Welcome to CFA Level I 2025 Fixed Income, Volume 6. We're kicking things off today with Module 01, Fixed Income Instrument Features. I'm really glad you're joining us for this deep dive. Seriously, think of this as your best shortcut to, well, really getting to grips with the basics of fixed income. It's foundational stuff. Today our mission is simple. Lay the groundwork. We want to understand the language, get a really clear picture of what these fixed income instruments actually are. It's like learning the alphabet before you try to read, absolutely crucial for everything that comes next in fixed income. We've got a good stack of source material here, lots of core concepts, examples, the details that really matter. And we're going to try and distill it all down, make it digestible, memorable. So by the end of this, you'll have a solid grasp of what these tools are, and just as importantly, why they're designed the way they are. Getting this first module right, it really sets you up perfectly for the rest of the CFA Level I fixed income journey. Trust me on that. And just looking ahead, next step, we'll be diving straight into Module 02, fixed income cash flows and types.
That builds directly on today's discussion, looking at how these features actually translate into, well, money changing hands. But first things first, let's get into the real DNA of these fixed income instruments. So starting right at the beginning, when we say fixed income instrument, what exactly are we talking about?
Fundamentally, we're talking about debt, a debt instrument.
Right. A loan, a bond.
Exactly. And it represents a contractual agreement. That word contractual is super important here.
Why is that so key?
Because it signifies a legally binding promise. You have one entity, the issuer or the borrower, getting money from investors, the lenders, and in exchange for that cash up front, the issuer makes these binding promises. They promise to pay periodic interest, we often call these coupons, and then, crucially, to repay the original amount borrowed, the principal, at some point in the future.
And you really can't overstate that contractual aspect, can you?
No, you really can't. It's not just a casual agreement. It's legally outlined, usually in a pretty detailed document, and that's what fundamentally separates debt from equity.
Right. With equity, you're an owner. Your return depends on how the company does if they decide to pay dividends.
Precisely. It's discretionary, linked to performance. But with fixed income, you're a creditor. The issuer has a clear legal obligation to pay you according to the contract. Doesn't matter if the company's stock is soaring or plummeting, they owe you that payment. If they miss it, they're in default. And that has serious consequences.
Okay, so it's a legal promise to pay. Now, you mentioned loans and bonds. Are they basically the same thing?
Well, they're both types of debt, but there are important distinctions. It's not quite all debt is created equal.
Okay. How do they differ?
Loans are typically private agreements. Think about getting a mortgage for your house or a company taking out a loan directly from a bank or maybe a small group of banks.
Negotiated one-on-one, basically.
Exactly. Because they're private, the terms can be highly customized, tailored to the borrower's specific situation and what the lender is comfortable with.
But that customization probably means they're harder to sell on.
That's the trade-off. Less standardization, less easy transferability.
Okay, so that's loans. What about bonds then?
Bonds are really designed for the wider capital markets. They're much more standardized, usually issued in smaller, uniform amounts like $1,000 or INR 10,000 face value.
Which makes them easier to trade.
Much easier, highly tradable. So instead of one bank lending to one company, bonds are often issued by bigger entities, large corporations, national governments, local governments, even special purpose entities we'll talk about. And they're issued to a really broad base of investors. Individuals, mutual funds, pension plans, insurance companies, you name it.
That standardization sounds like a game changer.
Oh, it absolutely is. That standardization is where the real power lies, isn't it? It opens the door to so much more liquidity.
Meaning people can buy and sell easily without messing up the price too much.
Exactly. And it allows for much better price discovery, figuring out what the fair market price actually is. Think about it. This is vital if you're a major corporation or a government trying to raise huge amounts of money globally.
Yeah, like the U.S. Treasury funding trillions in debt.
Precisely. They can't rely on just bespoke private loans. They need the reach, the efficiency of the bond market. Without that standardization, you'd be stuck with these tailored, inefficient deals that just don't scale up.
That makes sense. It's the difference between getting a custom suit made versus mass producing them.
Yeah.
But does that standardization mean less flexibility for the issuer sometimes? Like if they wanted to change the terms later on?
That's a great question. And yes, it certainly can. Once a bond is issued, its terms are pretty much set in stone, locked into that legal document, the indenture, which we'll get to later. If an issuer wants to change those terms, it usually requires getting agreement from a majority of the bondholders, and that can be a really complex, expensive process.
Compared to just renegotiating with your bank on a loan.
Right. Much simpler with a private loan, usually. So issuers essentially trade some of that flexibility for access to a much wider, deeper pool of capital through the bond market.
That's a really critical trade-off to keep in mind. Now, while we're talking about all these financial obligations, maybe we should clarify the scope a bit. What exactly falls under a fixed income for this specific CFA level I module?
Good point. Because while all fixed income instruments are liabilities, they represent an obligation to pay someone back. Not all liabilities are treated as fixed income instruments in this context.
Okay, so what's the focus here?
For the CFA Level I 2025 Fixed Income Volume 6 course, we're really zeroing in on instruments that are settled in cash and where the counterparty, the lender, is specifically an investor or a bank.
So think like a corporate bond from, say, Infosys in India.
Perfect example. Or a loan a company takes from State Bank of India, SBI. Those fit the bill.
And what's excluded then, just so we're clear?
We're generally excluding other kinds of liabilities you'd see on a balance sheet. Things like operating leases, pension obligations, accounts payable, accrued payroll, deferred revenue, taxes payable. These are all financial obligations, yes, but they don't quite fit that cash-settled investor bank counterparties definition that characterizes the fixed income instruments we're analyzing deeply in these modules.
Got it. So that helps you, the learner, really focus your attention correctly. We're looking at bonds and loans made by investors or banks. Okay, so within that framework, what are the absolute essential ingredients, the key features that define these instruments, and ultimately their cash flows?
Our source materials highlight several core features. We'll dig into each one, but just as a quick overview, we need to know the issuer who's borrowing, the time to maturity, how long the loan lasts, the principal amount or par value, how much is actually owed back at the end. Then there's the coupon rate and frequency, that's the interest, how much and how often. Seniority, basically, who gets paid first if the borrower gets into trouble. And finally, contingency provisions. These are special clauses for specific what-if scenarios.
You've laid out the components perfectly. It sounds like the genetic code of a bond, almost.
That's a good way to put it. And each one isn't just a label. It directly impacts the bond's risk profile, its potential return, and, what it's ultimately worth to an investor.
For example, longer maturity usually means more interest rate risk.
Exactly. And lower seniority means higher credit risk. So understanding these individual pieces is fundamental. They dictate the bond's health, if you will, and how it might behave in different market conditions. It's really the first step in evaluating any bond.
All right, let's peel back those layers then. Let's break down each key feature in more detail, starting right at the top. Who's actually doing the borrowing? So 2.1, the issuer. Who borrows and why it matters.
The issuer is just the legal entity responsible for making those interest and principal payments. Could be anyone, really, any legal entity.
And it ranges pretty widely, right?
Yeah.
From huge governments to smaller local entities.
Absolutely. You've got a whole spectrum. And the identity of that issuer, it's paramount. It directly tells you a lot about the perceived creditworthiness and therefore the risk and the kind of return you should expect.
Okay, so how do we categorize these issuers? What are the main buckets?
We usually break them down into two broad sectors, government and private.
Let's start with the government sector.
Within that, you have national or sovereign governments. These are the big ones. The U.S. Treasury issuing T-bonds, T-notes, T-bills, or the government of India issuing G-SECs, government securities.
And their ability to repay is backed by?
Their taxing authority, their overall fiscal power, and often, for developed economies, their ability to print their own currency.
Which generally makes them the lowest risk in their own market.
Typically, yes. They often serve as the risk-free benchmark within their domestic markets because the likelihood of default is considered extremely low.
Okay. What else in the government sector?
You have local or regional governments. Think municipal bonds, munis in the U.S., issued by states, cities, counties to fund local projects like schools or highways. India also has state development loans. Their ability to repay might come from local taxes or sometimes specific fees from the projects they fund, like tolls from a bridge or fares from a transit system.
So maybe a bit riskier than the national government bonds.
Often, yes, their revenue sources can be narrower. Then you have supranational organizations.
Like the World Bank.
Exactly. The World Bank, the IMF, these are international bodies formed by multiple governments. They issue bonds to raise money for development projects or loans to member countries.
And final,
Quasi-government entities. These are agencies owned or sponsored by governments, maybe a national postal service or railway, or think of the government-sponsored enterprises, GSEs, in the U.S., like Fannie Mae and Freddie Mac. They might issue their own debt, sometimes with government guarantees, either explicit or implicit.
okay, that's the government side. What about the private sector?
Two main types here. First, corporate issuers. These are just private companies. Think Apple Inc. in the US or Infosys, Reliance Industries in India. They issue bonds to fund operations, buy new equipment, make acquisitions, their ability to repay. It really hinges on their business performance, their cash flow generation, their overall financial health.
Makes sense.
And the second type.
Special purpose entities, or SPEs. These are quite interesting. An SPE is a legal entity created for a very specific, narrow purpose usually, to issue what are called asset-backed securities, or ABS.
How does that work? The SPE legally owns a specific pool of assets, maybe a bunch of mortgage loans or auto loan receivables or credit card debt. And the cash flows coming only from those assets are used to pay back the investors who bought the ABS.
So the repayment isn't tied to the original company that made the loans.
That's a key point. SPEs are often designed to be bankruptcy remote from the company that originated the assets. If the original company, say the bank that made the mortgages, gets into trouble, those assets in the SPE and their cash flows are legally separate. They should still be available to pay the ABS bondholders.
Ah, so that separation can reduce risk for the ABS investors compared to just buying a regular bond from the originating company.
Precisely. It isolates the risk to the performance of that specific pool of assets.
So it really sounds like the issuer's identity is the first big filter when you're assessing credit risk, isn't it?
Absolutely. It's the fundamental starting point. You look at a U.S. Treasury bond backed by the full faith and credit of the U.S. government. That's why it's a global benchmark for the risk-free rate. Virtually no default risk.
And similarly, in India, the government of India's GSECs are the lowest credit risk domestically.
Right. Then you move to corporates. Investors immediately start looking at the company's financials, its industry position, management quality, and they demand higher yields to compensate for that inherently higher risk compared to the sovereign. So yeah, the type of issuer tells you exactly where to begin your credit analysis.
Okay, that covers who is borrowing. Next up, 2.2, maturity and tenor. How long until repayment?
Pretty straightforward definitions here. Maturity is simply the date the final payment is due. That typically includes the last interest payment plus the full principal repayment. Tenor is just the remaining time until that maturity date. So a bond issued 10 years ago with a 30-year maturity now has a tenor of 20 years.
And we classify bonds based on their tenor at issuance, right?
Yeah, we do. The main distinction is between money market securities, these are short-term guys, tenor of 1 year or less at issuance. Think U.S. Treasury bills, T-bills, or commercial paper issued by very creditworthy companies for their short-term cash needs, generally very liquid, low risk. And capital market securities. These are the longer-term ones, tenor longer than 1 year at issuance. This covers the vast majority of bonds, corporate bonds, government bonds, ranging from maybe 2 years out to 30 years or even longer sometimes.
Now, beyond just the repayment date, maturity has a huge impact on risk, doesn't it? Particularly interest rate risk.
Absolutely huge. A longer maturity bond generally has higher duration. A concept we'll unpack fully in later modules, but basically it means its price will be much more sensitive to changes in market interest rates.
So if rates go up, the price of a long-term bond falls more sharply than a short-term one.
Exactly. That's why investors often see longer-dated bonds as carrying more interest rate risk. There's also reinvestment risks to consider for the investor. It's the risk that when you receive your coupon payments over the years, you might have to reinvest them at lower interest rates if market rates have fallen. This hurts your overall return, and it's more significant for longer-term bonds with many coupon payments.
And for the issuer, what does maturity mean for them?
Well, issuing long-term debt lets them lock in their financing costs for a long time. Great if you think rates might rise, but if rates fall, you might be stuck paying a higher rate than the current market.
Okay, so short-term, long-term, but then there's this other category, right? Perpetual bonds.
Ah, yes, the perpetual bonds, sometimes called consols. They're less common, but really fascinating. Why? Because they have no stated maturity date.
No maturity date, so the issuer never pays back the principal.
That's right. They just agree to pay interest, the coupon, forever, indefinitely.
Wow. Who issues those?
Well, historically, governments did. More recently, you see some corporates or quasi-government entities. For example, the Airport Authority Hong Kong, AAHK, issued about USD 1.5 billion worth of perpetual bonds back in late 2020
What for?
to help fund a massive project, their third runway, and for general corporate stuff. It showed investors had confidence in the airport's very long-term future, even during the pandemic.
But are they still considered debt if the principal isn't repaid?
Yes, they are, because they have contractually defined cash flows, those perpetual interest payments. And, crucially, they have seniority over equity holders in case of liquidation. They also don't grant voting rights like equity does.
So for the issuer, it's like permanent capital without having to repay the principal.
Exactly. Though they do have that perpetual interest payment obligation. For an investor, it's like buying an annuity that pays forever. But the interest rate risk is massive because, theoretically, the duration is infinite. Their price is extremely sensitive to rate changes.
Okay, very interesting. Let's move on to the amount itself. 2.3 principal, R or face value, the amount owed.
The principal, also called par value or face value, is simply the amount the issuer agrees to repay the investors when the bond matures. It's the original amount borrowed, basically, usually stated in standard units like $1,000 in the US or maybe INR 10,000 for many Indian bonds.
And how is that principal typically repaid?
The most common structure, like in that BRWA corporation example we saw, is a bullet payment. This means the entire principal amount is repaid in one single lump sum payment right at the maturity date.
So if BRWA issued a $300 million bond for 5 years,
At the end of year 5, they pay back the full $300 million plus the final interest payment, all at once.
gives the issuer use of the money for the whole time.
It does. But it also means they need to have a big chunk of cash ready on that specific maturity date, which carries some refinancing risk for them.
Are there other ways to repay principal?
Yes, some instruments are amortizing. This means the principal is repaid gradually over the life of the instrument, not all at the end.
Like a mortgage.
Exactly like a typical home mortgage. Each monthly payment you make includes both an interest component and a principal repayment component. So over the life of the loan, the outstanding principal balance slowly declines.
And by the end of the term, it's fully paid off through those regular installments.
Right. Not one big bullet payment at the end.
And that difference between bullet and amortizing must have big implications.
Oh, definitely. For both sides. For the issuer, amortizing debt spreads out the repayment obligation. It reduces that big refinancing risk of needing a huge lump sum at maturity.
And for the investor.
It means you get some of your principal back regularly throughout the bond's life. That reduces the amount of your capital at risk over time. Plus, it provides more frequent cash flows. Think about a housing loan portfolio securitized by, say, HDFC Bank in India. Investors in those securities are getting principal back every month, not just waiting 20 years. That can be quite attractive.
So that regular return of capital changes the whole cash flow profile. What about situations where the principal repayment isn't guaranteed? Maybe depends on something else.
Now you're touching on contingency provisions tied to principal. We'll cover these more formally later. But things like call features or put features.
Call feature means the issuer can repay early.
Right. The issuer has the option to call the bond back and repay the principal before the scheduled maturity date, usually if interest rates have fallen.
And a put feature.
That gives the investor the option to demand early repayment from the issuer, perhaps if rates have risen or if something specific happens. These contingencies add a layer of optionality, making the bond's valuation and risk profile more complex.
Okay, got it. Now for the part everyone thinks about with fixed income. The income. 2.4 coupon rate and frequency. The interest payment.
Exactly, the coupon payments. This is the interest the bondholder receives for lending their money, and the way these payments are structured can vary quite a bit.
The most common type is
Fixed coupon bonds. These are straightforward. They pay a set, predetermined amount of interest on specific scheduled dates. Could be annually, semi-annually, quarterly, even monthly sometimes. In the U.S. and Indian corporate bond markets, semi-annual payments are very common.
And how do you calculate the payment?
Simple formula. The annual coupon amount is just the coupon rate multiplied by the par value of the bond.
Mm.
If the payments are more frequent, say semi-annually, you just divide that annual amount by 2. If quarterly, divide by 4.
So a bond with a $1,000 par value, 6% coupon rate, paying quarterly.
Annual coupon is $60, 6% of $1,000. Quarterly payment would be $15, $60 divided by 4, paid 4 times a year.
Let's make that concrete. Got any examples?
Sure. Let's take an Indian example. Say State Bank of India, SBI, issues a bond with a par value of INR 10,000. It has a 7% fixed coupon rate and pays semi-annually. The annual interest is 7% of 10,000, which is INR 700. Since it pays semi-annually, the bondholder gets INR 350 every 6 months.
Okay. And a U.S. example.
Let's say Apple Inc. issues a corporate bond. Par value $1,000, 3% fixed coupon, paying semi-annually. Annual interest is 3% of $1,000, so $30. Semi-annual payment is $15, $30 divided by 2, paid every 6 months.
Pretty clear. Predictable income stream. That's a big appeal.
Definitely. But not all bonds are fixed rate. You also have floating rate notes, or FRNs.
Floating rate. So the coupon payment changes.
Exactly. FRNs don't have a fixed interest payment. Instead, their coupon rate resets periodically, maybe every 3 months or 6 months, based on what's happening in the market.
How is that floating rate determined?
It usually has 2 main parts. First, a market reference rate, MRR. This is a benchmark rate reflecting the cost of borrowing for highly creditworthy issuers in a particular currency and for a specific period. Historically, LIBOR, London Interbank Offered Rate, was the big one globally, but it had issues.
Yeah, the manipulation scandals.
Right. So now the market is transitioning to more robust transaction-based rates. In the U.S., the main one now is SOFR, the Secured Overnight Financing Rate. It's based on actual overnight repo transactions collateralized by U.S. Treasuries. Much more reliable.
And other markets have their own reference rates. India, too.
Yes, India has benchmarks often linked to interbank lending rates or treasury bill rates. This MRR component resets periodically, reflecting current market conditions.
Okay, so that's the base rate. What's the second part?
The second part is an issuer-specific spread, often just called the credit spread or margin. This is a fixed amount, usually stated in basis points, hundredths of a percent, that gets added to the MRR. This spread is set when the bond is first issued and generally stays constant for the bond's entire life. It reflects the issuer's specific credit risk.
So a riskier issuer would have a higher spread.
Precisely. Higher credit quality means a lower spread, lower quality means a higher spread. It's compensation for the issuer's specific riskiness above the general market rate.
Okay, can you walk us through an example calculation?
Sure. Let's imagine a European company issues a EUR 10 million FRN. It pays interest quarterly, and the rate is set at the 3-month MRR plus 125 basis points, which is 1.25%. Now, let's say for a particular quarter, the 3-month MRR happens to be negative 0.50%. Negative rates can happen.
Right.
So the coupon rate for that quarter would be negative 0.50% plus 1.25%, which equals 0.75%. The annual interest payable would be 0.75% of EUR 10 million, which is EUR 75,000. Since it pays quarterly, that's EUR 18,750 for that specific quarter, and the rate would reset again for the next quarter based on the new MRR.
So what's the big picture takeaway with FRNs? Who likes them?
Well, what's crucial is their dynamic nature. For investors, FRNs offer protection against rising interest rates. Because the coupon payment adjusts upwards when market rates rise, their income stream kind of keeps pace.
And for issuers?
They effectively transfer the interest rate risk to the bondholder. If rates go up, the issuer has to pay more interest, but the investor receives more.
Seems like a fair trade-off. Any catches?
Yes. A key nuance often missed is that many FRNs have built-in caps, a maximum rate the coupon can reach, or floors, a minimum rate it won't fall below.
So the protection against rising rates might not be unlimited if there's a cap.
Exactly. Or the protection against falling rates for the issuer might be limited by a floor. You really need to read the fine print, the indenture, to understand the specific provisions. They can significantly affect the risk and reward.
Good point. The details always matter.
Yeah.
Okay, fixed, floating. What's the third main type?
The third type is zero coupon bonds, sometimes called pure discount bonds. These are quite different.
How so? No coupons at all?
That's right. They don't pay any periodic interest payments during their life. None.
So how does the investor make money?
They are issued at a significant discount to their par value. The investor buys the bond for, say, $700, and then at maturity, they receive the full par value, maybe $1,000. The interest earned is simply that difference between the discounted purchase price and the full par value received at the end. It's all paid in one lump sum at maturity.
So you don't get regular checks, but the return is built into that price appreciation from discount to par.
Exactly. It's like all the cumulative interest is bundled up and paid at the very end.
Who finds these attractive?
They can be popular for long-term savings goals, like planning for a college tuition or retirement. You know exactly how much money you'll get back at a specific future date, and there's no hassle of reinvesting coupon payments along the way.
And for issuers.
They avoid those periodic cash outflows for coupon payments, which can be helpful. But of course, they need to be prepared to make that single, large principal repayment, which includes the implied interest, at maturity.
Okay, that covers the core features brilliantly. Now, let's shift focus slightly. How do these features actually influence the risk and the potential return for an investor? Because ultimately, that's what drives investment decisions, right? Let's start with 3.1, seniority. Who gets paid first?
Right, seniority. This refers to the priority order of repayment among all of an issuer's different debt obligations, and it becomes absolutely critical if the issuer runs into financial trouble, like bankruptcy or liquidation. Seniority dictates who gets first dibs on any remaining assets. It's fundamental to credit risk.
So there's a pecking order. What does it typically look like?
Generally, yes. The typical order of claims, from highest priority down to lowest, is 1. Senior secured debt. These guys are at the front of the line. Why? Because their claim is often backed by specific assets pledged as collateral. So if the company liquidates, the holders of senior secured debt have the first legal claim on the proceeds from selling those specific assets. If the collateral isn't enough to cover their claim, they might become unsecured creditors for the remaining amount, but they get first crack at the pledged assets. 2. Senior unsecured debt. Next in line. These debts aren't backed by specific collateral, but they still rank ahead of any junior debt. That BRWA Corporation bond example we mentioned was senior unsecured. They get paid after the secured guys, but before the junior ones. 3. Junior debt or subordinated debt. These are at the bottom of the debt hierarchy.
Cool.
Holders of junior or subordinated debt only get paid after all the senior claims, both secured and unsecured, have been fully satisfied.
Which means if there isn't enough money left after paying the senior creditors.
The junior debt holders might get very little back, or sometimes even nothing at all. This makes them significantly riskier than senior debt.
Okay, so we know who's first in line. But why is really understanding this hierarchy so crucial for an investor? Can you maybe give a quick hypothetical?
Absolutely. Think of it like queuing for a lifeboat on a sinking ship. The senior secured creditors get on first, often with designated seats, the collateral. Then the senior unsecured, then the junior folks wait at the back. Why is it crucial? Because it directly impacts the potential recovery rate, how much money you might get back if the issuer defaults. And that directly affects the perceived credit risk and therefore the yield investors demand.
So higher chance of recovery means lower risk, lower yield.
Exactly. Imagine a company, let's call it Vivu Inc., defaults. If you hold their senior secured bonds, maybe backed by valuable real estate, you have a pretty decent chance of recovering a good chunk of your investment by selling that real estate. But if you hold their junior unsecured debt, by the time the secured and senior unsecured creditors have been paid, there might be very little left for you. That much higher risk means investors will demand a much, much higher yield to even consider buying that junior debt. This hierarchy is absolutely fundamental to assessing bond safety.
Makes perfect sense. And that leads us directly into 3.2, credit risk, the risk of default.
Right. Building directly on seniority, credit risk is, quite simply, the risk that you won't get your money back as promised. It's the risk of loss, because the issuer fails to make their interest or principal payments in full and on time, either because they can't pay, not enough money, or, less commonly, because they won't pay. Lack of willingness may be in a sovereign context.
And this risk directly impacts the yield, you said.
Directly. Investors demand compensation for taking on risk. So for bonds with very low credit risk, think U.S. Treasuries or Indian G-Secs investors accept lower yields because repayment is seen as highly probable. As the perceived credit quality goes down, meaning the chance of default goes up, investors demand progressively higher yields. This extra yield is their risk premium, their compensation for the possibility of not getting paid back in full.
It's a spectrum then, from risk-free governments up to speculative junk bonds.
Exactly. And yields generally move inversely with perceived credit quality. Higher quality, lower yield. Lower quality, higher yield.
What factors actually influence that credit quality assessment?
Several things we've touched on. The underlying source of repayment is taxes, operating cash flow, Specific assets, we'll dig into that more. Its seniority senior is safer than junior. Any credit enhancements like collateral backing. And then there's the issuer's overall financial health, their industry, competitive pressures, management competence, even the broader macroeconomic environment. And sometimes, particularly with sovereigns, their historical willingness to honor their debts plays a role too. It's a complex assessment.
Okay, so we understand the risks. Now, how do we actually measure the potential return? Let's talk about 3.3 yield measures. What's my return?
Right. Given all those features we discussed and the bond's current market price, we can calculate different yield measures. These help quantify the return an investor might expect and allow us to compare different bonds.
What's one of the simpler measures?
One straightforward one is the current yield, CY.
Yeah, how's that calculated?
Very simple. Take the bond's annual coupon payment and divide it by the bond's current market price. Then express it as a percentage.
So it's like a dividend yield on a stock.
Pretty much analogous, yeah. It tells you the income return you're getting right now based on the current price. But importantly, it ignores any potential capital gain or loss you might realize if you hold the bond until maturity or sell it before then. It also ignores the time value of money.
And it changes if the price changes.
Yes, there's an inverse relationship. If a bond's price goes down, its current yield goes up, assuming the coupon payment stays the same.
Got an example?
Sure. Remember that BRWA bond with a 3.2% annual coupon? Let's say it's currently trading the market at a price of $101, meaning $101 for every $100 of face value. Its current yield would be the annual coupon payment, which is $3.20 per $100 face value, divided by the current price, 101. So $3.20 equals approximately 3.168%.
So it's a quick snapshot of current income return.
But limited.
Exactly. Useful but incomplete.
What's the more comprehensive measure that people usually talk about?
But that would be the yield to maturity YTM. This is a much more common and more informative measure.
Okay, what is YTM conceptually? Conceptually, the YTM is the total anticipated return on a bond if the bond is held until it matures. It's expressed as an annual rate. More technically, it's the internal rate of return, IRR, on the bond's cash flows. That means it's the single discount rate that makes the present value of all the bond's expected future cash flows, all the remaining coupon payments, plus the final principal repayment exactly equal to the bond's current market price.
So it accounts for the coupon payments, the final principal, and the current price.
Yes, and the time value of money. It gives you a single percentage figure representing the total expected annualized return if, and this is a big if, certain assumptions hold true.
Ah, the assumptions. What are they? Why might my actual return not equal the YTM calculated when I bought the bond?
There are three crucial assumptions baked into the YTM calculation. For your actual realized return to match the YTM, all three must hold. 1, you must receive all the promised interest and principal payments exactly as scheduled. In other words, the issuer cannot default. It's obviously not guaranteed, especially for riskier bonds. 2, you must hold the bond until its maturity date. If you sell it before maturity, your return will depend on the market price you sell it at, which could be higher or lower than you expect. 3, and this is often the trickiest one, you must be able to reinvest all the periodic coupon payments you receive at a rate exactly equal to the original YTM.
Why is that tricky?
Because market interest rates fluctuate. If rates fall after you buy the bond, you'll likely reinvest those coupons at a lower rate than the initial YTM. This will drag your actual realized return below the YTM you calculated at purchase.
And if rates rise?
You might reinvest the coupons at a higher rate, potentially boosting your actual return above the initial YTM. This is that reinvestment risk we mentioned earlier. So you've really hit the core challenge with YTM as a predictor of actual return. It's a theoretical, forward-looking snapshot based on current price and promised cash flows under ideal conditions. It's an excellent benchmark for comparing bonds and understanding the market's current expectation of total return. But that reinvestment assumption, it's critical. For a long-term bond, a big chunk of the total return actually comes from reinvesting those coupons. If you assume a 5% YTM but can only reinvest at 3%, your final result will be lower.
So YTM is a powerful tool for valuation and comparison, but we need to remember those underlying assumptions.
Absolutely. Keep them front of mind.
Okay, we'll definitely dive much deeper into the actual calculation of YTM in later modules. It involves present value math, often using financial calculators or spreadsheets. For now, understanding the concept and its assumptions is key. It represents the market's expected total return if held to maturity under those specific conditions. Now, most issuers, governments, big companies, they don't just have one bond out there, right? They have lots with different maturities. How do we make sense of all that?
That's where yield curves come in. They're a really useful way to visualize the relationship between yield and maturity for a specific issuer.
Okay, so what exactly is a yield curve? 3.4 yield curves. Visualizing market expectations.
It's simply a graph. On the horizontal axis, you plot the time to maturity of an issuer's bonds. On the vertical axis, you plot their yield to maturity, YTM. The crucial thing is you're plotting bonds from the same issuer and ideally with very similar features like coupon type, seniority, etc., except for their maturity date. So you're comparing apples to apples, just different maturities.
So what might a typical yield curve look like? Let's use that BRWA Corporation example again.
For many issuers like BRWA, you might see that bonds with longer maturities have higher YTMs. The graph would slope upwards from left to right.
We call that an upward sloping or normal yield curve. What does that shape tell us?
It suggests that investors are demanding higher expected returns to compensate them for tying up their money for longer periods. Longer time horizon usually means more uncertainty, more exposure to risks like interest rate changes or inflation eroding returns, so they want more compensation, a higher yield for longer maturities. It makes intuitive sense.
Are there other shapes?
Oh yes, you can have a flat yield curve where short-term and long-term yields are pretty much the same, or sometimes you see an inverted yield curve where short-term yields are actually higher than long-term yields.
Inverted curves are often talked about as predicting recessions, right?
They have historically been a fairly reliable, though not perfect, indicator of potential economic slowdowns or recessions ahead. The shape of the yield curve itself is a powerful piece of economic information.
Okay, so we can plot a yield curve for a company like BRWA. How does that help us understand their credit risk specifically?
By comparing it to the yield curve of a benchmark issuer that has very little or no credit risk typically, the sovereign government in that same currency. This brings us to the concept of credit spreads.
What exactly is a credit spread?
It's simply the difference in yield to maturity between an issuer's bond, say a corporate bond like BRWA's, and a comparable sovereign bond like a U.S. Treasury or an Indian GSEC that has the same maturity and is in the same currency. This difference, the spread, represents the extra yield investors demand for taking on the specific credit risk of that particular issuer over and above the risk-free rate offered by the government. It's the market's price for that issuer's credit risk.
Can we use our BRWA example if their 5-year bond has a YTM of 3.2%?
And the 5-year U.S. Treasury bond has a YTM of 2.3% at the same time.
Then the credit spread is 3.2% minus 2.3%, which is 0.9% or 90 basis points.
Exactly. That 90 basis points is the additional compensation investors require for lending to BRWA instead of the safer U.S. government for that 5-year period. And this comparison to the sovereign yield curve, that's really where the rubber meets the road for credit analysis and relative valuation. It gives you a quick, clear snapshot of how the market is pricing an issuer's credit risk relative to the benchmark risk-free rate.
So if that spread widens,
If the spread widens, say it goes from 90 BPs to 120 BPs, it generally signals that the market perceives more risk in lending to BRWA. Maybe the company reported poor earnings, or the economic outlook for its sector worsened. Investors are demanding more compensation.
and if the spread tightens, say down to 70 BPs,
That usually suggests improving credit quality or a more positive outlook for the issuer. The market feels safer lending to them, so they demand less extra yield. Monitoring these spreads is a fundamental part of fixed income analysis.
So just to use an Indian example, if a 5-year Infosys corporate bond yields, say 6%, and a 5-year Government of India GSEC yields 5%,
Then that 100 basis point spread, 6%, 5%, is the market's current price for the perceived credit risk of Infosys compared to the Indian government. It's a very tangible measure.
fantastic. Okay, we've covered the core features, risk, return, yields. But what about the legal stuff, the contracts that underpin all this?
Yes, absolutely critical. This brings us to the legal backbone, Section 4, the legal backbone, indentures and covenants.
Let's start with the main document, 4.1 bond indentures, the legal contract.
The bond indenture, sometimes called a trust deed, is the comprehensive legal contract between the bond issuer and the bondholders. It meticulously describes the form of the bond, spells out all the obligations of the issuer, and details the rights of the bondholders. It's essentially the complete rule book for that specific bond issue. Think of it as the Constitution governing that bond.
So it contains more than just the coupon rate and maturity date.
Oh, much more. It specifies all the features we've discussed, but it also typically identifies the issuer's specific sources of funds for repayment, outlines any promises or commitments the issuer makes to the bondholders, these are the covenants we'll discuss, and includes provisions designed to support the issuer's ability to repay the debt. It details things like payment dates, calculation methods, specifies the trustee who acts on behalf of the bondholders, and outlines procedures in case of default. It's a hefty document, usually.
And why is this indenture so important for investors?
Because it's what legally protects them. Remember, unlike equity holders who get voting rights, bondholders generally don't have a direct say in how the company is run. Their rights and protections stem entirely from this legal contract, the indenture. If there's ever a dispute, if the issuer fails to pay or violates a term, this document is what the bondholders or the trustee acting for them rely on to enforce their rights. Understanding what's in the indenture is paramount for assessing the true safety of a bond.
Okay, so the indenture sets the rules. One key thing it likely specifies is where the repayment money comes from. Let's talk about 4.2 sources of repayment. Where does the money come from?
Absolutely. Knowing the underlying source of funds used to pay back the debt is fundamental to assessing credit quality, and it varies hugely depending on the type of issuer.
Let's break it down by issuer type again. National governments.
National governments, sovereign bonds. Their repayment capacity primarily comes from their broad taxing authority and general fiscal power, their ability to collect taxes, manage spending, control the economy. And as we mentioned, for governments borrowing in their own currency, the ability to print money provides an ultimate backstop, making default in local currency extremely rare for developed nations. That's why they're benchmarks.
Local government.
Local regional governments. Repayment might come from their own local taxing power, like property taxes for a city, or often from specific revenues generated by the projects being funded. Think revenue bonds, where tolls from a bridge or fares from a transit system are pledged to repay the bonds. Their sources can be narrower, more project-specific.
Okay, now for corporations. Corporate bonds. Where does their repayment money come from?
It depends. For unsecured corporate bonds like that BRWA example, investors are primarily relying on the company's operating cash flows. You're essentially betting on the core business being profitable and generating enough cash to meet its debt obligations. This means you need to analyze the company's financials, its industry, its competitive standing very carefully.
What about secured corporate bonds?
They also primarily rely on operating cash flows as the first source, but they offer an extra layer of protection: collateral. These bonds have a legal claim, a lien or pledge, on specific assets owned by the company. This collateral serves as a secondary source of repayment. If the company defaults and goes into liquidation, the secured bondholders have first claim on the proceeds from selling those specific pledged assets.
What kind of assets can be used as collateral?
All sorts. Physical assets like buildings, machinery, inventory, financial assets like accounts receivable, specific cash flow streams like license fees or royalties, even guarantees from a third party.
Does providing collateral benefit the issuer?
It usually lowers their borrowing cost because it reduces the risk for investors, but the trade-off is reduced operational flexibility. Those pledged assets are tied up. The company can't easily sell them or use them to secure other loans.
Okay, and then there are those asset-backed securities, ABS, we mentioned earlier. Where does their repayment come from?
This is where it's quite different. ABS are issued by those special purpose entities, SPEs. The absolutely crucial point is that repayment comes solely from the cash flows generated by the specific pool of underlying assets owned by the SPE. It's not reliant on the general health of the company that originated the loans, like the bank that made the mortgages. It's ring-fenced. Repayment depends only on whether the borrowers in that specific pool make their payments.
And you mentioned tranches before. How does that relate to repayment?
Right. ABS deals often slice the securities into different tranches, creating a kind of internal capital structure. Each tranche has a different priority claim on the cash flows coming from the asset pool. For example, Tranche A investors might get paid first, then Tranche B, and only if there's enough cash left over do the Tranche C investors get paid. The lower tranches, like C, are riskier, but offer higher potential yields, while the senior tranches, like A, are safer but lower yielding.
Can you give examples of ABS?
Sure. In India, you see banks like HDFC securitizing pools of their housing loans. The cash flows from those mortgages are packaged into ABS and sold to investors. This frees up HDFC's capital to make new loans. In the U.S., the most famous examples are mortgage-backed securities, MBS, especially those issued or guaranteed by government agencies like Fannie Mae or Freddie Mac. Huge market. Pools of residential mortgages underpin these securities. And what's really fascinating about this whole securitization process
Uh,
is how it transforms relatively illiquid assets, like thousands of individual mortgages, into liquid, tradable securities. It allows risk to be repackaged and sold to investors with different appetites. It's fundamentally changed how lending works globally. Banks can originate loans, package them up, sell them off, and use the capital to lend again. It's a core mechanism for efficient capital allocation in modern finance.
It really is incredible how risk can be sliced and diced like that. Okay, so the indenture is the master contract. But you mentioned it contains specific rules or promises. Let's talk about 4.3 bond covenants, rules for behavior.
Right. Since bondholders don't have the direct influence of equity holders, covenants become incredibly important protective measures. These are legally enforceable rules agreed upon by the issuer and lenders right at the start, included within the indenture. They're designed to protect the bondholder's interest by restricting certain actions of the issuer or requiring them to meet specific standards, ensuring they maintain their ability and willingness to pay.
What are the main types of covenants?
We generally split them into two categories, affirmative and negative.
Okay, affirmative covenants first. What are those? Thou shalt do.
Exactly. Affirmative covenants specify what the issuer is required to do. They're usually more administrative, focused on transparency and good practice. They typically don't materially restrict the issuer's actual business operations.
Like a
Things like promising to use the bond proceeds only for the stated purpose, for example, building a factory, providing regular audited financial statements to bondholders, maintaining adequate insurance on key assets, paying taxes on time. Sometimes they might include clauses allowing bondholders to sell their bonds back to the company at a premium if the company gets acquired. A change of control put.
Are there any particularly important affirmative covenants?
Yes, a couple stand out. One is the pari passu clause. It literally means on equal footing. This clause ensures that the debt covered by the indenture will rank equally have the same payment priority as the borrower's other similar senior debt instruments. It prevents the issuer from creating new debt of the same type that would somehow rank ahead of the existing bonds. For instance, if that Antelis AG FRN had a pari passu clause, any new secured unsubordinated debt they issued couldn't jump ahead in the queue. It would rank alongside the existing notes.
That protects existing bondholders from getting pushed back in line.
Precisely. Another crucial one is the cross-default clause. This specifies that if the issuer defaults on one of its significant debt obligations, it's automatically considered in default on other specified debts, like the bond in question, even if payments on those other debts are still current.
Why is that important?
It prevents the issuer from selectively defaulting, say, defaulting on junior debt while keeping senior debt current. It triggers default clauses across multiple agreements simultaneously, giving more power to all creditors.
Okay, those are the thou shalts. What about the negative covenants, the thou shalt nots?
These are often the ones investors focus on more intensely because they are typically more restrictive. Negative covenants specify what the issuer is prohibited from doing. Their main purpose is to prevent the issuer from taking actions that could weaken its financial position and jeopardize its ability to repay the bonds. You generally find stricter negative covenants on bonds issued by companies with lower credit ratings as investors demand more protection.
What kind of restrictions are common, say, for a higher-rated company like BRWA Corp?
For a relatively strong issuer, the negative covenants might be less constraining. Examples include limitation on liens. Restricts the issuer's ability to pledge its assets as collateral for other debts. This protects existing unsecured bondholders by ensuring there are still unencumbered assets available if things go wrong. Limitation on sale and leasebacks. Prevents the company from selling key assets and then just leasing them back. This keeps those assets potentially available to creditors and maintains operational control. Restrictions on mergers and consolidations. Limits the company's ability to merge or consolidate with another entity if doing so would violate other covenants or significantly weaken the credit quality of the combined entity, thus harming existing bondholders.
Okay, those sound protective, but maybe not overly burdensome. What about for a lower quality issuer, like that hypothetical Vivi Inc.? What kind of thou shalt nots might they face?
For lower-rated issuers, the negative covenants can get much tighter, much more detailed. Examples include restriction on additional debt. Severely limits the issuer's ability to take on new debt unless certain conditions, often called an incurrence test, are met. For example, any new debt might have to be subordinated junior to the existing bonds, or might only be allowed for specific purposes like short-term working capital up to a strict limit. Restrictions on dividends and distributions. This is a big one. It often prohibits the issuer from paying dividends to shareholders, buying back its own stock, or making other payments to equity holders unless, again, a stringent incurrence test is met. This keeps cash within the company for the benefit of debt holders rather than flowing out to shareholders. Maintenance covenants, debt restriction tests. These require the issuer to maintain certain financial ratios at specific levels continuously, tested each reporting period. For example, a covenant might say net interest-bearing debt to EBITDA must not exceed 5.00x, or the interest coverage ratio, EBITDA divided by interest expense, must remain above 2.50x. Failure to meet these triggers a violation. Incurrence tests. These are often even tighter ratio requirements that must be met before the company is allowed to take specific actions, like issuing more debt or paying a dividend. So maybe the NIB to BIP ratio must be below 4.50x and interest coverage above 3.0x before they can pay that dividend. These act as gates preventing risky actions. Negative pledge clause. This is a broader restriction preventing the issuer from creating limits on assets to secure other debt, potentially limiting investments or asset sales, effectively preventing actions that could subordinate or disadvantage the existing bondholders.
Wow, those negative covenants for lower quality issuers sound incredibly strict. Can they? Can they ever backfire? Be too restrictive and actually cause problems?
That's a really critical point. And yes, absolutely they can. It's a delicate balance. If covenants are overly strict, they might hamstring the company. They could prevent management from taking necessary actions to grow the business, respond to market changes, or even raise crucial new funds for a promising investment opportunity.
So, a covenant designed to protect could ironically stifle the company's ability to improve its situation.
Exactly. Imagine a company facing a temporary downturn, but having a viable turnaround plan that requires new investment. If overly tight covenants prevent them from raising that capital, it could push them into a default that might otherwise have been avoidable. The goal of covenants should be to manage risk and align incentives, not to put the issuer in a straitjacket that prevents necessary business actions. It's about finding that balance between protecting creditors and allowing the business the flexibility it needs to succeed and ultimately repay its debts.
That's a fantastic insight, the potential unintended consequences. So what happens if an issuer actually does violate a covenant? What recourse do bondholders have?
Covenant violations aren't automatically a default on payment, but they are serious breaches of the contract. The indenture typically outlines specific remedies or recourse for bondholders. These can include a change in the financial terms. Maybe the interest rate on the bonds automatically increases, a penalty rate, or the issuer might be forced to provide additional collateral to secure the bonds now that risk has increased. Accelerated debt payments. This is a powerful one. The violation might give bondholders the right to demand immediate repayment of the entire principal amount outstanding. The debt becomes due right away. Or, in some cases, the termination of the debt agreement entirely, allowing bondholders to pursue legal action immediately to recover their investment. These remedies give bondholders significant leverage to ensure issuers stick to the agreed-upon rules.
Okay, absolutely fascinating stuff. We've really covered the waterfront on the essential features.
Yeah.
And just like that, we've navigated the core components of fixed income instruments. That was a really insightful deep dive into the very fabric of these tools for CFA Level I 2025 Fixed Income Volume 6, Module 01, Fixed Income Instrument Features.
It really was. We've seen how all these pieces fit together, the issuer type, maturity, principal, coupon structure, seniority, and those crucial legal elements in the indenture and covenants. Every single feature shapes the bond's risk and return profile. Getting these fundamentals down is truly foundational. You can't really analyze a bond properly without understanding this stuff first.
Absolutely. So for everyone listening, you should now have a much clearer picture of what we mean by fixed income, the key differences between issuers like governments and corporations, how maturity and principal work, and those vital distinctions between fixed, floating, and zero coupon bonds. We also unpack the importance of seniority, how credit risk drives yields, and how measures like current yield and yield to maturity help quantify potential returns. And underpinning it all, that legal framework, the indenture, and the power of affirmative and negative covenants. It's a solid base to build on. I really hope you feel more equipped now. And just to leave you with something to chew on, here's where it gets really interesting thinking ahead. Consider this. You have central banks, like the Federal Reserve in the U.S. and the Reserve Bank of India, actively managing interest rates through monetary policy. How might their ongoing actions dynamically shift the relative attractiveness of, say, floating rate notes versus fixed coupon bonds?
think about it from both the issuer's perspective and the investor's perspective in both the U.S. and Indian markets. How does it change who prefers which structure based on where they think rates are headed? How does that affect the transfer of interest rate risk we talked about? It's definitely something worth mulling over as you continue through the fixed income material. Okay, that officially wraps up our deep dive into Module O1, Fixed Income Instrument Features. Next time, we'll jump straight into Module O2, Fixed Income Cash Flows and Types. We'll build directly on today's foundation, exploring the detailed cash flow patterns these instruments generate and looking at different ways bonds are categorized based on those flows. You definitely won't want to miss that one.
Welcome to the Deep Dive, your essential guide to really getting to grips with fixed income for your CFA Level I 2025 Fixed Income Volume 6 journey. Today, we're tearing open Module O2, Fixed Income Cash Flows and Types. Think of this module as our deep dive into the very DNA of debt instruments, how they generate returns, the clever features that define their behavior, and importantly, the legal and tax landscapes they navigate. We're basically asking, how do financial engineers design these things, these bonds, to solve all the different problems faced by both borrowers and lenders in this dynamic global market?
That's a great way to frame it. And as your guide through this CFA Level I material, I can tell you getting these fundamentals down isn't just academic. It's absolutely essential for anyone looking to, well, navigate the fixed income landscape. Doesn't matter if you're analyzing a company's debt or building a portfolio. We'll look at what the structures themselves, but also really dig into the why, uncovering how they strategically impact risk, return, and even an issuer's flexibility in managing their balance sheet. This module really does set the stage.
That's a critical point, that strategic impact. It's not just mechanics. And for those of you planning ahead, after this deep dive into cash flows and types, our next module, Module O3, will be all about fixed income issuance and trading. That's where we'll see how these instruments actually come to market and change hands. It ties directly into the features we're discussing today. But okay, for now, let's unpack this fascinating world of fixed income, cash flows, and types. Okay, let's dive straight into the heart of it. How bonds actually pay out. We kind of start with the most common one, right? The bullet bond.
Yeah, a bullet bond. It's about as basic as it gets in fixed income, but foundational.
Foundational. Okay. So what makes it tick?
Well, it's pretty straightforward, really.
Yeah.
The issuer could be a government, could be a company. They get the cash, the principal, right at the start.
Okay.
Then, over the life of the bond, say 5 years, 10 years, whatever, they make regular fixed coupon payments. Usually semi-annual in many markets like the U.S.
Got it. Predictable payments.
Exactly. And then, the key part, right at the very end, at maturity, boom, they pay back the entire original principal amount, all in one go.
A big lump sum.
That's it, along with that last coupon payment, of course.
Yeah.
So it's like a really steady, predictable income stream for the investor.
So going back to that BRWA example, the 5-year, $300 million one with the 3.2% semi-annual coupon, if I bought that, I'd just be getting those regular coupon checks twice a year.
Yep.
And then, bam, 5 years later, the full $300 million comes back to me.
Precisely. You've got it. That structure is, well, it's super popular. You see it with governments, big corporations.
Why so popular?
Predictability. Investors, especially big institutions like pension funds or insurance companies, they often love it because they can perfectly match it to future payouts they know they have to make. It's like setting a financial clock,
Makes sense. That predictability must be key.
Absolutely. And you see this everywhere. In the U.S., think about standard corporate bonds from big names like Apple or Tesla, often bullet structures. Same in India. The Indian government frequently issues government securities, GSECs with bullet maturities. Very predictable return profile, which investors like the RBI or commercial banks definitely value.
Okay, but not all bonds are like that, waiting till the very end for the principal. Some spread it out, right?
These are called amortizing bonds.
That's right, amortizing bonds.
What's the main idea here? How do they differ fundamentally from a bullet?
Well, the key difference, the fundamental shift, is that the principal, the amount the issuer owes you, is gradually reduced before the bond's final maturity date. So instead of that single big payment at the end, you get portions of your principal back periodically, usually alongside the interest payments. Now, for the borrower, this can be a big plus. It means more evenly spread out payments over time, which can be easier to manage than saving up for one huge lump sum.
Right, avoids that big cash crunch at maturity. Exactly. And for investors, well, it means higher cash flows in the near term because you're getting both interest and some principal back with each payment. Plus, it actually reduces your credit risk. As the issuer pays down the principal,
their total outstanding liability shrinks, making them theoretically less likely to default on the remaining amount.
Okay, so lower credit risk sounds good, but there's always a trade-off, isn't there?
There usually is. In this case, the big one for the investor is reinvestment risk.
Reinvestment risk. Explain that.
Okay, so you're getting your principal back earlier than you would with a bullet bond, right?
Yeah.
But now you have to reinvest that principal. And what if market interest rates have fallen since you bought the bond?
Ah, so you might have to reinvest at a lower rate than what you were originally earning.
Precisely. You might have been earning, say, 5%, but now you get some principal back, and the best you can find is 2%.
Yeah.
That drags down your overall return. It's the risk that you can't put your money back to work at the same attractive yield.
Okay, less credit risk, but more reinvestment risk, a crucial trade-off, like you said. So can you walk us through the different types of these amortizing structures?
Certainly. Let's start with the most straightforward, fully amortizing bonds. With these, each periodic payment, whether it's monthly, quarterly, whatever the schedule is, includes both interest and a portion of the principal. And it's all calculated very precisely so that by the time the bond or loan hits its maturity date, the entire principal amount has been completely repaid. Nothing left outstanding.
This sounds really familiar. Is this like how a typical home mortgage works?
Exactly like that. It's probably the most common example people encounter in their daily lives. Think about a standard 30-year fixed-rate residential mortgage in the U.S.
Right.
Let's say you borrow $400,000 at 3.5% annual interest.
Okay.
Your monthly payment would be constant, maybe around $7,796 or so. But here's the interesting part. Even though the total payment is fixed, the composition changes over time.
How so?
Well, initially, a huge chunk of that $7,796 goes just to pay the interest owed for that month, maybe over $1,100.
Wow, really?
Yeah. And only the remainder, maybe $600 or so, actually goes to reduce the principal balance. But as you keep making payments, the outstanding principal slowly goes down.
Which means less interest is owed next month.
Exactly. So month by month, the interest portion of that fixed $7,796 upper payment shrinks, and the principal repayment portion grows. By the very end of the 30 years, almost the entire payment is principal.
That's clever. So the constant payment structure just automatically handles it.
Precisely. It's the engine behind millions of home loans in the U.S., often packaged up by entities like Fannie Mae and Freddie Mac into mortgage-backed securities.
And is there a formula for that constant payment? I remember seeing one in the CFA curriculum.
There is. It looks a bit intimidating, but the concept is straightforward. The periodic payment, let's call it A, is calculated as A, R principal, 1 plus R dash N. Here, R is the periodic interest rate, so if it's an annual rate quoted semi-annually, you divide by 2. Principal is the initial loan amount, and N is the total number of payment periods.
Okay, so let's try that with our BRWA bond example. $300 million, 3.2% annual coupon paid semi-annually for 5 years, if it were fully amortizing.
Right, so 3R would be 3.2% divided by 2, which is 1.6% or 0.016.
And N would be 5 years times 2 periods per year, so 10 periods.
Exactly. Plug those into the formula with the $300 million principal, and you get a constant semi-annual payment of roughly $32.70 million.
$32.70 million every 6 months, and that covers both interest and principal.
Yes. For that very first payment, the interest would be 1.6% of $300 million, which is $4.8 million.
Okay.
So the remaining part of that $32.70 million payment, which is $27.90 million, goes straight to reducing the principal. The new principal is now $272.1 million.
And the next payment's interest is calculated on that lower amount.
You got it. And the principal portion gets bigger. It's a self-correcting mechanism.
Fascinating. And are there similar examples in India, fully amortizing loans?
Oh, absolutely. It's very common in India, too. Think about housing loans from major players like HDFC, or maybe car loans from banks like SBI. Borrowers typically make what are called equated monthly installments, or EMIs.
EMIs, right. Heard that term.
It's the same principle as the U.S. mortgage. The EMI payment is constant throughout the loan. High interest component at the start gradually decreasing, while the principal component increases. It ensures the loan is fully paid off by the end of the term. Very standard practice.
Okay, so that's fully amortizing. What comes next?
Next up, we have partially amortizing bonds. Sometimes people call these balloon payment bonds. As the name suggests, they repay some of the principal over the bond's life, so they're not pure bullet bonds.
But they don't fully pay off the principal by maturity either.
Exactly. There's still a significant lump sum payment due at the very end. That final larger payment is called the balloon payment.
So it's a bit of a hybrid structure then. You get some principal back along the way, but still face a big chunk at maturity. Why would an issuer go for this?
It offers flexibility, really. Let's take our $300 million BRWA bond again. If it were partially amortizing, maybe, say, $150 million of the principal amortizes over the 10 semi-annual periods.
Okay, so you'd get regular payments covering interest plus some principal repayment.
Right. But then at maturity, that remaining $150 million is due all at once as the balloon payment. For the issuer, this structure lowers the periodic payments compared to a fully amortizing bond, which helps with cash flow management. They still reduce their debt over time, which looks good, but they push a large part of the repayment to the end.
Maybe hoping to refinance that balloon payment later.
Often, yes. Or maybe they expect larger cash flows towards the end of the bond's life. For investors, it offers a mix. You get some earlier cash flows, which reduces reinvestment risk slightly compared to a bullet, but you still get that larger final principal amount.
Interesting balance. How are the payments calculated? Is it complex?
Conceptually, you can think of it as combining a smaller, fully amortizing loan, for the part that amortizes, with a zero-coupon bond, for the balloon payment. The math gets a bit more involved, but the idea is to ensure the present value of all the payments equals the bond's initial price. You calculate the periodic payment needed to amortize the $150 million portion, and then the final payment would include that last periodic payment plus the $150 million balloon.
Got it. Okay, what other ways are there to handle principal repayment besides these direct amortization schedules?
Well, another important mechanism is the sinking fund. This isn't quite the same as amortization, but it achieves a similar goal: retiring principal before maturity. It's often used by governments, maybe municipalities, and some corporate issuers.
A sinking fund. Sounds like they're putting money aside.
That's essentially it. With a sinking fund provision, the issuer commits to periodically setting aside funds, maybe in an escrow account, specifically to retire a certain amount of the bond issue early. They might do this in a couple of ways. They could randomly select bonds to call or redeem early, like a lottery system for bondholders.
So you might get your principal back unexpectedly early.
Exactly. Or the issuer might use the funds to go into the open market and repurchase their own bonds if they're trading below a certain price.
So again, this reduces the issuer's total debt over time, which should lower credit risk for the remaining bondholders.
Right. Yes, definitely lowers credit risk, just like amortization. But
It increases reinvestment risk for those investors whose bonds get called or repurchased early.
you've got it. Same trade-off. A classic example in the U.S. might be a municipal bond issue, say. A city building a new bridge issues bonds with a sinking fund provision. They agree to retire maybe 5% of the bonds each year for the last 10 years of a 30-year issue. Helps manage their debt burdens systematically. In India, while maybe less common for standard corporate bonds, you might see sinking fund-like features in some large, long-term infrastructure project bonds to ensure gradual debt reduction.
Okay, one more structure you mentioned under amortization, these waterfall structures. Sounds intriguing. Where do we see those?
These are really common in the world of structured finance, particularly in asset-backed securities, ABS, and mortgage-backed securities, MBS. The waterfall name is quite descriptive. It dictates a very specific hierarchical order for how cash flows from the underlying assets like mortgages or auto loans are distributed, especially the principal payments, to different classes or tranches of bondholders.
A hierarchy. So some investors get paid before others, like a cascade.
Precisely. That's a great way to think about it. Interest payments are usually paid to all the different tranches proportionally, based on the amount outstanding. But the principal repayments, that's where the waterfall kicks in. All the principal collected from the underlying assets in a given period flows first to the most senior tranche. Let's call it Tranche A.
Okay, tranche A gets filled up first.
Exactly. Only after Tranche A has received its full principal entitlement does the principal then start flowing down to the next tranche in line, say Tranche B, and then Tranche C, and so on.
So the lower tranches, the junior ones, only get principal after the senior ones are fully paid.
That's right. And this structure has a huge impact on risk.
How so?
Well, if there are any losses or shortfalls in the cash coming from the underlying assets, maybe homeowners default on their mortgages, those losses are absorbed first by the most junior tranche.
Ah, so the junior tranches act like a buffer, protecting the senior ones.
Exactly. Tranche A has the lowest credit risk because it's protected by all the tranches below it. Tranche B is riskier than A, but safer than C. The most junior tranche, sometimes called the equity tranche, bears the first loss.
So why would anyone buy those junior tranches if they take the first hit?
The potential return. Because they're taking on much more risk, these junior tranches offer significantly higher yields. They might attract investors like hedge funds or specialized credit funds who have a higher risk appetite and are looking for those enhanced returns. It's all about segmenting the risk to appeal to different investor types.
Makes sense. Risk and reward. Can you give examples?
Sure. In the U.S. MBS market, agencies like Fannie Mae and Freddie Mac issue securities backed by pools of mortgages. These almost always use waterfall structures. The senior tranches get AAA ratings because of that protection, while the subordinate tranches have lower ratings but offer higher yields. In India, the securitization market is growing, especially for things like housing loans from HDFC or vehicle loans. They also use waterfall structures. An Indian ABS deal might have a senior tranche rated highly by local agencies like CRISIL or ICRA, while the junior tranches offer higher coupons but carry lower ratings, reflecting that first loss risk.
Okay, that covers a lot on how principal gets repaid. Let's switch gears now. What about the interest side? We've mostly talked about fixed coupons, but what if the interest payments themselves can change?
Right. In a world of fluctuating interest rates, fixed coupons aren't always ideal for everyone. This brings us to variable interest debt, often called floating rate instruments. These are really crucial tools for managing interest rate risk. Most bank loans and a huge number of bonds called floating rate notes, or FRNs, fall into this category. Their coupon isn't fixed. Instead, it's typically set based on some market reference rate, or MRR, plus a fixed credit spread.
MRR plus spread. So the coupon floats with the market. How does that work in practice? And does it mean I'm protected if rates go up?
That's the core idea. The formula is simple. FRN coupon rate, market reference rate, plus quoted spread. Let's use the Antylis AG FRN example from the curriculum. It's a euro-denominated note, EUR 250 million, and the coupon is MRR plus 250 basis points paid quarterly.
Okay, 2.5% spread.
Right. So if the relevant MRR for a particular quarter is, say, 0.50%, then the coupon rate for that quarter is 0.50% plus 2.50%, which equals 3.00% on an annualized basis.
And the actual cash payment is based on that 3.00%.
Exactly. You'd calculate the quarterly interest, 3.00%. You are $250 million. 4. If the MRR changes next quarter, say it goes up to 1.00%, then the coupon rate automatically resets to 1.00% plus 2.50%, and your interest payment goes up.
So this definitely helps investors when rates are rising, right? Protects them from that interest rate risk.
It absolutely does. As market rates rise, your coupon income rises too, which helps maintain the bond's value closer to par compared to a fixed-rate bond whose price would fall significantly.
But what about the other big risk, credit risk? Does the floating rate help with that?
Good question. And the answer is generally no. This is a really important point. FRNs are great at mitigating interest rate risk, but they do not protect against credit risk.
So if the issuer's financial health worsens,
Investors will still demand a higher yield to compensate for that increased risk of default, regardless of where the MRR is. That higher required yield will push the price of the FRN down, potentially well below par. So you might be getting a higher coupon because the MRR went up, but your bond could still lose significant value if the market gets worried about the issuer's ability to pay.
okay, critical distinction. Interest rate risk protection, yes. Credit risk protection, no. Are there other ways coupons can change besides just tracking an MRR?
Yes, absolutely. Financial engineers have come up with several variations. One type is step-up bonds. With these, the coupon rate isn't tied to an MRR, but it's scheduled to increase or step up by specific amounts on predetermined future dates.
So it's a fixed schedule of increases.
Exactly. For example, a bond might pay 4% for the first 5 years, then step up to 5% for the next 5, and maybe 6% after that.
Why do that?
Well, for investors, it offers some protection against generally rising rates over the long term. For issuers, it might make the bond more attractive initially, and it can also act as an incentive for them to call the bond before a big step-up occurs if market rates haven't risen as much as the step-up implies. Then there are credit-linked notes. These are really interesting. Here, the coupon rate, or more often the spread over the MRR, is explicitly linked to the issuer's credit quality.
So the coupon changes if the company gets riskier or safer.
Precisely. It's often tied to specific financial metrics, like a leverage ratio or an interest coverage ratio. The Antylis AG example we mentioned earlier actually had this feature in its leveraged loan counterpart. The credit spread wasn't fixed at 250 BPs. It adjusted based on their total leverage ratio, TLR. If leverage went up, riskier, the spread increased, maybe to the 325 BPs. If leverage went down, safer, the spread decreased, maybe to 250 BPs.
That gives investors comfort, right? They get paid more if the risk increases.
Exactly. It provides direct compensation for changes in credit risk. It also allows companies that might be perceived as slightly riskier to access financing, possibly on better terms initially, because they're offering this built-in protection. Another feature you sometimes see, especially with issuers who might be tight on cash, is a payment in kind, or PIK feature.
Payment in kind. What does that mean? They pay you with goods.
No, not usually goods. It means the issuer has the option, under certain conditions, to pay the periodic interest not with cash, but by increasing the principal amount of the bond or loan.
So they just add the interest owed to the total amount they owe me.
Essentially, yes. Instead of sending you a cash coupon, they just issue you more bonds or increase the face value of your existing bond.
Why would they do that?
Really?
Why would I accept it?
Issuers do it to conserve cash, maybe during a difficult period or while funding a big project before it generates revenue. Investors accept it because PIK bonds typically offer a significantly higher interest rate to compensate for the added risk you're getting paid later, and your total exposure to the issuer is increasing. It's usually seen with lower-rated, maybe private equity-backed companies.
Okay, that makes sense. Higher risk, higher potential reward. Now, I've been hearing a lot about sustainability in finance. Are there bonds where the coupon is tied to, like, environmental goals?
Absolutely. This is a rapidly growing and really fascinating area. These are called sustainability-linked bonds, SLBs. With SLBs, the coupon rate is directly linked to the issuer achieving specific, predefined environmental, social, and governance ESG targets.
Really? So if they meet their green target, the coupon might go down, or if they miss it, it goes up?
Often it's structured as a penalty. The coupon steps up if they fail to meet the target by a certain date. The example from the Public Power Corporation, PPC, in Greece, is perfect. They issued bonds where the coupon margin would increase by 50 basis points if they didn't hit their target of reducing CO2 emissions by 40% by December 2022.
So it gives the company a direct financial incentive to meet its sustainability promises.
Exactly. It aligns financial performance with ESG goals. And it also attracts a growing pool of investors who specifically want to support sustainable practices, potentially broadening the issuer's investor base. It's a strategic tool for both financing and demonstrating corporate responsibility.
Very interesting development. Okay, one more area related to changing economic conditions, inflation. With all the recent concerns about rising prices, are there bonds designed specifically to protect investors from inflation?
Yes, definitely. And they become quite popular for that very reason. These are index-linked bonds, often just called linkers. The core idea is to tie the bond's cash flows, either the principal, the interest, or sometimes both, to a specific price index, most commonly a consumer price index, CPI.
So if the CPI goes up, meaning inflation is rising, my payments from the bond go up too. Is that the goal?
That's precisely the goal. Think about a standard fixed coupon bond. If inflation spikes, the purchasing power of those fixed coupon payments gets eroded. You're getting the same number of dollars, but they buy less.
Right. Your real return suffers.
Exactly. Index-linked bonds aim to protect the real interest rate, the return you get after accounting for inflation. They adjust the cash flows upwards to try and preserve the purchasing power of your investment.
How do they do that? Are there different ways?
Yes, there are two main types. The most common type globally is capital index bonds. With these, the bond's principal amount is adjusted up or down based on changes in the chosen inflation index, like the CPI.
The actual principal value changes.
Yes. And then the fixed coupon rate, stated in the bond contract, is applied to this inflation-adjusted principal amount.
So if the principal grows due to inflation and the coupon rate is applied to that larger principal, my coupon payments also get bigger.
You got it. Both the principal you get back at maturity, potentially, and the periodic coupon payments adjust to keep pace with inflation.
The main example of this in the U.S. is TPS, right? Treasury Inflation Protected Securities.
Exactly. TPS are the classic example of capital index bonds. If the CPI goes up, the principal value of your TPS increases. That increased principal then leads to larger semi-annual coupon payments. And there's a nice feature. Even if there's deflation and the adjusted principal falls below the original par value, at maturity, you typically receive the greater the inflation-adjusted principal or the original par value, so you have protection against deflation too.
That's a good safety net. Can you see how the numbers work, like with that TPS example in the text?
Sure. Let's say you have a $115 million TPS bond, 1% annual coupon paid semi-annually. And over 6 months, the relevant CPI index goes from 265.00 to 267.25.
Okay.
First, you calculate the inflation adjustment percentage, 267.25, 265.000, 265.90, which is about 0.849%.
Right.
You apply that to the original principal. $115 million, 1 plus 0.00849, gives you a new inflation-adjusted principal of about $115,976,350.
Yep. Now, your next semi-annual coupon payment is based on the original 1% annual rate, but applied to this new higher principal. So 1%, $115,976,350, gives you a coupon payment of about $579,882.
It's higher than the coupon would have been on the original $115 million principal.
Exactly. It shows how both the principal and income stream are protected. India has also issued similar inflation-indexed bonds linked to its own CPI, although the market isn't as deep as the U.S. TPS market.
Okay, so that's capital index. What's the other type? The other main type is interest-indexed bonds. With these, only the coupon payments are adjusted for inflation. The principal amount paid back at maturity remains fixed at the original par value.
So the principal doesn't change, just the coupons.
Correct. You can almost think of these as floating rate notes, where the reference rate isn't a market interest rate, but the rate of inflation itself. They protect your income stream's purchasing power, but not necessarily the real value of the principal you get back at the end. They're less common than capital index bonds.
Got it. Okay, final category here in cash flow structures. What about bonds that don't pay regular coupons at all, or maybe delay them? That seems quite different.
They are definitely distinct and serve specific purposes. First, you have zero coupon bonds. As the name implies, these bonds pay absolutely no periodic interest throughout their entire life. None.
No coupons at all. So how do you make money?
They're sold at a significant discount to their face value, or par value. Your entire return comes from the difference between the discounted price you pay up front and the full face value you receive back at maturity.
So the interest effectively accrues over time, but isn't paid out until the very end.
Exactly. It's like the interest is automatically reinvested within the bond at the original yield to maturity.
What's the advantage of that? Why buy or issue these?
For investors, they are great for matching a specific future liability. If you know you need exactly $10,000 in 5 years for, say, tuition, you can buy a zero coupon bond maturing in 5 years with a face value of $10,000. You know exactly what you'll get back, and there's absolutely no reinvestment risk on coupons because there aren't any.
Eliminates reinvestment risk completely.
Completely. For issuers, it means no cash outflows for interest payments during the bond's life, which can be helpful if they're funding a long-term project that won't generate revenue for a while. They're very common for short-term government debt.
Like T-bills.
Exactly. U.S. Treasury bills are prime examples, sold at a discount, mature at par. The Indian government also issues Treasury bills, T-bills, through the RBI on the same principle, discount issuance, redemption at par. They're fundamental tools for short-term government funding in both countries.
Okay. And the other type you mentioned was deferred coupons.
Right, deferred coupon bonds. These are a bit of a hybrid. They pay no interest for an initial period, maybe the first few years after issuance.
So zero coupon initially.
Yes, but then, after that deferral period, they start paying coupons, often at a higher rate than a comparable standard bond, for the remainder of their term until maturity.
Why the delay? Again, conserving cash for the issuer.
Usually, yes. An issuer might use this structure if they're, say, a startup company with limited initial cash flow, or maybe financing a big infrastructure project that takes years to complete and start generating income. They push the interest burden further out.
And investors, what's the catch?
Well, you forego income in the early years. To compensate for that, these bonds are typically priced at a discount to par, similar to zeros, and the coupon rate in the later years is usually higher. They appeal to investors who don't need immediate income and are looking for potentially higher total returns over the full life of the bond.
Okay, fascinating stuff on all the ways cash flows can be structured, but bonds can get even more interesting, right? You mentioned these contingency provisions. What exactly are those? Sounds like escape hatches or special features.
That's a good way to think about them. A contingency provision is basically a clause baked into the bond contract that allows for a specific action to happen if a certain event or condition occurs. In the bond world, we often call these embedded options because they give either the issuer or the bondholder the right, but
crucially, not the obligation to take some action in the future.
An option embedded within the bond itself.
Exactly.
Yeah.
And you can't strip it out and trade it separately as part of the package deal. These options can significantly affect the bond's behavior and its value.
How do we figure out their value?
Usually by comparing the price of the bond with the option to an otherwise identical bond from the same issuer without the option. The price difference gives you a sense of the option's market value. The most common types you'll encounter are callable bonds, putable bonds, and convertible bonds.
Okay, let's start with callable bonds. This sounds like the issuer can call the bond back, buy it back early.
That's exactly what it means. A call provision gives the issuer the right to redeem the bond, pay back the principal, before the scheduled maturity date.
Why would they want to do that? Isn't issuing debt a long-term plan?
Primarily, it's about refinancing flexibility, especially if interest rates fall.
Ah, okay. So if they issued bonds when rates were high?
Say it's 6%, and then market rates drop to 3%, they'd love to get rid of that expensive 6% debt and replace it with new debt at 3%. The call provision allows them to do just that. They call the old bonds back, usually paying a specified call price, and then issue new bonds at the lower prevailing rate. Saves them a bundle on interest costs.
So it's a big benefit for the issuer, letting them take advantage of falling rates.
Absolutely. It gives them strategic flexibility to manage their borrowing costs.
What does this mean for the investor, though? Sounds like a risk.
It definitely is. We call it call risk. There are two main aspects. First, your maturity is uncertain. You might have planned on holding that 6% bond for 10 years. But if rates fall, the issuer might call it back after only, say, 3 years.
So your income stream gets cut short.
Yes. And you get your principal back earlier than expected, forcing you into that reinvestment risk we talked about, having to reinvest at the now lower market rates. The second part of call risk is limited price appreciation. If rates fall, a normal bond's price goes up significantly. But a callable bond's price won't typically rise much above its call price because investors know it's likely to be called away if it gets too valuable. The call price acts like a ceiling on the bond's potential gains.
Okay, so uncertain maturity and capped upside. Investors must demand something extra for taking on that call risk, right?
They absolutely do. Callable bonds have to offer a higher yield, a higher coupon rate, compared to an otherwise identical non-callable bond from the same issuer. That extra yield is the compensation for the call risk the investor's bearing.
How do these calls actually work? Is there a specific process?
Yes, the bond indenture, the legal contract, specifies the details. There's usually a call protection period right after issuance, maybe the first few years, where the issuer cannot call the bond. This gives investors some initial certainty.
Okay, a lockout period.
Right. Then after that, the call period begins. The contract will specify the call dates, when it can be called, and the call price, what the issuer pays. Often, the call price starts above par value, for example, 103% of par, and declines gradually towards par as the bond gets closer to maturity.
Like that Vivu Inc. example, 6.5% coupon, but callable after 3 years, starting at 103.25, then stepping down.
Exactly that kind of schedule. It gives the issuer flexibility, but also defines the terms clearly for investors.
Now, I saw a mention of a make-whole call. Is that different? It sounds expensive for the issuer.
It is different, and yes, it's designed to be expensive. With a make-whole call, the issuer can call the bond back, often at any time, but they have to pay a call price calculated to make the investor whole.
Make them whole. How?
By paying a price equal to the present value of all the bond's remaining future cash flows, coupons and principal, discounted back at a very low rate, typically a government bond yield of similar maturity plus a very small spread.
So they basically have to pay a price that reflects the value of the bond if rates had fallen?
Pretty much. It means the investor gets compensated for the lost higher coupon payments. Because this calculation usually results in a very high call price, issuers rarely exercise make-whole calls just for refinancing purposes. They exist more as a legal mechanism to allow redemption under unusual circumstances, like a merger or acquisition, without being overly punitive compared to the fixed-price call. They offer flexibility, but have little economic impact on yield calculations usually.
Okay, so if issuers get call options, do investors get the flip side? Can they force the issuer to buy the bond back early?
Yes, they can. That's exactly what a putable bond is. A put provision gives the bondholder the right to sell the bond back to the issuer at a predetermined price, usually par value, on specified dates before maturity.
So it's the investor's option this time. When would they want to use that?
Primarily if interest rates rise after the bond is issued.
Ah, the opposite scenario to the callable bond.
Exactly. If rates rise, the market price of existing fixed-rate bonds falls. If you hold a putable bond and its price falls below the put price, say below par, you can exercise your put option.
So you sell it back to the issuer at par, even if the market price is lower.
Precisely. You get par value back, avoiding a loss, and you can then take that cash and reinvest it at the new, higher market rates. It effectively puts a floor under the bond's price, protecting the investor from downside risk due to rising rates.
That sounds like a great feature for investors.
It is, and because it's so beneficial to investors, putable bonds are typically priced at a premium compared to non-putable bonds, meaning they offer a lower yield. The issuer is essentially paying for the investor's option by accepting a lower return on their borrowing.
Makes sense. So if I hold a putable bond from, say, Apple and rates shoot up, I can just put it back to them at par.
If the terms allow it on that specific date, yes, it's a valuable form of protection. You might see put features on some corporate bonds in the US or India, especially if the issuer wants to make the bond more appealing, perhaps because it has a very long maturity or some other feature investors might be wary of.
Okay, callable, putable. Now for the really different one, convertible bonds. These seem to blur the lines between debt and equity. What's the story here?
You're right, they are a hybrid instrument. A convertible bond gives the bondholder the right to exchange their bond for a specified number of shares of the issuing company's common stock.
So I can trade my bond for stock. Why would I do that?
For the upside potential. If the company's stock price performs really well and goes up significantly, converting your bond into shares might be worth much more than just holding the bond to maturity or selling it. It allows debt investors to participate in the equity upside of the company.
So it's like having a bond with a stock option attached.
Kind of, yes. You get the relative safety of a bond, a regular coupon payments, though often lower than a standard bond, and a claim on assets senior to equity if things go wrong, but you also get that potential equity kick if the company does well.
And why do companies issue them? What's in it for the issuer?
Two main benefits. First, they can issue debt with a lower coupon rate than a comparable non-convertible bond. Investors are willing to accept that lower yield in exchange for the valuable conversion option. This saves the company cash on interest payments.
Lower interest cost, that's attractive.
Very. Second, if the bonds are eventually converted, it means the debt disappears from their balance sheet and is replaced by equity. This can improve the company's leverage ratios and credit profile, although it also dilutes existing shareholders. It's often used by younger, growth-oriented companies whose stock price might be expected to rise.
Let's look at that ZTG biotech example from Italy. 1.25% coupon, 5-year convertible notes. That coupon seems really low.
It is low, likely much lower than ZTG would pay on a straight bond. Investors accept 1.25% because they also get the option to convert each bond into ZTGB common shares at a conversion price of EUR 42.00.
Let's say the stock is currently trading at EUR 28.00.
So conversion isn't attractive right now.
Not yet, but investors are betting it might be in the future. We need to understand two key terms here: conversion ratio and conversion value.
Okay.
The conversion ratio is how many shares you get for each bond. You calculate it by dividing the bond's par value, let's assume EUR 1,000, by the conversion price. So EUR 1,000, EUR 42.000, approximately 23.81 shares per bond.
Got it. 23.81 shares per bond.
Now, the conversion value is what those shares would be worth today if you convert it. It's the conversion ratio times the current market price of the stock. So 23.81 shares, EUR 28.00 share, EUR 666.68.
So the bond is probably trading for more than EUR 666.68 right now.
Almost certainly. It will trade based on its value as a bond, its bond floor, plus the value of that embedded conversion option. If ZTG's stock price were to soar, say to EUR 50.00, then the conversion value would become 23.81 EUR 50.00, since EUR 1,190.50.
Which is higher than the par value.
Exactly. At that point, the convertible bond's price would closely track its conversion value, behaving much more like the stock than a bond.
So its value depends heavily on the underlying stock price, especially once the stock price rises.
Very much so. It offers that asymmetric payoff profile investors like bond-like downside protection, to a degree, and equity-like upside potential.
Are there other ways debt gets linked to equity?
Yes, a couple of others are worth knowing. One is warrants. Sometimes bonds are issued with warrants attached. A warrant gives the holder the right to buy a certain number of shares of the issuer's stock at a specified price, the exercise price, before an expiration date.
How is that different from a convertible bond?
Key difference. Warrants are often detachable, meaning they can be separated from the bond and traded on their own. Also, when you exercise a warrant, you pay cash to buy the stock.
You don't exchange the bond itself. Issuers often use them as sweeteners or equity kickers to make a regular bond issue more attractive, maybe allowing them to pay a slightly lower coupon.
Okay, so warrants are separate options, often detachable. What else?
The other important one, especially in the banking sector, is contingent convertible bonds, usually known as COCOs. These are mainly issued by banks, particularly in Europe, often to meet regulatory capital requirements. They are convertible, but with a crucial and sometimes painful twist.
A twist. What is it?
They convert into equity automatically if a specific trigger event occurs, typically when the bank gets into financial trouble. For example, if the bank's core capital ratio falls below a predetermined regulatory minimum.
Wait, so they convert to equity when the bank is weak, not when the stock is strong. That sounds like the opposite of a regular convertible.
It is the opposite in terms of the trigger. Regular convertibles convert on the upside. COCOs convert on the downside.
Why would an investor want that? You're forced to become an equity holder in a struggling bank just when things look bad.
It's definitely a higher risk proposition for the investor. The primary purpose of COCOs is regulatory. They're designed to automatically bolster a bank's capital and absorb losses before it fails, potentially avoiding taxpayer bailouts and limiting systemic risk.
So it helps the bank recapitalize itself under stress.
Exactly. Because investors are taking on this significant downside risk, the risk of their debt turning into potentially worthless equity. COCOs have to offer a much higher yield than other bank debt to attract buyers. They're complex instruments, usually held by sophisticated institutional investors who understand the triggers and risks involved.
Okay, we've covered a huge amount on cash flows and those embedded options, but bonds don't exist in a vacuum, right? There's this whole layer of legal stuff, regulations, taxes. How does all that affect fixed income?
You're absolutely right. These factors are critical and can significantly influence how bonds are structured, where they're sold, who buys them, and ultimately the net return an investor receives. These considerations primarily help classify bonds based on jurisdiction and impact everything from disclosure to trading to tax treatment.
So let's break down those classifications first. How are bonds categorized based on where they're issued and by whom?
Okay, we usually think in terms of three main categories plus a variation. First, the simplest, domestic bonds. These are issued in a particular country by an issuer incorporated in that same country and denominated in that country's own currency, fully local.
Like Apple issuing dollar bonds in the US, or Reliance Industries issuing rupee bonds in India.
Exactly. Classic domestic bonds. They fall squarely under the laws and regulations of that single country, the SEC in the US, SEBI in India, for instance.
Makes sense. What's next?
Next are foreign bonds. Here, the issuer is from another country, but they issue bonds in a domestic market, denominated in that domestic market's currency.
Okay, so issuer is foreign, but the market and currency are local where it's issued, like that Canadian company, Digistripe Logistics, issuing Eurobonds in Germany you mentioned.
Perfect example. A Canadian company issuing Eurobonds subject to German regulations. These often get nicknames. Foreign bonds issued in the U.S. are Yankee bonds. In Japan, they're samurai bonds. In the U.K., bulldog bonds.
Why issue a foreign bond?
Maybe the Canadian company has big operations in Europe and wants euro funding to match its revenues. Or maybe they think they can get better terms or access a different investor base in Germany than they could at home or in the Eurobond market.
Eurobond market, that's the third category. How is that different from a foreign bond?
Yes, Eurobonds. The key difference is that Eurobonds are issued outside the jurisdiction and regulatory framework of any single country. They're issued internationally. They are typically denominated in a currency different from the country where they are issued, like a US dollar bond issued in London or Singapore, although they can be in the issuer's home currency if it's a major international currency, like a US company issuing a US dollar Eurobond.
So the defining feature is being outside a single country's rules. Less regulation.
Generally, yes. They tend to have fewer listing and disclosure requirements compared to domestic or foreign bonds, which can make them quicker and sometimes cheaper to issue. This makes them very popular for multinational corporations and governments tapping global capital markets.
So that Romanian government bond issued in euros, but outside Romania, possibly listed in Luxembourg or London, that's a Eurobond.
Exactly. Or an Indian company like Infosys issuing US dollar bonds not in the US market, which would be a Yankee foreign bond, but internationally. Maybe targeting investors in Asia and Europe, that would be a Eurobond. Historically, many Eurobonds were bearer bonds, meaning whoever held the physical certificate owned it, offering anonymity. But now most are registered, just like domestic bonds.
What about U.S. investors buying these? Are there restrictions?
Yes. Generally, newly issued Eurobonds cannot be sold directly to U.S. investors, particularly retail investors, during the initial distribution period, because they don't go through the full SEC registration process required for public offerings in the U.S. However, they can often be sold to large, sophisticated U.S. institutional investors through private placements under a rule called Rule 144A.
Rule 144A, so big players can buy them, but not the general public initially.
Right. It creates a separate market for these qualified institutional buyers, QIDs, in the U.S.
And how do things like Sukuk fit in, that UK government Islamic bond?
That UK Sukuk is a great example of market adaptation. It was structured to comply with Sharia law, no interest profit sharing instead, and listed in London, but it followed Eurobond principles in terms of its international offering and regulatory approach. It shows how the Eurobond market framework can accommodate diverse structures to meet specific investor demands globally.
Okay, domestic, foreign, Eurobonds. Is there a fourth type?
Yes, a variation called global bonds. These are bonds that are issued simultaneously in the Eurobond market and in one or more domestic bond markets.
So best of both worlds, maximum distribution.
Exactly. It ensures the widest possible reach, accessing investors in the international Eurobond space and specific large domestic markets like the U.S. or Japan all at the same time. Big issuers like the World Bank often use global bonds to maximize demand and potentially achieve better pricing.
Okay, those classifications make sense. Now, let's talk taxes. This always seems complicated, but crucial for the actual return you keep.
Absolutely critical. Tax treatment can vary enormously depending on the type of bond, the issuer, the investor's location, and the specific rules of that jurisdiction. The first basic distinction is between interest income and capital gains.
Right.
Bond interest payments are typically taxed as ordinary income in most countries, usually at the same rate as your salary or other regular income. However, if you sell a bond before maturity for a price different from what you paid, you have a capital gain or loss. Tax rules for capital gains often differ from ordinary income tax rates. They might be lower, especially for long-term gains, if you held the bond for more than a year, for example, but this varies hugely. Some countries don't even have separate capital gains taxes.
Can you give specific examples? Like, for government bonds in the U.S. and India, tax advantages seem common there.
Sure. In the U.S., interest from Treasury bonds is subject to federal income tax, but is completely exempt from state and local income taxes. That's a nice benefit, especially if you live in a high-tax state.
Okay, federal tax, but no state local. What about municipal bonds?
Municipal bonds, issued by states, cities, etc., are even better, potentially. Their interest is often exempt from federal income tax, and if you're a resident of the state that issued the bond, it's usually exempt from that state's income tax, too. This double tax exemption can make their yields highly attractive on an after-tax basis compared to taxable bonds.
Wow, that's a significant advantage. What about India?
In India, interest income from both government securities, GSECs, and corporate bonds is generally taxed as ordinary income, added to your total income, and taxed at your applicable slab rate. For capital gains on bonds in India, the rules depend on the holding period and type of bond. Gains on listed bonds held for more than 12 months might qualify as long-term capital gains, potentially taxed at a lower rate, sometimes with indexation benefits to account for inflation, compared to short-term gains, which are typically taxed as ordinary income. The rules for unlisted bonds, or specific types like zero-coupon bonds, can differ. Tax laws change, so specifics always need checking.
Okay, you mentioned zero coupon bonds. How is the interest on those taxed if you don't receive cash? And what about bonds issued at a discount generally?
That's a really important area where tax rules differ the treatment of original issue discount,
Sure.
OID. OID is the difference between a bond's stated redemption price at maturity, usually par, and its lowered issue price.
So it's like built-in interest.
Exactly. Now, how it's taxed varies. In the U.S., the tax code generally requires investors to recognize a portion of that OID as taxable ordinary income each year over the bond's life, even though they haven't received any cash yet.
Phantom income. UK tax on income you haven't actually received.
Yes, it can create cash flow issues if you're not prepared. The upside is that when the bond matures, the OID portion isn't taxed again as a capital gain because you've already paid ordinary income tax on it annually. However, in some other jurisdictions, the rules might be different. A country might not have specific OID rules, or they might treat the entire discount as a capital gain only when the bond matures or is sold.
So in that case, no tax until the end, but then maybe a big capital gains tax bill.
Potentially, yes.
Yeah.
The timing and character, ordinary income versus capital gain, of the income recognition can dramatically impact an investor's after-tax return and their tax planning. It's crucial to know the rules in your specific jurisdiction.
What about the opposite bonds, bought at a premium, above par value? Any tax implications there?
Yes, often there are. If you pay more than par for a bond, say 105, that extra 5 is a premium. Some jurisdictions allow you to amortize that premium over the remaining life of the bond. This means you can deduct a portion of the premium each year from the bond's taxable interest income, effectively reducing your tax bill slightly each year.
So it lowers your taxable coupon income.
Right. Alternatively, some rules might not allow annual amortization but let you claim the entire premium as a capital loss when the bond matures, since you only get par back, but you paid more than par. Again, the specific rules vary, offering potential tax planning opportunities. Hashtag outro.
Wow, that really covers the landscape. That wraps up our deep dive into Module O2, Fixed Income Cash Flows and Types from the CFA Level I 2025 Fixed Income Volume 6 course. We've gone from the simple rhythm of bullet bonds through the complexities of amortization on waterfalls into the dynamic world of floating rates, convertibles, linkers, and those crucial embedded options, and finally overlaying it all with the legal, regulatory, and tax frameworks.
We really have. We've seen how these different cash flow structures are designed to allocate risk and return in very specific ways. We've unpacked how contingency provisions, calls, puts, convertibility provide strategic flexibility for both issuers and investors. And we've touched on how that whole global web of jurisdictions, regulations, and tax rules shapes everything from how bonds are issued to how much an investor actually gets to keep. It's definitely not just about the coupon rate.
It's truly fascinating, isn't it? Seeing how these intricate financial designs allow for such precise risk management and tailoring to specific needs in different markets all over the world. It really feels like financial engineering at its most practical.
It absolutely is. And understanding these nuances, why a bond is structured the way it is, what the embedded options mean, how taxes impact the outcome, that's fundamental. It's what you need to make informed investment decisions and really navigate the complexities of global debt markets. It's key for the CFA program and beyond.
So what's next on our CFA journey?
Next up is Module O3, Fixed Income Issuance and Trading. We'll explore how these instruments we've just dissected actually get created and brought to market, the primary market process, and then how they're bought and sold between investors afterwards, the secondary market.
So taking what we learned today and seeing the how and where they trade, as everyone prepares for that, maybe think about this. How do the features we discussed today, the call options, the floating rates, the tax treatments actually influence the demand for these bonds when they're first issued? Who lines up to buy them and why? Something to ponder. Until then, keep digging. We'll see you for the next deep dive.
Wait, let's unpack this. Welcome to CFA Level I 2025 Fixed Income, Volume 6. Today, we're diving into Module O3, Fixed Income Issuance and Trading. This is where we go behind the scenes, really getting into the nuts and bolts of how bonds enter the market, move between investors, and essentially fuel the global economy. It's a crucial deep dive, into the practical mechanics of these vital markets.
Indeed. What's truly foundational here is that grasping the nuances of bond issuance and trading is absolutely essential for understanding how these markets operate really at a granular level. We'll explore the diverse ways bonds are categorized, introduce the key players who make these markets tick, and uncover the vital role of benchmarks.
Benchmarks, right.
Think of it as mapping the intricate circulatory system of the global economy, where bonds are the lifeblood, facilitating everything from, say, government spending on infrastructure to corporate expansion into new territories. Our mission in this deep dive is to give you not just an overview, but a comprehensive, interconnected understanding of these core processes.
That's a powerful way to put it. So if we're mapping the circulatory system, we've defined the major organs and the lifeblood. Now, just a little peek ahead. After we master Module O3, we'll move on to Module O4. That's where we'll narrow our focus specifically to fixed income markets for corporate issuers. So get ready to build on this foundational knowledge in a very targeted way.
So when we talk about bonds, they're definitely not all the same. Something that always strikes me about bonds, especially compared to equities, is just the sheer variety. We typically categorize them along 3 key dimensions: the type of issuer, their credit quality, and how long until they mature. Think of it like a highly sophisticated, multi-layered filing system for trillions of dollars of debt, where each category serves a distinct purpose for both the entity borrowing the money and the investor lending it.
Precisely. The issuer type, often referred to as the sector, defines who is borrowing. This could range from a sovereign government, like the U.S. Treasury or the Indian government, to a sub-sovereign entity, like a state or municipality, a corporation, or even a securitized entity
Yeah.
that pools assets like mortgages or auto loans.
Right, those pooled assets.
Then credit quality, on the other hand, speaks directly to the borrower's capacity and willingness to repay their debt obligations. This heavily influences the risk and the expected return an investor demands. And then there's time to maturity, which is fairly straightforward. Short-term bonds typically mature in less than 1 year. Intermediate terms say 1 to 10 years, and long-term bonds mature in greater than 10 years.
Simple enough?
But sometimes we also look at additional classifications. Things like the bond's geography of issuance, the currency it's denominated in, or even its environmental, social, and governance, or ESG characteristics. These added layers help refine investment strategies and risk assessment for fund managers and individual investors alike. For instance, a forward-thinking Indian investor might specifically seek out, say, green bonds issued by a domestic company, denominated in rupees, not just for financial returns, but also to meet their ethical and sustainable investment objectives.
ESG, yeah, that's becoming huge. But here's where it gets really interesting. With stocks, a company usually has one, maybe two types of shares. Outstanding common stock and perhaps preferred, simple. But with bonds, a single issuer can have dozens, even hundreds of different fixed income instruments outstanding. It's a completely different landscape compared to equities. Why? Why such an explosion of options on the debt side?
That's an excellent observation, and it highlights a critical difference. What's truly insightful here is that this isn't just about borrowing money, it's about the issuer acting as a master financial strategist, really, orchestrating a complex array of debt instruments, each finely tuned to a particular purpose.
This is strategist, okay.
Take a global corporate, like Apple Inc., for example. At the end of 2021, they had over 80 fixed income instruments outstanding, but just one common stock. Similarly, in India, a major conglomerate like Reliance Industries might issue short-term commercial paper, essentially very short-term unsecured promissory notes, right, for immediate working capital needs. Simultaneously, they could have various tranches of non-convertible debentures, or NCDs, with different maturities and coupon structures, specifically designed to finance long-term capital projects, like a new refinery or maybe a telecom network expansion.
Tailored financing.
Exactly. And to access global liquidity and diversify their funding sources, they might even issue bonds denominated in US dollars through their international subsidiaries. This raises an important question. Why such a variety? It's about optimizing their capital structure, attracting a broad investor base with vastly different risk appetites and liquidity preferences, and managing currency exposure across their global operations. This tailored approach allows issuers to minimize their cost of debt while meeting incredibly diverse financing needs simultaneously.
That's a fantastic point. It's like they're building a custom financial puzzle, piece by piece. Let's visualize this. If you look at Exhibit 1 in the materials, you see a spectrum. From short-term to long-term maturities on one axis and from default risk-free to high-yield credit quality on the other. This chart really shows how varied the bond world is, mapping out where different types of bonds fit in terms of their key characteristics.
Yeah.
It's a great way to understand the lay of the land.
Indeed. At the default risk-free and short-term end of that spectrum, you typically find highly liquid government-backed instruments. For instance, in the U.S., these are Treasury bills, or T-bills, which mature in less than a year, and are considered the purest form of short-term risk-free investment. In India, you'd find similar government T-bills, which are part of the broader government securities, or GSECs market.
GSACs, right.
As we move to intermediate and long-term along that default risk-free spectrum, we encounter U.S. Treasury notes and bonds, or longer-duration Indian GSECs. These sovereign bonds are considered the fundamental benchmarks for credit risk within their respective economies. Moving up the credit risk ladder, but still firmly within the investment grade category, which is considered high quality, you'd find unsecured corporate bonds issued by financially strong, well-established companies.
Like the big names.
Exactly. A stable U.S. company like Apple or an Indian giant like Infosys, with their robust cash flows and strong balance sheets, would issue these. Then there's the world of asset-backed securities, ABS, and mortgage-backed securities, MBS. These are bonds backed by a pool of assets, where the cash flows from those assets are passed through to the bondholders. In the U.S., MBS are often backed by housing loans from government-sponsored enterprises like Fannie Mae or Freddie Mac. In India, you see similar securitization structures, such as HDFC's housing loan securitization, where individual home loans are pooled and transformed into marketable securities.
Okay, so pooling loan.
Right. And finally, for the high yield category, which implies higher credit risk for potentially higher returns, you might see leveraged loans or secured corporate bonds. These are typically from companies with less stable cash flows. Perhaps a fast-growing but less profitable tech startup in the U.S. that needs to secure its debt with collateral. Or maybe a newer industrial firm in India that lenders view as higher risk due to its less established operating history. This spectrum truly highlights that there's a fixed income instrument for nearly every risk-return profile and financing need imaginable.
So we've mapped out this incredible spectrum of bonds and the entities that issue them, always optimizing their funding, it seems. But every issuance needs a buyer. So let's flip the coin and consider the investors, those institutions and individuals who are actively seeking out these instruments. How do they navigate this complex landscape, and what drives their choices along those same credit and maturity spectrums?
Exactly. For near-term obligations and highly liquid cash alternatives, investors extensively use money market securities. Think of money market funds, for example. They pool investor money to buy ultra-liquid short-term debt, like commercial paper or short-term government securities, prioritizing capital preservation and liquidity.
Keeping cash safe and accessible.
Precisely. Then you have massive institutions like pension funds and insurance companies, LIC in India or MetLife in the US. With their very long time horizons and often fixed future liabilities, they naturally gravitate towards long-term fixed income instruments. They seek predictable coupon cash flows and a maturity profile that matches their long-term obligations, prioritizing stability and income over aggressive growth.
Makes sense for them. Long-term needs long-term assets.
Absolutely. Central banks, like the Reserve Bank of India, or RBI, or the U.S. Federal Reserve, are colossal holders of their respective sovereign bonds. G-SECs in India, U.S. Treasuries, they actively use these to conduct monetary policy, manage interest rates, and maintain financial system stability. These are also key components of their foreign exchange reserves.
Huge players.
Oh, massive. And finally, for those seeking higher returns and willing to take on more credit risk, you have hedge funds and distressed debt funds. These sophisticated investors might dabble in high yield or even junk bonds, sometimes taking very short-term positions if they believe the market is mispricing the risk or if they anticipate a corporate turnaround or restructuring. Each investor type strategically aligns its bond portfolio with its unique financial objectives, risk tolerance, and regulatory constraints.
That's a huge spectrum of investor types. But how do these investors really gauge if an issuer can actually pay them back? I mean, beyond just trusting a big name. That's where credit ratings come in, right? These letter grades are like a universal report card for a borrower's ability to meet their debt obligations, offering a standardized, often globally recognized measure of creditworthiness.
Credit ratings are indeed powerful qualitative measures. They look at an issuer's capacity and willingness to meet its financial commitments. They consider both the probability of default, how likely is it that the borrower will fail to make payments, and the expected loss if a default occurs, which reflects the potential recovery rate for bondholders. How much you might get back.
So likelihood and severity.
Exactly. Major agencies like Standard & Poor's, S&P, and Moody's assign these ratings for both short-term and long-term debt, covering both the issuer itself and specific bond issues. For example, S&T's ratings range from AAA for the absolute highest quality, signifying extremely strong capacity to repay, all the way down to D for default.
AAA to D.
And a rating of BBB is considered the lowest investment grade by market participants. Anything from BB plus downwards is categorized as speculative grade, often colloquially referred to as high yield or junk bonds. Now, this distinction between investment grade and speculative grade is absolutely critical because many large institutional investors, such as the bond funds managed by Baywhite Financial that we'll discuss, are legally or mandate restricted to only invest in investment grade instruments.
So they can't buy the junk bonds.
Often, no. This significantly impacts demand, liquidity, and pricing for bonds of different credit qualities. And when we talk about changes, even a single basis point, remember, that's 1/100th of a percentage point can mean millions of dollars in interest costs over the life of a bond.
Wow. Okay, so that distinction between investment grade and speculative grade sounds like a really sharp dividing line in the market. But what happens when an issuer crosses that line? We sometimes hear the term fallen angels. What does that actually mean for the company and, more importantly, for the investors holding those bonds?
That's an excellent point because fallen angels, issuers that were once investment grade but have had their credit quality deteriorate, leading to their bonds being downgraded to speculative grade, they create immense market shifts. When a bond loses its investment grade status, many large institutional investors, like pension funds or insurance companies, are often mandated to sell it, sometimes regardless of price because it no longer fits their investment policy statement.
Forced selling.
Exactly. This forced selling can create significant downward pressure on the bond's price, potentially creating opportunities for other opportunistic investors, but also immense liquidity challenges for the original holders. Conversely, new issuers entering the high-yield market often lack the stable operating cash flows and established track record of their investment-grade counterparts, leading investors to often require collateral or significantly higher interest rates to compensate for the increased risk.
Makes sense. More risk, more return needed.
Precisely. Now, developed market (DM) sovereign issuers, such as the U.S. government, typically represent the most credit-worthy borrowers within their respective markets, often carrying AAA ratings. This is primarily due to their fundamental right to tax economic activity, and critically, their ability to print money in their own currency.
And money printing power.
Right. This means that, in theory, they can always meet their local currency obligations. This unique power makes their debt the absolute baseline for risk in that economy, forming the risk-free rate upon which all other credit risk premiums are built. Indian G-Secs, while having a different sovereign rating than U.S. Treasuries, represent the lowest credit risk within the Indian market and serve a similar default risk-free benchmark function within the Indian economy. They are widely held by both domestic and foreign investors and central banks globally as a component of their reserves.
That's a crucial distinction. The ability to print money really changes the game for a local currency debt. Let's look at some real-world examples to bring this to life. We have BRWA Corporation and VIVU in the materials, which perfectly illustrate the difference between investment-grade and high-yield issuers and how those ratings fundamentally shape their access to the debt markets.
Okay, let's start with BRWA Corporation, a classic example of an investment-grade corporate issuer. Their debt profile showcases ready access to various unsecured debt instruments across different maturities. They utilize 150-day commercial paper for short-term working capital needs, akin to how a U.S. blue-chip company like Microsoft or an Indian conglomerate like Tata Motors might manage their immediate cash flow and liquidity.
Short-term needs covered.
Right. For more permanent working capital or medium-term investments, they issue intermediate-term notes, like a 5-year bond. And for significant capital investments, such as new factories or equipment with longer useful lives, they issue long-term notes, perhaps 15-year bonds, to match the duration of those assets. Crucially, BRWA also maintains bank credit facilities. They have a 364-day facility to back its commercial paper program, ensuring liquidity and a longer-term revolving credit facility.
Like a safety net of cash.
Exactly. They pay a commitment fee to a syndicate of banks for this ready access to capital, even if not fully drawn. It's a powerful liquidity buffer. In India, an established company like Infosys, with its strong balance sheet and reputation, would similarly issue diverse non-convertible debentures, NCDs, and commercial paper, enjoying strong investor trust and favorable terms because of their investment grade rating.
Okay, so BRWA has it relatively easy.
Relatively, yes. Now, contrast this with VIVU, our example of a high-yield corporate issuer. Their access to debt markets is significantly more constrained. They have limited or often no access to unsecured debt like commercial paper because their credit profile just doesn't warrant it in the eyes of investors. Instead, VIVU relies heavily on secured working capital facilities and credit facilities from banks, where lenders require specific collateral, such as inventory or accounts receivable, due to less stable operating cash flows.
They have to pledge assets.
They do. They also have a fully drawn loan, term Loan A, which often comes with a floating rate coupon, meaning their interest payments fluctuate with market rates, adding another layer of risk. VIVU might also issue callable notes, like its 7-year callable notes. These come with higher interest rates to compensate investors, not just for the increased credit risk, but also for the embedded call option, which lets the issuer redeem the bond early if interest rates fall.
So investors demand more for that uncertainty.
Absolutely. Think of a rapidly expanding but still cash flow negative U.S. tech company, maybe a newer EV startup, or a growth stage Indian firm needing asset-backed financing. For such issuers, lenders demand not only collateral, but also more restrictive covenants. Those detailed terms and conditions in the bond indenture that dictate what the company can and cannot do financially, like limiting additional debt or dividend payments.
Those sound strict.
They can be. The difference in their debt profiles highlights how credit quality fundamentally shapes an issuer's financing options, costs, and the flexibility they have.
So it sounds like for a high-yield issuer like VIVU, Accessing debt isn't just a trip to the bank. It's more like a complex negotiation where every single asset might be on the table. It must feel like they're walking a tightrope compared to BRWA's stroll down the boulevard. Now, how do investors use these categories? You mentioned Baywhite Financial manages bond funds, and their strategies clearly show how credit quality and maturity define their portfolios and cater to specific investor objectives.
That's a perfect analogy, and it's precisely why the covenants we mentioned earlier become so much more critical for high-yield issuers. For VIVU, those aren't just legal boilerplate, they're the safety net, the rules of engagement that define what they can and cannot do with their business until the debt is repaid. Breach a covenant, and lenders can swoop in, potentially demanding immediate repayment. It's a constant balancing act.
High stakes.
Very high. Now, turning to Baywhite Financial's funds, let's see how they apply these concepts. Their core bond fund is designed with the objectives of long-run capital appreciation while maintaining a relatively low tolerance for credit risk. This fund invests primarily in investment-grade, intermediate to long-term bonds, naturally including instruments like BRWA's 5- and 15-year notes. Its holdings reflect this conservative approach. 55% in Pol A-rated securities, significant portions in sovereign bonds, 28%, mortgage-backed securities, 23%, and other asset-backed securities, 16%.
So mostly top-quality stuff.
Exactly. For instance, it might hold highly liquid U.S. Treasury bonds, corporate bonds from top-tier companies like Apple, or Indian GSECs and NCDs from blue-chip Indian companies such as Infosys or Reliance. Conversely, Baywhite also manages a short-term bond fund. This fund is positioned as a highly liquid cash alternative for investors, thus taking minimal credit and interest rate risk. It invests exclusively in investment-grade, short-term bonds, exactly like BRWA's commercial paper.
Like a parking spot for cash.
Precisely. A substantial 41% of its holdings mature in less than 1 year, with another 57% maturing between 1 and 3 years. Notably, neither of these funds would invest in VIVU's 7-year callable notes, as their mandates restrict them solely to investment-grade debt. This brings us to a crucial point for anyone studying fixed income: understanding these fund mandates. As a CFA candidate, you'll often encounter scenarios where an asset manager is restricted by their investment policy statement. Knowing why a fund invests only in investment grade or only short-term bonds isn't just academic, it dictates their entire strategy and risk profile.
The rules they have to follow.
Exactly. This raises an important question for you, the listener. What's your investment objective? Are you seeking the stability and predictable cash flows akin to a large Indian pension fund managing long-term liabilities? Or are you comfortable with higher growth potential that comes with higher risk, much like some opportunistic investors? Your answer dictates which part of the fixed income spectrum you should explore.
We've explored how bonds are classified and how different players approach them. Fascinating stuff. But how do we get a sense of the entire landscape? How do we measure the ebb and flow of these vast markets? Just as a ship needs a compass, investors rely on fixed income indexes. But here's where the journey gets a little trickier, because while they serve a similar purpose to stock indexes, bond indexes are fundamentally different in ways that will genuinely surprise you.
Indeed. Fixed income indexes are absolutely crucial for several reasons, and their functions extend beyond simple tracking. First, they allow us to evaluate overall market performance and identify key trends in the bond space, whether it's a rally in corporate bonds or a sell-off in government securities. Second, and critically for portfolio managers, they serve as benchmarks for evaluating the performance of investment managers and funds.
Measuring their success.
Exactly. A bond fund manager's success is often measured by how well their fund performs relative to an appropriate bond index, factoring in risk and return. Third, these indexes form the very basis for indexed investment strategies, such as bond exchange-traded funds, ETFs, which aim to replicate the index's performance as closely as possible. They provide a vital reference point for understanding how various segments of the bond market are performing, whether it's U.S. corporate bonds, Indian government securities, or global high-yield debt.
That's a comprehensive set of roles, especially for benchmarking. But if they're so similar in purpose to equity indexes, where do these surprising differences you mentioned actually come into play? What makes a bond index tick so differently from a stock index?
That's an excellent follow-up, and if we connect this to the bigger picture, these differences stem directly from the inherent characteristics of bonds themselves, their life cycle, their variety, and how they're issued. Let's elaborate on 3 critical distinctions.
Okay, let's hear.
First, more constituents. A key takeaway here is that a single issuer, like the U.S. Treasury or the Reserve Bank of India managing GSECs, can have literally hundreds of individual fixed income securities outstanding at any given time.
Hundreds. from one issuer.
Easily. Each of these can have different maturities, coupon rates, and sometimes even specific covenants. This means fixed income indexes often have a vastly greater number of constituent securities than equity indexes, sometimes exceeding 10,000 unique bonds.
10,000. Wow.
Yeah. For a bond fund manager trying to track such an index, this makes full physical replication almost impossible. Instead, they often have to employ sampling strategies, holding a representative subset of the bonds to minimize tracking error. This complexity is also why unique alphanumeric identification codes, like a CUSIP in the US or an ISIN globally, are so crucial. They're essentially a bond's social security number.
Makes sense. Too many to buy them all.
Second, higher turnover. An intriguing aspect of bonds is their finite maturities they expire. When a bond matures, it's removed from the index. This, combined with the higher frequency of new issuance, from governments and corporations constantly seeking to roll over maturing debt or raise new capital, leads to far more changes or turnover in fixed income indexes compared to equity indexes. Bond indexes are typically rebalanced monthly to add new issues that meet the inclusion criteria and remove maturing ones or those that no longer qualify.
So they're constantly changing.
Constantly. This constant churn presents significant challenges for index replication and can lead to higher transaction costs for passive bond funds trying to keep up. And third, market value weighting. Unlike most equity indexes, which are often weighted by an issuer's market capitalization, bond index constituents are usually weighted by the market value of the debt outstanding.
Weighted by debt size, not company size.
Precisely. This means broad bond indexes naturally reflect significant shifts in market composition over time. For example, if there is a surge in government borrowing, as we've seen during global crises, the weight of government debt within a broad index will automatically increase. Similarly, changes in the overall maturity profile or the credit quality of the market will directly impact the index composition. To put this in context, if the Indian government issues a large new tranche of GSECs, it will immediately increase the weighting of that particular bond within the relevant Indian bond index, reflecting its increased prominence and liquidity in the market. These fundamental differences mean that managing and understanding bond indexes requires a distinct approach compared to equity indexes.
That's fascinating, especially the implications of that higher turnover and market value weighting for anyone trying to track these markets. It sounds like managing a bond index fund is a much more dynamic and complex task than its equity counterpart. So given this complexity, bond indexes aren't just one size fits all, right? They can be incredibly broad or very narrow, tailored to specific investor criteria.
Exactly. The classification of bond indexes is a direct response to the specific and diverse needs of investors. Let's look at some illustrative examples from the provided exhibits to highlight this specialization.
Okay, good idea.
First, we have the Bloomberg Barclays Global Aggregate Index, as highlighted in Exhibit 3. This is a prime example of a broad-based aggregate index. It includes fixed-rate bonds from sovereign, government-related, corporate, and securitized issuers in both developed and emerging markets across 28 eligible currencies. A crucial point, which we touched on earlier with Bayway Financial, is that it only includes investment-grade rated securities and explicitly excludes high-yield and unrated debt.
Only investment grade globally.
Right. It also has minimum issuance size requirements, for example, USD 300 million or CNY 5 billion for treasury and bank debt in China to ensure sufficient liquidity. For a global fund, whether based in the US or India, seeking diversified investment grade exposure, a fund tracking this index would offer broad access to many fixed income markets without needing to actively select individual securities. It might include U.S. Treasury bonds, corporate bonds from highly rated companies like Apple, or highly rated Indian corporate NCDs and GSECs. All constituents are typically priced at a predetermined time each business day, offering consistency. It's a comprehensive benchmark for global investment-grade debt. But remember, its exclusions are as important as its inclusions.
Got it. Broad but with specific rules.
Next, consider the JP Morgan EMBI Plus Index, shown in Exhibit 4. In stark contrast to the global aggregate, this index is much narrower and highly specialized. It focuses specifically on U.S. dollar-denominated debt issued by emerging market sovereign governments with a credit quality of Ba1 BBB plus or below.
Below investment grade. And only USD.
Exactly. This raises an important question. Why this specificity? It's meticulously designed for investors who are explicitly seeking higher U.S. dollar-based returns by taking on the external debt risk of these emerging economies. So you wouldn't find an Indian GSEC denominated in rupees here, but you might find a dollar-denominated bond from a country like Brazil or South Africa if it meets the credit and size criteria. like a minimum face amount outstanding of USD 500 million and at least 2.5 years to maturity. It targets a very specific risk-return profile.
Okay, very targeted index.
Very. And finally, we have indexes that integrate ESG considerations, reflecting a significant and growing trend in investing. The Bloomberg Barclays MSCI Euro Corporate Sustainable SRI Index from Exhibit 5 is a fascinating example of this evolution. It includes euro-denominated corporate bonds of investment-grade quality, but critically, it screens for and excludes issuers involved in certain business activities deemed non-sustainable or unethical, such as alcohol, tobacco, gambling, nuclear power, or thermal coal.
So it filters companies based on what they do.
Right. Precisely. It also requires a minimum MSCI ESG rating of BBB or higher and excludes issuers with red MSCI controversies scores, meaning they have severe controversies related to ESG issues. This demonstrates how investment strategies are evolving beyond purely financial metrics, actively aligning with ethical and sustainable investing principles. A trend we see growing rapidly in both the U.S. and Indian markets as investor preferences shift. These indexes allow investors to implement their values alongside their financial objectives, effectively shaping capital flows towards more responsible issuers.
So we've dissected what bonds are and how they're categorized and benchmarked, but where do bonds actually come from? The primary market is where an issuer first sells new bonds to investors to raise capital. It's a launchpad for new debt, effectively initiating the relationship between borrower and lender. It's the very first step in a bond's life cycle.
The primary market is indeed where the genesis of a bond occurs, and the process varies significantly depending on the issuer and the type of bond being offered.
Okay, so how does it work?
Let's start with debut issuers. These are entities approaching the bond market for the very first time. They often transition from relying on private debt, like bank loans, to publicly issued bonds, effectively transforming a private ownership structure into a public one for their debt. Examples might include new corporate legal entities formed after a major merger or acquisition, companies reaching a more mature stage with predictable cash flows, or even a sovereign government raising external foreign currency debt for the first time on the international stage.
Their first time selling bonds publicly.
Exactly. For a debut issuer, the process is extensive and can take weeks. Underwriters, which are financial intermediaries, typically conduct rigorous due diligence and extensive roadshows and information sessions for several weeks to educate potential institutional investors about the new entity, its business model, its financial health, and the sources of repayment for the new bond.
A lot of explaining needed.
A lot. This isn't just a formality, it's a critical discovery phase. Underwriters are not only educating investors, but also gauging demand and pricing sensitivity. They might start with a target price range, but based on investor feedback, their questions, their expressed interest, that range can shift significantly. For a brand new entity, the spread it has to offer over comparable established debt might be substantial, reflecting that initial information asymmetry and lack of a long track record. In India, a new infrastructure project entity might issue its very first project bonds to a select group of institutional investors through this detailed relationship-building process.
Makes sense for newcomers. What about established players?
For repeat issuers, which frequently access the bond market, the process is far more abbreviated. These are established entities like Apple or Infosys, whose credit profile is well known. They often issue a new security priced at or close to par. A less common but strategically important maneuver is a reopening, where an issuer increases the size of an existing bond, even if its price is significantly different from par.
Reopening an old bond. Why?
It allows them to issue opportunistically when market conditions are favorable without creating a completely new CCU Zipper ISIN. Remember, those unique identification codes. This is incredibly efficient as it adds liquidity to an existing issue, rather than fragmenting the market with a new, smaller one.
Clever. Keeps things simpler.
Exactly. Exhibit 6 provides a clear illustration of an investment-grade corporate bond issuance timeline. What's truly striking here is the speed for investment-grade corporate bonds. An underwritten offering can be announced at 9:15 a.m. and priced by 3:00 p.m. the same day.
Same day, that's fast.
Incredibly fast. Underwriters guarantee the sale and manage the order book, ensuring the bonds are placed with large institutional investors. An established company like Apple in the U.S. or Infosys in India, with its strong reputation and frequent market access, would utilize such a streamlined process. These issuers often operate under a shelf registration, with regulators essentially a broad offering circular updated regularly that allows for quick, repeated issuance of securities without needing to go through the full regulatory approval process each time they want to tap the market.
Pre-approved for speed.
Okay, but what about riskier bonds?
Right. For secured versus unsecured issuance, especially among high-yield corporate issuers like our VIVU example, the process is longer and more involved. Investors need to scrutinize complex covenants, those detailed terms and conditions, and understand both operating cash flows and the specific collateral as sources of repayment. This might necessitate a best efforts offering, where the financial intermediary acts as a broker and doesn't guarantee the sale, merely trying to sell the bond issue on a commission basis.
So the bank doesn't promise to sell it all.
Exactly. This is common for smaller or higher risk issues. For example, a smaller Indian company issuing secured NCDs, where a bank acts as an intermediary but doesn't take on underwriting risk, shifting the placement risk entirely to the issuer. Sometimes, if the bond size is small, the issuer is less well known, or the terms are highly customized and negotiated. Bonds are sold via a private placement to a select group of institutional investors rather than a public offering. This allows for more tailored agreements, greater flexibility, and can often be quicker with less extensive regulatory disclosure for specialized needs.
Like a private deal.
Pretty much. Finally, sovereign debt issuance, such as U.S. Treasury bonds or Indian G-Secs, is typically issued via a public auction, led by the National Treasury or Finance Ministry. The Reserve Bank of India, for instance, regularly conducts bond auctions for G-Secs, where banks and primary dealers, a select group of financial institutions, bid for the securities. This is a very transparent and standardized process designed to ensure fair pricing, broad participation, and efficient distribution for the most creditworthy issuers.
So the primary market is where a bond comes to life, but its journey is far from over once it's initially sold. Once bonds are issued and find their initial buyers, they don't just sit there. They immediately enter the secondary market, where they are actively traded among investors. This is where most of the daily action happens, determining the ongoing market value of existing debt and offering investors liquidity.
Indeed. The secondary market is where bonds change hands after their initial issuance in the primary market. Understanding its structure is crucial because it significantly differs from equity markets.
Oh, so?
Market structure. Unlike listed equities, which primarily trade on electronic exchanges with a central order book, secondary fixed income markets are mostly, quote, driven or over-the-counter OTC markets. While platforms like MarketAxess and TradeWeb have significantly increased electronic trading and transparency, dealers still play a central role, quoting bid, buy, and offer sell prices to customers.
So dealers are key.
Very key. Major participants include large institutional investors, like the Baywhite funds we introduced earlier, various financial intermediaries, and central banks. These players are constantly adjusting their portfolios based on market conditions, interest rate expectations, and credit outlook, driving trading activity. Liquidity. This is a crucial factor here, and it varies widely across fixed income instruments and even among different bonds from the same issuer. We measure it primarily by the bid-offer spread, essentially, the dealer's profit margin. The difference between the price they're willing to pay to buy a bond from you, the bid, and the price they'll sell it to you, the offer.
The buy-sell difference.
Exactly. Think of it like a currency exchange. They buy your dollars at one rate and sell them back at a slightly higher one. A tighter spread, meaning a smaller difference, generally signifies greater liquidity, indicating that a bond can be bought or sold quickly without significantly impacting its price.
Tighter spread equals easier trading.
Generally, yes. Now let's consider the liquidity hierarchy. If we connect this to the bigger picture, the most liquid fixed income securities are typically on-the-run developed market sovereign bonds. These are the most recently issued and actively traded U.S. Treasury bonds, or active Indian G-Secs. Primary dealers make active markets in large sizes for these, resulting in bid-offer spreads as small as a fraction of a basis point.
Tiny spreads for those.
Tiny. These bonds serve as global benchmarks. Recently issued corporate bonds from frequent investment-grade issuers like Apple or Infosys also exhibit good liquidity, with spreads of maybe a few basis points as underwriters and other dealers hold trading inventory in these. However, bonds from less frequent corporate issuers or more seasoned, older bonds from frequent issuers often have much wider spreads, sometimes 10, 20 basis points or more, because they trade less frequently and dealers face higher inventory risk. This raises an important question for you, the investor. How easily and efficiently can you convert your bond into cash without significant price impact? Your answer depends heavily on the bond's position within this liquidity hierarchy.
Something to watch out for. What about really risky stuff?
An interesting exception to this liquidity spectrum is distressed debt. This refers to bonds of issuers believed to be very close to or in bankruptcy or already in default. For example, during its bankruptcy filing in May 2020, Hertz Global Holdings, Inc. saw its bonds plummet to less than 10% of par value, only to stage a remarkable recovery a year later after a successful reorganization.
Wow, big swings.
Huge. Such bonds trade well below par because bondholders anticipate significant losses, if not a total loss. They are typically sold by investors restricted to highly rated securities and bought by hedge funds or opportunistic investors, seeking equity-like returns from potential price appreciation if the company successfully reorganizes. What's fascinating here is the contrast with equities. Distressed debt continues to trade, sometimes until the issuer's assets are liquidated or the debt is restructured. Long after the company's equity securities have likely been delisted from exchanges due to failing minimum listing requirements.
So the debt keeps trading even when the stock might be gone.
Often, yes. Finally, many bond issues do not trade at all on a regular basis. They are highly illiquid. For these illiquid bonds, their price quotes from dealers or on platforms like Bloomberg are often estimates. These estimates are typically derived from more liquid bonds with similar credit quality, maturity, and other characteristics through complex quantitative models. This estimation process is actually a topic for a later module, but it underscores the importance of understanding liquidity and its implications for valuation when considering any bond investment.
That wraps up Module 03 of CFA Level I 2025 Fixed Income, Volume 6. Today, we've taken a truly comprehensive deep dive into how fixed income instruments are issued and traded. We explored the nuances of market segmentation by issuer, credit quality, and maturity, delved into the critical role of credit ratings and the implications of terms like fallen angels. We uncovered the vast differences between various types of bond indexes compared to equities, and dissected the distinct characteristics of primary and secondary markets, from debut issuers to distressed debt.
We've seen that fixed income markets are far more diverse, complex, and dynamic than equities, that's for sure. With issuers often having multiple instruments, indexes exhibiting higher turnover due to finite maturities, and trading predominantly occurring over the counter. This foundational understanding is absolutely crucial for anyone navigating these markets, whether you're managing a portfolio or preparing for the CFA exam. Next, we'll dive into Module 04 and explore the fixed income markets for corporate issuers in even more detail, bringing a sharper, dedicated focus to that specific and very active segment.
So what does this all mean for you, the listener? Next time you see a headline about a major corporation like Apple or Reliance Industries issuing bonds, or hear about a country's treasury auction for U.S. Treasuries or Indian G-Secs, you'll know there's a fascinating and complex engine humming behind it. This engine impacts everything from your pension fund to the price of a cup of coffee by influencing the cost of capital for businesses and governments globally. Think about how these intricate issuance decisions and secondary market trading dynamics ultimately shape the financial landscape, your investment opportunities, and the incredible detail that goes into every single bond decision and transaction. It's truly an invisible force at work.
Welcome back to the Deep Dive. We're genuinely thrilled you're joining us for another essential exploration, custom-tailored for your CFA Level I 2025 Fixed Income Volume 6 course. Today, we're zeroing in on a crucial dynamic area of finance, Module 04, Fixed Income Markets for Corporate Issuers. We're sort of unraveling the intricate web of corporate funding. It's a high-stakes game where every choice, from an overnight loan to a 30-year bond tells a story.
It really does. A story about a company's health, its ambitions, and the economic landscape it operates within. Our mission today is to equip you with a robust understanding of how corporations, whether they're nimble startups, established local businesses, or sprawling global giants, secure the lifeblood they need, funding. We'll uncover the specific instruments, the complex mechanisms, and the often overlooked risks involved in the corporate fixed income landscape, basically providing you with a critical lens to analyze corporate finance.
That's right. We're going to peel back the layers on everything, from the nuances of various bank loans and the surprisingly powerful commercial paper to the intricate, sometimes opaque world of repurchase agreements. And then we'll draw a very clear contrast between the distinct characteristics of investment grade versus high-yield corporate debt. We'll reveal why these differences are just so critical.
Critical for both the companies issuing them and the investors buying them. It's all about understanding what makes these markets tick.
Exactly.
And just so you know where we're heading, once we wrap up this module, our next stop will be Module 05, Fixed Income Markets for Government Issuers. There, we'll shift our focus entirely to how sovereign entities, governments fund themselves, and the unique considerations involved.
Yep.
But for now, let's unpack the corporate landscape and dive deep into Module 04.
Okay, so let's kick things off with the most immediate need, short-term funding. Why do corporations and financial institutions, these massive entities with often vast cash flows, still need external funding in the short term? What's driving this constant, immediate demand for cash, sometimes just overnight?
Fundamentally, it's all about managing immediate cash needs, preserving liquidity, and capitalizing on opportunities that arise during their cash conversion cycles.
Cash conversion cycles.
Right.
Think about it. A company might need to pay its suppliers today before it collects payments from its customers next month. That's a gap. Or it might want to take advantage of an early payment discount offered by a vendor, but the cash isn't quite in the bank yet. This entire process, the time it takes to turn investments in inventory and accounts receivable into actual cash, that's their cash conversion cycle. Short-term funding provides that crucial operational fluidity to bridge these gaps. It ensures day-to-day operations can continue smoothly, without interruption, avoiding liquidity crunches.
That makes perfect sense, bridging that gap between cash out and cash in. So let's start with the non-financial corporations, the Apples and the Oracles of the world, maybe the Tatas in India. What are the primary external sources of short-term funding they first turn to, typically through banks?
Okay, for non-financial corporations, external loan financing from financial intermediaries, usually banks, is a common go-to. This typically comes in a few forms, each offering different levels of reliability and cost. The first is uncommitted bank lines of credit.
Uncommitted. Sounds risky.
Well, as the name suggests, they are the least reliable form of bank borrowing because the bank can, at its discretion, just refuse to lend. There's no formal promise. However, under normal business conditions, they're often the most flexible and least costly. There's no upfront commitment fee. You only pay interest on the principal you actually borrow. These are typically unsecured and are offered to clients who maintain stable cash deposits, which also allows banks to monitor their activity closely.
I'm curious, if they're so flexible and cheap, why wouldn't every company just rely on uncommitted line? Is there a hidden downside beyond just the bank's discretion? Like, what kind of signal does a company send if this is its primary short-term funding?
That's a great question because it highlights a key trade-off. While flexible and cheap under normal conditions, the core downside is exactly that, the lack of guarantee. During periods of market stress, or if the bank perceives a deterioration in the borrower's financial health, that line can simply disappear.
Poof.
Exactly. Imagine being in a tight spot needing cash and your bank saying no. That's the ultimate risk. A company heavily relying on uncommitted lines is signaling high confidence in both its own financial stability and the stability of the overall market. It's basically saying, we believe we'll always be creditworthy enough, and the banks will always be willing to lend.
A bit of a gamble, then.
It can be. For instance, a large, highly rated U.S. tech company, like Oracle, maintaining significant cash deposits with its primary bank, might have an uncommitted line for seasonal working capital needs. They like the flexibility, but they know the bank can withdraw it. Similarly, a well-established Indian manufacturing firm, maybe one with a strong relationship with State Bank of India, SBI, and consistent deposits, might utilize an uncommitted line for immediate operational expenses without incurring upfront costs. They're relying on that relationship, but it's not guaranteed.
It sounds like uncommitted lines are great for flexibility, but they come with a crucial asterisk: no guarantees. What's the next step up the reliability ladder for a company seeking more certainty?
That brings us to committed bank lines of credit. These are significantly more reliable than uncommitted lines because they involve a formal, written commitment from the bank to lend up to a certain amount over a specific period.
Okay, a real promise this time.
A real promise. Because of this commitment, banks are required to set aside more capital, which is a regulatory requirement. Interestingly, commitments under a year, like a 364-day facility, are often preferred by banks because they minimize these capital reserve requirements compared to multi-year commitments. A little regulatory nuance there.
Oh, okay.
For larger borrowers, these lines are often syndicated. That just means a group of banks shares the commitment.
Spreads the risk.
Exactly. Spreads the risk for the lenders and allows for much larger funding amounts. Like uncommitted lines, they're typically unsecured and prepayable without penalty. However, reliability comes at a price. And they involve upfront costs, such as a commitment fee, often around, say, 0.50% on either the full amount or the unused portion of the line. They can also serve as crucial backup credit for other financing forms, like commercial paper, providing a safety net against that rollover risk we'll talk about. Think of General Motors in the U.S. They might secure a committed line of credit from a syndicate of U.S. banks to ensure liquidity, paying that commitment fee for guaranteed access. Or in India, Tata Motors could similarly obtain a committed line from a consortium of Indian banks like ICICI, HDFC, or Axis Bank to manage its working capital, guaranteeing access in exchange for the fee. It provides a much stronger sense of security.
So we've moved from maybe to definitely for a fee. And if a company needs the absolute most reliable bank funding for the longer haul, something they can truly integrate into multi-year strategic plans, what's their option then?
For the highest level of reliability and long-term commitment in bank funding, companies turn to revolving credit agreements, often just called revolvers or sometimes operating lines of credit.
Revolvers, got it.
These are multi-year credit commitments, making them the most dependable and stable source of bank-intermediated short-term funding. Because of this extended multi-year commitment, lenders typically seek more protections. This often comes in the form of covenants.
The fine print.
Pretty much. These are requirements or restrictions on borrower actions, much like those you'd find in a bond indenture. Covenants might dictate financial ratios, spending limits, or even prohibit certain business activities to protect the lender. Otherwise, revolvers share similar features with regular committed lines regarding borrowing rates and commitment fees. They might even include optional medium-term loan features, offering even greater flexibility.
How so?
Well, they might allow a portion of the revolver to be drawn as a longer-term loan, not just short-term working capital. A major U.S. financial institution, for example, might use a multi-year revolving credit agreement with strict covenants to provide a stable, long-term source of flexible funding for its operations. In India, a large infrastructure company like Larsen & Toubro might enter into a multi-year revolver with a public sector bank, complete with covenants linked to their project completion milestones and financial ratios. It ensures the lender is protected while giving the company the stable funding it needs for big projects.
That makes sense. The longer the commitment, the more protective the lenders become. We've covered unsecured bank financing. But what if a company's credit quality isn't strong enough for an unsecured loan? What alternatives do they have when banks need something more concrete to lean on?
That's where secured loans, also known as asset-based loans, come into play. Here, the lender requires collateral.
Okay, tangible assets.
Right, things like fixed assets, high-quality accounts receivable, inventory, or maybe marketable securities. The lender then files a security interest or a lien against these pledged assets. This becomes part of the borrower's financial record, giving the lender a legal claim on those assets if the borrower defaults. It significantly reduces the lender's risk.
So it's mainly for lower credit quality companies.
Primarily, yes.
Yeah.
Companies that might not qualify for unsecured loans. Within secured loans, we have a couple of specific mechanisms. One is the assignment of accounts receivable. The company uses its incoming payments, its receivables, as collateral for a loan, but crucially, it remains responsible for collecting those payments itself.
Okay.
A more intensive option is factoring. Here, the company actually sells its accounts receivable to a lender, known as a factor, usually at a discount.
Sells them outright.
Yes. And in this case, the factor takes on the full responsibility for credit granting and collection, effectively shifting that burden and the associated credit risk away from the original company. For a U.S. example, a smaller manufacturing company with limited access to unsecured credit might get a secured loan from a bank by pledging its inventory or accounts receivable. In India, a mid-sized textile exporter could secure a loan from the Export-Import Bank of India, or EXIM Bank, by assigning its foreign receivables as collateral. This ensures immediate cash flow for the exporter while reducing the bank's risk because it has a direct claim on those incoming payments. Makes the loan much safer for the bank.
That's a clear picture of bank intermediated financing, secured and unsecured. But what about companies that are so large and well-regarded that they can bypass banks altogether? Issue debt directly to the market for short-term needs.
Right. For some large, highly rated firms, issuing debt directly in financial markets can be significantly more cost-effective than relying solely on bank loans, particularly for short-term needs. This leads us to commercial paper, or CP. These are short-term, unsecured promissory notes issued by large, highly rated companies, typically maturing in less than 3 months.
Very short-term.
Very short. CP is used for working capital, seasonal cash needs, or as bridge financing, providing interim funds until more permanent financing can be arranged, or just smoothing out cash flow gaps. A key risk with commercial paper, and one that has caused significant market disruption in the past, is rollover risk.
Right, the risk they can't pay it back when it's due.
Exactly. The possibility that the issuer won't be able to issue new CP at maturity to repay the existing paper. That leaves them in a sudden liquidity crunch. To mitigate this, investors often require a liquidity enhancement. This is essentially a committed backup line of credit from banks.
Ah, so the banks are still involved, just indirectly.
Precisely. This liquidity enhancement isn't just a nice-to-have, it's often a requirement. Without that backup line, investors would be incredibly wary, knowing the issuer could face a sudden inability to repay if the market for new CP dries up, as we've seen in past crises. We also see Euro commercial paper, or ECP. This is just CP issued in the international market, often in a different currency. ECP generally involves smaller transaction sizes, is less liquid than USCP, and tends to have slightly different investor bases. For US example, Apple Inc. frequently issues commercial paper. They manage their short-term cash flows, relying on their strong credit rating and substantial backup lines of credit from major banks. It demonstrates financial prudence. In the Indian context, Reliance Industries might issue commercial paper to finance its seasonal working capital needs, leveraging its high credit rating in the Indian market to attract institutional investors looking for short-term, low-risk options.
We've just seen how non-financial firms scramble for short-term cash. But what about the behemoths of finance themselves, the banks? How do they, ironically, manage their own immediate cash flows, given their entire business is about money?
That's a fascinating transition because financial institutions, acting as intermediaries, have slightly different needs and, therefore, slightly different sources of short-term funding. Their assets are often long-term loans and securities, while their liabilities include various forms of deposits and short-term borrowing. Their whole business model revolves around managing this balance. The primary and often largest source of short-term funding for most banks is deposits.
Makes sense. Customer money.
Exactly. These come in several forms. Demand deposits are your typical checking accounts, no stated maturity, low or no interest. But for banks, they represent a relatively stable funding source due to customer relationships and daily activity. Saving deposits are generally held for non-transactional purposes and often come with a stated term or withdrawal restrictions. Then we have certificates of deposit, or CDs. These are deposits with a predetermined maturity, typically less than a year, and a fixed interest rate.
Okay, CDs. I know those.
Right, but there are different types. Non-negotiable CDs penalize early withdrawal. You can't just take your money out without a cost. But negotiable CDs can be sold in the open market before maturity. This offers vital liquidity to investors. We also differentiate between small denomination CDs, which are retail-oriented, and large denomination CDs, which are a common source of wholesale funding from institutional investors. These large negotiable CDs are highly liquid and even traded in secondary markets, including the Eurobond market.
So banks rely heavily on these large institutional CDs.
They're a very important part of their funding mix. For instance, a large U.S. bank like Bank of America offers various CDs, with large negotiable CDs being crucial for their wholesale funding. In India, HDFC Bank issues large denomination negotiable certificates of deposit to institutional investors, providing them with short-term, liquid investment options.
Beyond attracting deposits, what other crucial avenues do financial institutions explore for short-term cash, especially when they need to borrow from each other or even the central bank?
The interbank market is another crucial avenue. It's like the nervous system for short-term liquidity among financial institutions. This involves short-term borrowing and lending among banks themselves, secured or unsecured. Terms typically range from overnight to 1 year, with rates tied to a market reference rate, like SOFR or Euribor, plus a spread for credit risk.
Banks lending to banks.
Exactly. Within this, we have the central bank funds market. This is where banks with excess reserves lend to those facing shortages to meet regulatory requirements, often overnight. The central bank funds rate isn't just a theoretical number. It's the key target rate for this overnight lending. The central bank uses open market operations, buying or selling government securities, to nudge this rate towards its policy goal.
Influencing the whole system.
Absolutely. For example, in the U.S., a bank like Wells Fargo might borrow overnight from another bank in the federal funds market to meet its reserve requirements, at a rate influenced by the Federal Reserve's target rate. In India, the Reserve Bank of India, or RBI, actively manages overnight liquidity through its Liquidity Adjustment Facility, or LAF. Banks borrow or lend funds through daily repo and reverse repo auctions, directly influencing short-term rates. Now, as a last resort, if a bank can't borrow in the interbank market, it can turn to discount window lending from the central bank.
The lender of last resort.
That's the one. But it usually comes at a higher rate, requires collateral, and often leads to increased central bank oversight. It also carries a certain stigma, signaling distress, so banks prefer to avoid it if possible.
Okay. We previously discussed commercial paper for non-financial corporations. Do financial institutions also extensively use CP? And are there any specialized forms unique to them?
Absolutely. Large financial institutions are actually the dominant issuers of commercial paper. They account for something like 60% of annual CP issuance volume.
Wow, that much.
Yeah. They use these unsecured notes for short-term needs and sometimes even to fund longer-term assets like loans, which creates a potential maturity mismatch risk. And just like non-financial firms, banks face that crucial rollover risk with their CP, often needing those backup liquidity lines. A particularly interesting and somewhat more complex form used by financial institutions is asset-backed commercial paper, or ABCP.
Asset back, so
Yeah.
it's secured.
It is a secured form of CP, yes. The mechanics involve a bank selling a pool of short-term loans or receivables, think credit card receivables, auto loans to a special purpose entity, or SPE. This SPE is legally separate from the bank, an off-balance sheet vehicle. The SPE then issues ABC to investors, backed by the cash flows from these assets. Crucially, the sponsoring bank typically provides a backup credit liquidity line to the SPE. This ensures the ABCP can be repaid even if the underlying assets have temporary cash flow issues.
Why go through all that trouble with an SPE?
Good question. It's off-balance sheet financing for the bank. This reduces its capital costs because it moves assets off its balance sheet without needing to hold capital against them. Instead, it provides that backup liquidity line. For investors, it offers a liquid, short-term note backed by a diversified pool of loans they wouldn't normally access directly. However, the rapid growth of ABCP and its challenges during the global financial crisis starkly highlighted its risks, especially when used to fund longer-term or lower-quality assets.
Right, the GFC connection.
Exactly. Post-GFC, the market largely reverted to funding high-quality short-term assets with stronger credit enhancements. For example, during the U.S. housing boom, backed by mortgage pools. That became hugely problematic. Post-GFC, the focus shifted back to safer short-term loans. In India, a major housing finance company like HDFC might use securitization to transfer a pool of its housing loans to an SPE, which then issues ABCP. This allows HDFC to free up capital and manage its balance sheet.
Here's where it gets really interesting: repurchase agreements, or repos. Many people might have heard the term, maybe in news headlines during market stresses, but what exactly are they at their core? Why are they so foundational?
Repos. Yes, they are fundamental. A repo is a form of short-term secured lending, but it's structured as a sale and repurchase. At its core, it involves the sale of a security with a simultaneous agreement by the seller to buy the same security back from the purchaser at a pre-agreed repurchase price and on a future date.
So it looks like a sale, but it functions like a loan.
Yeah. Exactly. It's essentially a collateralized loan where a security acts as the collateral, but legally it's two separate transactions. A sale, then a repurchase. Let's break down the mechanics. At TGRO, today, the security seller, who's effectively the cash borrower, sells a security, say a U.S. Treasury note, to the security buyer, the cash lender, for cash. Now, the interesting part is, for tax and coupon purposes, the seller retains legal ownership of the security, even though the buyer holds physical possession and the economic risk.
Okay, that's a key distinction.
It is. Then, at TT, the pre-agreed repurchase date, the security buyer returns the security to the seller. In return, the seller pays back the original cash amount plus interest, which is the repo rate. The difference between that initial sale price and the higher repurchase price is the interest earned by the cash lender. It's the cost of borrowing for the cash borrower. Most repos are very short-term, often just overnight, and they typically use high-quality, highly liquid securities as collateral, like sovereign bonds. We talk about general collateral repos, which reference a group of eligible securities and trade at the general collateral repo rate. But then there are special collateral repos. These involve a specific in-demand security, maybe one that's particularly scarce or valuable for certain trading strategies.
Yeah, and that affects the rate.
Significantly, the high borrowing demand for this specific security can actually drive down its special repo rate, sometimes even to zero, or in extreme cases, below zero.
Negative rates. Wow. Okay, so the collateral makes it secure and the price difference is the interest. But what about market volatility? How do these contracts protect against the collateral losing value during the repo term?
That's critical for risk management, and repo contracts have built-in features for this. One is initial margin.
Margin, like in futures trading.
Similar concept. It's collateral provided in excess of the cash exchanged. The formula is security price at T0, purchase price at T0. So 102% initial margin means the cash lender receives collateral worth $102 for every $100 lent. It provides a buffer against price declines right from the start. Closely related is the haircut.
It's a percentage reduction in the loan amount relative to the initial collateral value. Formula: security price at T0, purchase price at T0, security price at T0.
So a haircut is like the lender saying, I'll only lend you 98% of this collateral's value.
Exactly. A 1.96% haircut means for a $100 security, only $98.04 is lent. It provides the exact same dollar protection as the 102% initial margin you mentioned.
Two sides of the same coin, then.
Precisely. Initial margin means more collateral than cash. Haircut means less cash than collateral value. Same goal. Buffer against value decline. Then there's variation margin. This involves dynamic adjustments during the repo term if the collateral's value changes significantly. The formula is variation margin. Initial margin purchase price at T, security price at T. If the collateral's price drops, the cash borrower must provide additional collateral. That's a margin call.
Ah, the dreaded margin call.
Can be. Conversely, if the collateral's price rises significantly, the borrower can actually request some collateral back. All these terms, margining, collateral substitutability, default events, are governed by a master repurchase agreement, a comprehensive legal doc covering all repo trades between two parties. Provides legal certainty.
So beyond just basic borrowing and lending cash, what are the broader, more strategic applications of repos? Why are they so ubiquitous in finance?
Repos serve several crucial purposes. Firstly, they allow institutions to finance the ownership of a security. A bank or fund with a large inventory of bonds, say, can use repos to borrow cash against them. This reduces their net funding requirement for holding those bonds to just a fraction of the purchase price, basically, the margin amount. Frees up capital.
Makes sense. Leverages their holdings.
Exactly. Secondly, from the cash lender's perspective, repos are an excellent way to own short-term income by lending funds on a secured basis. It's very low-risk, collateralized cash investment. Great for mutual funds or pension funds, parking excess cash securely overnight. Naturally, longer terms or lower quality collateral can yield higher returns, but also higher risk. Thirdly, and this is quite clever, repos allow participants to borrow a security in order to sell it short.
Ah, short selling.
Yes. A hedge fund might use a repo to temporarily borrow a specific security they think is overpriced. They sell it immediately in the cash market. If the price falls as they expect, they buy it back cheaper and return the borrowed security to the repo counterparty, pocketing the difference. This sequence is often called a reverse repo when viewed from the security buyer's, cash lender's, perspective. They're lending cash and getting a security temporarily.
So repo and reverse repo are the same transaction, just different viewpoints.
It's exactly right. Finally, central banks are huge players in the repo market for monetary policy. They use repos for short-term adjustments to influence the money supply and the central bank funds rate. By doing a repo where they lend cash and borrow securities, they inject liquidity. Doing a reverse repo drains liquidity. A great U.S. example is the Federal Reserve's daily overnight repo and reverse repo operations with primary dealers. It's how they manage the Fed funds rate. Also, a U.S. mutual fund might do reverse repos to earn interest on spare cash using treasury bills as collateral. In India, the RBI uses repo auctions under its Liquidity Adjustment Facility, LAF, as a key tool to manage liquidity in the banking system and guide short-term rates. And an Indian hedge fund might borrow specific government securities, or GSECs, through a special repo to execute a short-selling strategy.
So many uses. It's clear they're incredibly versatile. What then determines the actual rate paid on these repo agreements? You mentioned they can even go negative sometimes.
Several factors influence repo rates. Firstly, they track money market interest rates generally. If other short-term rates go up, repo rates tend to follow. Secondly, collateral quality is absolutely key. Riskier collateral, like equities or emerging market bonds, means higher repo rates compared to safer developed market government bonds.
Makes sense. Higher risk, higher rate.
Right. Thirdly, the repo term. Generally, longer terms mean higher rates due to increased credit risk and usually an upward sloping yield curve, though that can invert. Fourthly, collateral uniqueness. High demand for a specific security like a newly issued on-the-run sovereign bond can drive down its special repo rate. If it's really scarce and needed for trading strategies, the rate can even go negative. Lenders might pay to borrow that specific bond.
Wow. Okay.
Lastly, collateral delivery. Under-collateralized or uncollateralized loans usually command higher rates due to the increased risk for the lender.
Even with all these benefits and risk features like margin and haircuts, repos aren't without their risks, right? That Bear Stearns example you mentioned earlier, it looms large.
Absolutely. While secured, repos are definitely not risk-free. And an over-reliance on repo funding, especially in stressed markets, can cause severe distress, even systemic risk. Default risk is the primary exposure.
Despite collateral, liquidating it during a default can be hard if the market is illiquid, prices are crashing, or there are legal hurdles. Collateral risk is about the quality of the collateral itself. It needs to be liquid, low credit risk, and ideally not too correlated with the counterparty's own risk. Margining risk is about getting the valuation right and transferring variation margin promptly. Big market swings can trigger margin calls across the system simultaneously, causing a liquidity squeeze.
A domino effect.
Precisely. Then there's legal risk, enforcing rights under the master repo agreement, and netting and settlement risk, ensuring trades clear efficiently. To manage some complexities, we see bilateral repos just between two parties and tri-party repos. Yes, involving a third-party agent, a custodian bank, or clearinghouse who administers the transaction. Manages cash, securities, collateral valuation, custody. While the tri-party agent doesn't change the underlying credit risk between the two main parties, it boosts efficiency, gives access to bigger collateral pools, and makes trading with multiple counterparties easier.
That's a lot of potential risks, even with the structures. Do we have a real-world example where these risks actually played out catastrophically?
We do, and it's a stark lesson. The fall of Bear Stearns. Bear Stearns was a major U.S. investment bank. Leading up to the GFC in 2007-2008, they relied heavily on short-term funding, especially repos, to finance huge holdings of mortgage-backed securities, MBS.
Okay, I remember this.
As the MBS market tanked, Bear faced huge losses and a credit downgrade. This caused a catastrophic loss of confidence from its repo counterparties. They simply refused to roll over or renew their repo trades, fearing Bear would default. The impact was immediate and brutal. Bear's cash reserves plunged from $18 billion to just $2 billion in 2 days.
2 days. Incredible.
The inability to roll over its short-term repo funding directly caused its collapse and led to an emergency acquisition by J.P. Morgan, brokered by the Fed. What the Bear Stearns case really hammered home is that while repos are individually low risk due to collateral, their systemic importance and short-term rollover nature create immense interconnected liquidity risk. Microprudence leading to macro fragility. For you, the listener, it's a crucial reminder. Repo markets offer liquidity, but their short-term nature can expose even collateralized firms to immense rollover risk when trust evaporates.
Wow, that's a powerful illustration. So interconnected, so fragile. Okay, let's pivot now from the quick turnaround world of short-term funding to the longer horizon. Corporate debt. What drives the choices here? How does credit quality factor in?
Right. Long-term debt provides stable funding not just for onshoring activities, but crucially for significant capital investments, building factories, R&D acquisitions. The choice of long-term debt, its availability, and its cost depend heavily on the issuer's credit quality. We primarily distinguish between investment-grade, IG, and high-yield, HY issuers. Understanding their differences is key. Now, despite these fundamental differences, there are some core similarities between IG and HY long-term issuance in the decision process. Both issuers and investors weigh the risk of different maturities against the cost, the yield to maturity. Under normal market conditions, longer maturities generally mean two things: higher base interest rates, often benchmarked against government yields, and higher credit spreads for a given issuer to compensate for that longer risk horizon.
Okay, longer term, higher rate, higher spread. Makes sense.
From an investor's perspective, longer maturities bring price risk, the risk of selling before maturity. If rates rise and reinvestment risk, the risk that future rates will be lower when you reinvest coupons. From an issuer's perspective, the main concern is rollover risk, having to refinance maturing debt at potentially much higher rates. These trade-offs exist for both IG and HY debt, but they are significantly magnified for high-yield debt due to those inherently higher credit spreads reflecting their greater default risk.
So the core considerations are similar, but the magnification for high yield sounds significant. What are the key distinctions between IG and HY bonds that fundamentally alter their features, issuance strategies, and how investors approach them?
The differences are vast, really shaping the landscape. Let's start with investment-grade IG bonds. For credit quality, IG issuers have a strong capacity to meet payments from operating cash flows, low default likelihood, ratings of BBB or BA3 and higher. Consequently, a big chunk of an IG bond's yield to maturity, YTM, is the government benchmark yield. The credit spread is relatively small.
Reflects the low risk.
Exactly. Regarding issue restrictions, IG bonds typically have very few, if any, restrictive covenants. This gives issuers lots of flexibility. Maturities often go out to 30 years. Their cash flows exhibit bond-like characteristics, high certainty of payment. Attractive for buy-and-hold investors. For analysts, the focus is mainly on monitoring financial ratios and ratings for changes in the likelihood of default. rather than digging deep into probability of default or loss given default, as those are assumed low. Think about, say, BRWA Corporation's senior unsecured notes in the curriculum example. They rely solely on operating cash flows. Restrictions are limited, maybe lien limitations or sale-leaseback limitations, just broad protections for bondholders. In terms of issuance strategy, IG bonds are often standardized. Issuers minimize refinancing risk by staggering debt maturities over time, avoiding a big debt wall. For example, Apple Inc. in the U.S. issues long-term unsecured IG bonds. Very few covenants, reflecting Apple's financial strength and investor confidence. Similarly, Infosys Ltd., investment-grade Indian IT giant, issues unsecured long-term bonds with minimal covenants, offering stability to global investors.
That paints a picture of stability, predictability, low perceived risk. So what's the flip side with high-yield bonds, where the risk profile is notably different?
The picture shifts considerably with high-yield HY bonds, sometimes called junk bonds, though that term can be a bit loaded. Here, credit quality means a higher expected likelihood of financial distress. Ratings below BBB or BA3. Their ability to meet payments is more vulnerable to downturns. As a result, a much higher proportion of HY bonds YTM is the issuer-specific credit spread over the benchmark yield. Investors demand that extra compensation for the higher risk.
Makes sense. Higher risk, higher reward, potentially.
Potentially. For issuer restrictions, investors impose far more constraints. You see extensive detailed debt covenants in bond indentures or loan agreements. These covenants allow lenders to closely monitor financial performance tracking ratios like debt to EBITDA, interest coverage, maybe limiting spending. If the company breaches covenants, lenders can take action, demand faster repayment, renegotiate, etc. Injure protect creditors.
More guardrails in place.
Many more. HY cash flows are considered more equity-like due to their uncertainty. They're riskier, requiring a different analytical lens. The analytical approach for HY bonds places much greater emphasis on the probability of default, the potential loss given default, how much you lose if they default, and crucially on secondary repayment sources, collateral, guarantees, asset pledges. Take the VIVU Corporation example. Their callable bonds might be secured, with specific assets pledged. The indenture would detail covenants limits on more debt, required financial ratios, maybe dividend restrictions to keep cash in the company. In terms of issuance strategy, HY issuers face less market access and flexibility. Maturities are typically shorter, often 10 years or less. They're much more sensitive to economic cycles. These firms often find themselves needing to restructure debt or renegotiate covenants. They might use leveraged loans with prepayment options or callable bonds, hoping improved creditworthiness lets them refinance cheaper later. A very important exception here are fallen angels.
Fallen angels sounds dramatic.
It refers to formerly investment-grade issuers whose credit quality deteriorates to high-yield status. What's unique is their outstanding debt still has the old IG features, maybe non-callable, few restrictions, long maturities, because it was issued when they were highly rated. The credit deterioration causes big losses for original investors. Many are forced to sell because the bonds no longer meet their rating mandates. This forced selling into the smaller, less liquid HY market can cause significant price drops.
So good features, bad credit rating, forced selling. Interesting dynamic.
Very much so. For a typical HY issuer example, think of a U.S. shale oil company, volatile prices, high debt. They might issue HY bonds with extensive covenants limiting spending, requiring certain coverage ratios to protect investors. In India, a smaller real estate developer might issue secured non-convertible debentures, NCDs, with high yield characteristics. Strict covenants on asset pledges and debt-to-equity ratios would be common, given the risks in that sector.
Wow, that was a truly comprehensive deep dive into the corporate fixed income universe. We've covered a tremendous amount of ground today, really revealing the calculus behind corporate funding.
Indeed. We've certainly covered a lot today for your CFA Level I 2025 Fixed Income, Volume 6, Module 04, Fixed Income Markets for Corporate Issuers. We explored short-term funding needs for both non-financial core and financial institutions. Everything from uncommitted and committed bank lines, revolvers, to commercial paper, and the specific tools for banks like deposits, interbank markets, and that complex ABCP structure.
And we really got into the weeds with repurchase agreements, the mechanics, the applications, the critical risks, including that compelling real-world lesson from Bear Stearns, showed us how systemic risk can pop up.
It really did.
Plus, we drew that clear, nuanced distinction between investment-grade and high-yield long-term debt, highlighting how credit quality just profoundly shapes everything: features, protections, analysis.
That wraps up Module 04, Fixed Income Markets for Corporate Issuers. Next, we'll dive into Module 05, fixed income markets for government issuers. We'll explore how sovereign entities, with their unique powers and constraints, finance their operations. Different world altogether.
Absolutely. As you continue your studies, think about how these varying funding mechanisms don't just support daily operations. They profoundly reflect a company's creditworthiness, its strategic choices, impacting risk and return for investors. What stands out to you about how companies choose to fund themselves? And how might that choice signal their health or maybe their future intentions to the market? Something to think about.
Definitely. We look forward to exploring more with you in our next deep dive.
Welcome, curious minds, to another deep dive. This is your essential shortcut for navigating the complex, but yeah, incredibly rewarding world of finance.
Glad to be here.
Today, we're embarking on a really critical segment of the CFA Level I-2025 Fixed Income Curriculum, Volume 6.
That's right.
We're digging into Module 05, Fixed Income Markets for Government Issuers. Now, this is absolutely foundational. I mean, government debt, especially sovereign debt, it isn't just another asset class, is it?
Not at all. It's often the benchmark, the measuring stick, really, against which much of the financial world evaluates risk.
Exactly.
And our mission today, if you like, is to cut through any perceived complexity around this. We'll be navigating the varied landscape of sovereign, non-sovereign, quasi-government entities, and also supranational debt. Our goal isn't just to, list these different types of issuers, is to really grasp why these markets operate so distinctly.
Right. What makes them tick?
Precisely. And what makes them such crucial, almost indispensable components of the global financial landscape.
Yeah.
We'll uncover not just what these instruments are, but why their issuance and trading mechanisms are so unique. And that has profound real-world implications for investors and economies alike.
That's a great setup. Okay, so before we dive headfirst into today's material, we always like to give you a quick peek at what's coming up next.
Good idea.
So once we've thoroughly explored the intricacies of government fixed income markets today, we'll seamlessly transition into Module 06, and that's where we'll embark on fixed income bond valuation, prices, and yields.
Putting numbers on it.
Exactly. That's where we take all this foundational knowledge we're building today and start putting a precise number on these instruments, understanding how to price them, what their yields truly represent. It's the practical application, really.
Makes sense. Connects the dots.
Okay, so let's begin at the very beginning, laying the groundwork for understanding these public sector issuers.
Right.
When we talk about debt, the broadest category, maybe the most familiar, and certainly the one with the most power, is sovereign governments.
The top level.
Yeah. What fundamentally sets a sovereign government apart is its unique legal authority, isn't it? Can you maybe elaborate on that inherent power and how it underpins their ability to issue debt?
Absolutely. A sovereign government possesses this inherent right, this power, to tax economic activity within its jurisdiction. And this isn't just, a revenue source. It's really a foundational power. It grants them immense creditworthiness.
The ultimate backstop.
Pretty much.
Yeah.
And with that power comes the responsibility to establish and maintain a country's public goods and services. Think national defense, education systems, essential infrastructure like roads, ports, public health care.
The core functions.
Exactly. These are the core functions they fund. And that taxing power is the ultimate backstop for their debt.
And it's not just taxes, right? I mean, taxes are the bedrock, sure, but sovereign governments also have other significant revenue streams that support their debt obligations.
That's true.
Could you give us a sense of what those might be?
Indeed. While broad-based taxes from, citizens and corporations form the bulk, they can also include things like tariffs on imported goods.
Okay.
Usage fees for specific government services, like, say, a fee to access a national park or specific administrative services. And importantly, in many countries, there are significant cash flows generated from various government-owned enterprises.
State-owned company.
Right,
Yeah.
which can range from state-run utilities and transportation networks to national airlines or even mining operations. These diverse, often quite predictable revenue streams underpin their ability to consistently meet their debt obligations.
That's a critical point. Okay,
Right.
so what's fascinating here is that while all these national or sovereign government issuers share this fundamental authority, there's actually a significant spectrum within that category.
Definitely.
You often hear about DM and EM sovereigns. Can you break down the distinctions between developed market DM sovereigns and emerging market EM sovereigns? And, why are those differences so crucial for an investor to understand?
Yeah, that's a profoundly important distinction. It really shapes the entire risk-return profile of their debt. Let's start with developed market DM sovereigns.
Okay.
These are typically characterized by strong, stable, and incredibly well-diversified domestic economies. Think US, Germany, Japan, UK, that sort of thing. When we look at their fiscal policy, it's generally consistent. They have recurrent government outlays, mainly financed by broad-based, deep tax cash flows from a really wide array of individuals and businesses.
So predictable.
Exactly. This leads to what is usually a very stable, predictable, and transparent fiscal policy environment. And crucially, DM sovereign fixed income securities are almost always denominated in a major reserve currency.
It's like the US dollar, euro, yen.
Precisely. Currencies that are commonly held in reserve by foreign governments and central banks globally. These characteristics altogether allow DM sovereign governments to issue what's often referred to as default risk-free debt.
Or at least very low risk.
Right. The lowest perceived default risk. This gives them basically unconstrained access to capital markets across the entire maturity spectrum, from very short-term treasury bills to long-dated bonds, often at exceptionally low borrowing costs.
Okay, so stable economies, diversified revenue, global reserve currency, those are the hallmarks. What about the other side of that coin, the emerging market, EM sovereigns?
Right. In stark contrast, EM sovereigns are usually characterized by, well, higher growth potential, which is certainly attractive,
Yeah, the upside.
but also by less stable and less well-diversified economies. They're inherently more subject to greater fluctuations over the economic cycle.
More volatility.
Exactly. Often an EM economy might be heavily dependent on a dominant domestic industry, like commodities. Think of nations whose economies are heavily tied to oil or copper or maybe agricultural exports. There might also be a greater involvement of state-owned or state-controlled enterprises in their economic structure, which can introduce different governance and efficiency challenges sometimes. Central government budget priorities in these markets frequently involve significant investments to expand economic and social infrastructure. Things like new ports, highways, power grids, or digital networks.
Big projects.
Big projects. However, these infrastructure needs often exceed their current domestic tax cash flows,
Right, so they need outside funding.
which gives rise to a greater reliance on external or supranational funding. Furthermore, EM sovereign debt securities are often denominated in a restricted domestic currency,
Meaning?
meaning one with limited convertibility into other major currencies, perhaps due to illiquidity or capital controls. This currency restriction can limit foreign investment and constrain their access to longer-term maturities in domestic currency markets.
That's a significant set of challenges. And, for many of our listeners, especially those in Asia, the situation in countries like India offers a direct parallel here. How does India, as an emerging market, fit into this framework?
That's an excellent question. Take India, for instance. As a rapidly growing emerging market, it's actively striving to diversify its economic base beyond just, say, a few dominant industries.
Mm-hmm.
The government is working hard to attract more foreign investment and continues to build out robust infrastructure. Now, the credit quality and stability of its sovereign debt, its GSECs, government securities as they're known in India, are directly tied to its ability to expand its tax base, manage its budget effectively, and ensure continued economic growth.
So it's all connected.
Absolutely. While India has a large and growing domestic investor base for its sovereign debt, the quest for broader economic diversification and attracting foreign investment is an ongoing journey. And that fundamentally impacts its debt profile, distinguishing it from, say, highly diversified developed markets. It's a classic EM balancing act, really growth potential versus managing inherent volatilities.
Okay, this brings us to a really crucial distinction you mentioned. External debt, especially when it's denominated in a foreign currency.
Right.
For EM sovereigns, this isn't just an accounting entry. It can literally be a matter of national solvency. What does external debt truly mean, and why is that foreign currency denomination such a potential trap?
Yeah, that's a profoundly important question. External debt, in simple terms, is debt that a sovereign government owes to foreign creditors.
Outside the country.
Exactly. These creditors can be other sovereign nations, large supranational organizations like the World Bank or the IMF, or even foreign private investors. The key factor and the potential trap is that this debt is often denominated in a foreign currency, like the US dollar or the euro. These are often structured as Eurobonds, which, just to clarify, are bonds issued by an entity outside the jurisdiction of the currency in which the bond is denominated. So a Sri Lankan bond denominated in USD is a Eurodollar bond.
Got it. And this brings us to a compelling, if, well, sobering, real-life example that vividly illustrates this risk. The Sri Lankan external debt crisis back in May 2022. Can you walk us through the details and the profound implications for investors?
Yeah, the Sri Lankan crisis serves as a really stark warning. In May 2022, Sri Lanka became the first Asia-Pacific country in decades to actually default on its external debt.
Wow.
They failed to make a USD 78 million foreign currency interest payment after a 30-day grace period. Now, the roots of this crisis were deep. A sharp rise in government debt, soaring from about 87% of Sri Lanka's GDP to over 100% by 2020.
That's a huge jump.
Huge. This increase was largely due to ambitious infrastructure projects, many of which were financed by, well, global debt markets, supranational agencies, and major trading partners. Then the situation was really exacerbated by severe external shocks. The Sri Lankan economy and its foreign currency reserves shrank significantly. This was primarily due to a collapse in tourism, a major foreign currency earner for the island nation.
Right, COVID hit that hard.
Exactly. And also a decline in remittances from citizens working abroad, adding fuel to the fire. Global inflation and soaring commodity prices, especially in the wake of the 2022 war in Ukraine, severely impacted the country's ability to import essential goods and, crucially, meet its foreign currency debt obligations. Ultimately, that led to the default.
And who were the creditors? Who was holding this debt?
Looking at their creditors back in 2021, it was a diverse group. A substantial 47% was market debt, mostly international sovereign bonds denominated in U.S. dollars and held by foreign private investors, including mutual funds.
Okay.
The Asian Development Bank, or ADB, held 13%. China and Japan each held about 10%. The World Bank held 9%. And India, an important regional partner, held about 2%. The profound implication for investors is this. Even if you're buying a dollar-denominated bond from an EM sovereign, you still face indirect exposure to currency fluctuations.
Because the government has to earn those dollars.
Precisely. Your returns fundamentally depend on the issuer's ability to generate sufficient foreign currency revenue through international trade, services, tourism, capital flows to meet those foreign currency interest and principal payments.
Yeah.
The government can't just print U.S. dollars to pay U.S. dollar debt. It has to earn them or borrow more of them.
That Sri Lankan example really drives home those unique risks. It's not just about the government's overall financial health, but its specific capacity to earn or acquire the foreign currency needed for its debt obligations. That's a fundamental difference compared to, say, the U.S. issuing debt in U.S. dollars.
Exactly right. Beyond these critical distinctions, sovereign governments issue a range of other fixed income securities too.
Right, it's not all the same.
No.
Yeah.
These include short-term securities, often called treasury bills or T-bills. They typically have maturities ranging from, say, 1 to 12 months. These are almost always zero-coupon instruments.
Meaning they're sold at a discount.
Correct. Sold at a discount to their par value and mature at par. Then we have medium and long-term securities, more commonly known as treasury notes and bonds. The most prevalent of these are fixed-rate coupon instruments denominated in the domestic currency. However, sovereigns also diversify. They issue floating-rate instruments where the coupon adjusts periodically based on some benchmark rate. They issue inflation-linked bonds, which protect investors against purchasing power erosion by linking principal and/or coupon payments to an inflation index.
Like TPS in the U.S.
Exactly, like TPS. And, of course, they issue foreign currency instruments, as we just discussed with EM external debt.
So it's not just plain vanilla fixed-rate bonds. There's a whole array of tools in the sovereign debt toolbox. And I understand it's not just direct issuance either. Sovereign governments can also effectively take on debt by guaranteeing other instruments, correct?
That's right. Some sovereign governments also effectively take on debt by guaranteeing other instruments. While they aren't the direct issuer, their guarantee makes these instruments function very similarly to sovereign debt in terms of credit quality.
Ah, okay.
The most prominent example, especially in the United States, is certain mortgage-backed securities that conform to specific criteria set by government agencies.
Like Ginnie Mae.
Ginnie Mae is a perfect example. The government's backing on these makes them implicitly a form of sovereign debt, enjoying a very high credit standing because of that guarantee. We'll definitely delve into this much deeper in later modules on securitization.
Right.
But yeah, it's a way for the government to leverage its credit to support specific sectors or initiatives, like housing.
Okay, that was an excellent foundation on the what and who. Now, let's pivot from what sovereign debt is and who issues it to the strategic side. How do governments actually decide how much debt to take on, and maybe even more importantly, what kind of debt it should be? It seems like it must be a sophisticated financial strategy involving maybe two distinct but related policy areas.
Indeed. This is where the art and science truly comes into play. First, we have fiscal policy. This primarily determines the level of sovereign debt.
The total amount.
Exactly. It's all about the central government spending relative to its revenue sources, which, as we discussed, come from tax receipts, various fees, and cash flows from government-owned enterprises. When government spending, including the cost of servicing existing debt, consistently exceeds its revenues, you get a budget deficit,
Which means more borrowing.
which naturally increases the need for borrowing and thus increases the overall level of sovereign debt. Conversely, a budget surplus reduces borrowing needs. So fiscal policy sets the aggregate demand for financing. Second, though, we have government debt management policies. These policies address the composition of sovereign debt.
So not how much, but what kind.
Precisely. This is where decisions are made about the maturity structure, whether to issue more short-term versus long-term debt, and also other features, like whether the debt will be fixed rate, floating rate, or inflation-linked, and in what currency. So if fiscal policy decides the how much, debt management policy carefully considers the what kind and when, aiming to balance costs, risks, and market stability.
What's fascinating here, I think, is how economic theory often seems to bump up against real-world constraints when it comes to government debt. Like you hear about the Ricardian equivalence theorem, for instance. Can you explain that theory and then maybe tell us where reality tends to diverge from it?
Absolutely. In theory, we have the Ricardian equivalence theorem. It suggests that under a very specific set of, let's say, ideal conditions, a government's choice of debt maturity is actually irrelevant to future tax cash flows.
Irrelevant. How so?
Well, the core idea is that taxpayers are incredibly rational. They anticipate that any government debt issued today will eventually need to be paid off through higher future taxes. Therefore, they would theoretically save any current tax cuts to offset those future tax increases, effectively neutralizing the impact of government debt on consumption and investment.
So people see a tax cut today, no taxes will rise later and save the difference.
That's the theoretical idea. It's a bit like that perfectly rational friend we all wish we had, but who probably doesn't exist in the real world, right?
Right. Seems like a big assumption.
It is. This theorem rests on some rather strong assumptions, like taxpayers can perfectly smooth their consumption over time, that they form rational expectations, understanding today's tax cuts mean future tax hikes. The capital markets are perfect, no transaction costs, taxpayers can borrow and lend freely, and even, rather altruistically, that taxpayers pass on tax savings to their descendants, accounting for intergenerational obligations.
Wow, okay. That's a lot of ifs.
Exactly. In practice, of course, these assumptions rarely hold true. Capital markets are imperfect, there are friction costs between bond investors and taxpayers, and people generally don't act with perfect intergenerational altruism or always form perfectly rational expectations. We're all, a bit more short-sighted and less perfectly rational than Ricardian equivalence assumes.
So the real world is messy. And that's precisely why governments can't just operate on theory alone. And I believe that leads us directly to the concept of rollover risk. What is that, and why is it such a central concern for governments in the real world?
Precisely. The fact that these ideal Ricardian assumptions don't hold is exactly why thoughtful government debt management policies are needed. When a government relies too heavily on short-term funding, it introduces a significant danger known as rollover risk.
Meaning they have to keep borrowing again and again?
Exactly. It means the government must frequently refinance its debt, often within a year. This frequent refinancing exposes the government to uncertain borrowing costs. If interest rates spike when they need to refinance,
Their budget gets hit hard.
exactly, their budget suddenly becomes much more expensive to manage. This increases the variability of its budget costs and consequently future tax rates. And since real-world taxpayers aren't perfectly smoothing consumption or thinking generations ahead, this fiscal instability creates uncertainty about future taxes and can genuinely threaten the stability of economic growth over time.
So it's about predictability.
Right. Therefore, in practice, governments strategically seek to minimize both interest rate risk, the risk rates will rise, and make borrowing costlier and rollover risk. They do this by thoughtfully distributing their debt across various maturities. They also aim to issue debt at regular, predictable intervals. This approach promotes greater fiscal stability and predictability, which is beneficial for both the government and the broader economy. And we can clearly see the stability of this practical approach through data. While fiscal policies can differ wildly across, say, the 38 OECD member countries, their sovereign debt maturity structures have shown far less variance over time.
Really? Even through crises?
Yeah. For example, at the end of 2021, long-term debt accounted for an impressive 85% of total sovereign debt outstanding across OECD nations. And that figure has remained largely unchanged since 2007, a period that included, the global financial crisis and the Eurozone debt crisis, leading to significant sovereign debt issuance. This clearly demonstrates a consistent practical approach to managing debt composition, prioritizing stability over maybe theoretical short-term cost minimization, even through turbulent economic cycles.
So this isn't just about government balance sheets, then. It sounds like it's the very scaffolding of the global financial system. Why is having a sufficient mix of short and long-term sovereign debt so profoundly beneficial, even if maybe the longer-term debt costs a bit more? What are the ripple effects for the broader financial system?
That's the core insight, really. It's the bedrock upon which vast swaths of the modern financial system function efficiently. Without these predictable, liquid benchmarks, pricing risk across all asset classes would be infinitely harder and market efficiency would plummet. Here are the key benefits. First, risk-free benchmark. One of the most critical benefits is establishing a risk-free benchmark for debt of specific maturities, because national governments, especially in developed markets issuing in their own currency, represent the lowest default risk. Theoretically, yes. Their bond yields are universally used to calculate the credit risk premiums for virtually all other issuers, corporate, municipal, agency, you name it. Government debt policies often actually mandate the regular issuance of benchmark securities across a range of maturities, specifically to enhance capital market efficiency and transparency for private sector issuers. This predictability allows everyone else to price their own risk relative to a known baseline.
Okay, that's huge. What else?
Second, managing hedging interest rate risk. These securities are extensively used in managing and hedging market interest rate risk. Market participants like financial intermediaries, large asset managers, they rely on medium to long-term government securities and related derivatives like futures and swaps.
To manage their exposure.
Exactly. They use these tools to manage their exposure to interest rate fluctuations entirely separately from their exposure to credit risk. This ability to isolate interest rate risk is fundamental to modern portfolio management and risk management strategies. Third, preferred collateral. They are the preferred use as collateral in repo and derivative transactions. Longer-term government securities are the most common form of collateral in these crucial markets.
Why is that?
It's due to their exceptionally high degree of liquidity and safety. Remember from earlier modules, repurchase agreements or repos offer security sellers a way to finance their positions short-term, while offering security buyers a short-term, collateralized investment with very little liquidity or default risk. Government bonds are the absolute workhorses of this market, underpinning huge amounts of daily financial activity.
Okay, benchmark, hedging, collateral. Anything else?
Yes. Fourth, monetary policy and foreign exchange reserves. Government bonds are indispensable in monetary policy and foreign exchange reserves management. Central banks, as we know, actively use government securities in fulfilling their monetary policy mandate.
Open market operations.
Right. Outright purchases and sales of securities and open market operations to influence money supply and interest rates. They also use government bonds as collateral in repo contracts with banks. And given their high liquidity and safety, foreign market participants, particularly other central banks, often hold their foreign currency reserves in the form of liquid foreign government bonds.
Like holding U.S. treasuries for dollar reserve.
Exactly. The U.S. dollar holds this role globally for a vast number of nations, meaning the demand for U.S. treasuries extends far beyond purely domestic economic needs.
That's a comprehensive overview of their systemic importance. And we can see these debt management policies adapt in real time to fiscal needs and market conditions. Can you give us maybe a concrete example of this dynamism from a major market?
Certainly. A very concrete example is the U.S. Treasury's 30-year bond.
The long bond.
The long bond. Back in October 2001, the United States actually stopped issuing 30-year Treasury bonds.
Why did they do that?
Well, the decision was driven partly by cost concerns, paying interest for 30 years. And at the time, Treasury officials perceived a reduced need for future borrowing because the U.S. government was actually posting a budget surplus. Remember those days?
Vaguely.
This move genuinely stunned the markets. It resulted in one of the largest one-day price movements in years for long-term bonds due to immediate concerns about the scarcity of supply for such a crucial benchmark. Before this, the Treasury had also suspended its 3- and 7-year issues. During the suspension of the 30-year bond, The 10-year Treasury note essentially became the de facto benchmark for long-term bonds. Then, fast forward to February 2006, and the issuance of the 30-year U.S. Treasury bond resumed.
Wow, the change of heart.
Because deficits had reemerged, largely created by tax cuts and the significant spending associated with ongoing wars in Afghanistan and Iraq. This whole historical episode clearly illustrates how government debt management policies are dynamic. They adapt to both fiscal needs, surpluses or deficits, and evolving market conditions, even if those adaptations cause some temporary market disruption. It shows that continuous balancing act between cost efficiency, market demand, and strategic fiscal goals.
That brings us to a fascinating, maybe even a paradox. If a sovereign government, especially one with its own reserve currency, can technically just print more money.
The magic money tree idea.
Right. Why is there such meticulous focus on the composition and the cost of its debt, trying to avoid things like rollover risk? It almost seems like they have an ultimate backstop. What are the deeper implications of managing this delicate balance, even for the most powerful issuers like the U.S.?
That's an excellent point, and it really touches upon a core misunderstanding for many people. While a government issuing debt in its own currency can technically always pay its debts by creating more money.
Right, they can't technically default in their own currency.
Correct. But that backstop comes at a very real, potentially catastrophic economic cost. It's the crucial difference between solvency, the technical ability to pay, and stability, the ability to pay, without triggering massive inflation, currency devaluation, or a complete loss of market confidence, both domestically and internationally.
Ah, so it's about the consequences.
Absolutely. Imagine the chaos if the U.S. Treasury just started printing trillions of dollars every time a bond matured to pay it off.
Yeah.
Investors would flee, the dollar's value would plummet, inflation would skyrocket, and its global standing would collapse. So debt management isn't really about avoiding a technical inability to pay. It's about avoiding the catastrophic consequences of mismanagement that would severely harm the economy, its citizens, and its role in the world. It's fundamentally about maintaining trust, stability, and the purchasing power of the currency.
So it's less about the technical ability to print and much more about maintaining credibility and preventing, well, economic self-sabotage. That really reframes the whole default risk-free concept, doesn't it?
It certainly adds a very important layer of nuance, yes.
Okay. With that clear understanding of what government debt is and why it's issued with such care, let's now turn our attention to the mechanics. How does this debt actually get from the government to investors? Because this process is quite distinct from how, say, corporate bonds typically hit the market, right?
Indeed. It's a very different process. In contrast to corporate debt, which is often managed by investment bank underwriters acting on behalf of the issuer, often in a somewhat opportunistic fashion depending on market conditions.
Trying to time the market.
Exactly. Sovereign debt issuance usually takes the form of a public auction. These auctions are led directly by the National Treasury or the Finance Ministry. This makes the process much more standardized, transparent, and regular.
Predictable intervals.
Generally, yes. And a crucial element in this system is the role of primary dealers.
Ah, yes, the big banks usually.
Typically large banks and securities firms, yes. They are a designated group of financial intermediaries selected by the government, and they are required to participate in all government debt auctions by submitting competitive prices or bids.
They have to bid.
They have an obligation to bid. This ensures broad participation and helps guarantee liquidity for the government's issuance. Beyond auctions, they also serve as key counterparties for the central bank in its open market operations, and they facilitate the purchase and sale of government debt by foreign central banks and other indirect bidders. They really are a critical piece of infrastructure for government borrowing.
That makes sense. Okay, so what's fascinating here is the transparency and structure of these government debt auctions, which seem meticulously designed for broad distribution and efficient price discovery. Once an auction is announced, how do prospective investors actually place their bids? What are the options?
Right. Once an auction is announced, prospective investors can submit two main types of bids. First, we have competitive bids. Here, investors specify both an acceptable price, or more commonly a yield, and the quantity of securities they wish to purchase. If the price determined at the auction ends up being above their bid price, meaning the yield determined is lower than the minimum yield they're willing to accept, then that competitive bidder simply will not be offered any securities. They effectively price themselves out.
Okay, they name their price. What's the other type?
Second, there are non-competitive bids. These investors agree in advance to accept the price or yield that is determined at the auction, whatever it turns out to be.
They just want the bonds, regardless of the exact price.
Essentially, yes, up to a certain maximum amount per bidder, typically. The advantage for them is that they are guaranteed to receive the securities they bid for without having to worry about bidding too aggressively or too cautiously and missing out. This encourages broader participation, especially from smaller investors or those who prioritize certainty of allocation over hitting a specific price target.
Okay, so within those competitive bids, I understand there are two primary auction types governments use: single price and multiple price. Can you detail the difference between those?
Absolutely. The single price auction, which is also sometimes called a uniform price auction or a Dutch auction.
Lots of names.
Yeah, finance loves jargon. But the mechanism is the issuer ranks all the competitive bids received from the highest price, which corresponds to the lowest yield, down to the lowest price, highest yield. They go down this list until the desired issuance amount is fully met. The highest yield among those accepted bids, the one that just clears the auction amount, is known as the cutoff yield or stop yield. This is effectively the highest yield the government is willing to pay to borrow that specific amount of money in that auction.
Okay.
Then, all winning bidders, both the competitive ones who bid at or below the stop yield and all the non-competitive bidders, pay the same single price derived from that stop yield. And thus they receive the same coupon rate for the bonds, regardless of what their individual bid price might have been.
So even if I bid a really low yield, I still get the higher stop yield.
Correct.
Yeah.
You benefit if the stop yield is higher than your bid. The advantages of this approach are that it may result in a lower overall cost of funds for the government, because bidders might bid more aggressively knowing they won't be stuck paying a much higher price than others. And it often leads to a broader distribution of the bonds among investors.
Okay, that makes sense. What about the other one, the multiple price auction?
In contrast, a multiple price auction process, sometimes called a discriminatory auction, generates different prices among bidders for the exact same bond issue. Here, while the bids are still ranked by price from highest to lowest,
Same ranking.
but each winning competitive bidder pays their own bid price. So if you bid a higher price, meaning a lower yield, you pay that higher price.
Hmm.
Someone else who bid a slightly lower price, higher yield, but still within the winning range, pays their lower price.
Seems less fair somehow.
Well, the main disadvantage often cited is that it can sometimes result in a narrower distribution, maybe concentrated among fewer large bidders. Investors might be more cautious with their bids because they want to avoid paying a significantly higher price than others for the same bond, a phenomenon known as the winner's curse.
Right. You win the auction but feel like you overpaid.
Exactly. So many major sovereign issuers, like the U.S. Treasury, now predominantly use the single price method for most of their auctions. And typically, a single price auction process unfolds in 4 distinct phases.
Okay. What are they?
1. The announcement. The Government Debt Management Office officially announces the auction, details the amount, type of security, auction date, issue date, maturity date, bidding times, all the key info. 2. Bidding. During the specified window, primary dealers, institutional investors, sometimes individuals via intermediaries, submit their competitive or non-competitive bids. 3. Acceptance and pricing. All the non-competitive bids are accepted first. Then, the competitive bids are ranked by yield, lowest yield, highest price, first. The issuer works down the list until the total amount needed is reached. The yield of the last accepted competitive bid becomes the stop yield. All securities are then sold at the single price corresponding to this stop yield. Competitive bidders who bid a higher yield, lower price than the stop get nothing. The results are announced publicly pretty quickly. And 4, delivery. Finally, the securities are delivered to the non-competitive bidders and all the winning competitive bidders, usually electronically, in exchange for payment of the proceeds.
Okay, that's very clear. To bring this to life, let's look at some real-world examples of how these auctions actually play out. First, maybe a global example. The Singapore government bond auction that took place back on September 8, 2021.
Right. The Monetary Authority of Singapore, their central bank, announced an option of SGD 2.6 billion Singapore dollars of 30-year Singapore government bonds.
Long maturity.
Very long. This was specifically stated as a uniform price auction, so single price. Bids had to be submitted through primary dealers, and the auction attracted strong demand bids totaled SGD 4.1 billion, which was over 1.5 times the amount actually offered.
Good sign for Singapore.
Definitely. The results, announced later that day, showed a cutoff yield of 1.95% per annum, and the bond's coupon rate was then rounded down to the nearest 0.18%, as is common practice, resulting in a 1.875% per annum coupon. So a classic illustration of a transparent, well-subscribed single-price auction process, achieving borrowing for the government efficiently.
Okay. And for an example maybe closer to home for many of our listeners, let's look at India. In July 2021, the Reserve Bank of India, RBI, made a pretty significant shift in its government bond auction strategy. Can you explain what happened there and why it was important?
Yes, this was a very significant move for the Indian GSEC market. The RBI shifted from multiple price to single price auctions for a whole range of maturities. Specifically, its 2-year, 3-year, 5-year, 10-year, and 14-year bonds, as well as its floating rate bonds.
So most of the curve?
Most of the main benchmarks, yes. Interestingly, their very long-dated bonds, the 30-year and 40-year bonds, continue to be auctioned via the multiple price method, perhaps reflecting a different, more specialized investor base for those ultra-long durations.
Why the change for the others?
Well, this change wasn't just an arbitrary tweak. The RBI adopted this new methodology after facing several partially failed auctions under the multiple price system.
Meaning they didn't sell all the bonds they wanted to.
Exactly. Bidders were perhaps being too conservative, maybe worried about that winner's curse, leading to undersubscription. The rationale for the shift was clear. With a single price option, as we discussed, volatility in yields tends to be reduced because all successful bidders get the same rate. This promotes greater stability and predictability in the market.
Which is good for everyone.
Especially important for a large developing economy like India, looking to manage its sovereign debt effectively and attract broad, consistent participation. It was really a pragmatic response to observed market challenges.
Okay, stepping back to see the broader implications again. Once these bonds are issued via auction, their trading environment also has some unique characteristics, right? Especially compared to corporate bonds. How do these government bonds trade, and what defines their liquidity?
Right. Once issued, the trading environment is also distinct. While sovereign debt is usually traded in a manner similar to private sector debt, primarily in OTC, over-the-counter markets, through financial intermediary broker-dealers, some markets, like Australia, do utilize exchanges for trading government bonds more heavily. The sovereign issuer is almost always the largest single borrower in its domestic market, and its securities are typically the most liquid among all fixed income instruments in that currency.
That makes sense.
Within this trading landscape, we make a key distinction between on-the-run securities and off-the-run securities.
Okay, what's the difference?
On-the-run securities are the most recently issued sovereign debt securities for a given maturity, the newest 10-year bond, for example. They are highly liquid, actively traded, and are almost universally used for benchmark yield analyses because their constant trading provides the most up-to-date and reliable market pricing.
They reflect current market sentiment.
Exactly. Off-the-run securities, conversely, are all the previously issued bonds of that same maturity that are still outstanding. They tend to be less liquid and trade less frequently. They're often held in longer-term portfolios or used for specific hedging needs where that exact bond's characteristics are required. But for general market tracking, everyone watches the on-the-run issues. And given the immense liquidity of on-the-run securities, particularly in major developed markets, a lot of their trading now occurs electronically on centralized marketplaces operated by private companies, further enhancing efficiency and transparency.
Now, you mentioned earlier something really interesting. A significant and distinct difference in trading between sovereign and corporate debt lies in the presence of investors with varying non-economic objectives. This is a fascinating aspect. Can you explain who these non-economic investors are and why they're so important for sovereign debt markets?
Yes, this is a critical point, and it fundamentally alters the traditional supply and demand dynamics you might expect. Non-economic objectives refer to investors who hold sovereign bonds not purely for their expected financial return in a typical risk-reward calculation.
Not just trying to maximize profit.
Not purely, no. They hold them for other strategic, regulatory, or mandated reasons. For example, let's take the U.S. context. Major investors in U.S. Treasuries include the Federal Reserve itself. The Fed uses Treasuries extensively in conducting monetary policy through open market operations.
Buying and selling treasuries to influence rates.
Exactly. Then you have major foreign governments and central banks holding U.S. Treasuries as their primary U.S. dollar reserves, which are vital for international trade settlements and financial stability. Domestically, state and local governments in the U.S. often face strict investment restrictions that mandate holding very safe assets, making treasuries a natural choice. And finally, banks and insurance companies are often either required by regulation to hold treasuries for liquidity or capital adequacy purposes or are heavily incentivized to do so.
So a lot of forced buyers, in a way.
or at least buyers with motivations beyond just yield. The impact of these non-economic objectives is profound. It significantly reduces sovereign borrowing costs compared to what the private sector would have to pay for similar risk. This effect is most pronounced for sovereign issuers with a reserve currency,
Like the US dollar.
like the US dollar, which is, of course, the dominant reserve currency. It accounts for approximately 60% of global foreign exchange reserves and is involved in nearly 90% of all FX market transactions. Other prominent reserve currencies include the euro, Japanese yen, British pound, Swiss franc, Australian dollar, and increasingly the Chinese renminbi, each playing varying but important roles. The intrinsic, often mandated demand from these non-economic players creates a sort of permanent bid for reserve currency sovereign debt. It offers a unique advantage to those issuers.
That's a huge structural advantage.
It really is. The profound takeaway here for you as an investor is that in certain segments of the sovereign debt market, particularly reserve currencies, traditional supply and demand mechanics are significantly altered. You're not just investing in an asset based on its standalone risk return. You're often investing into a global financial utility where a large chunk of demand isn't purely driven by risk-adjusted return, but by systemic necessity, regulation, and policy.
This raises an important question then. Given this immense, almost structural demand for sovereign debt from these non-economic players, how much does traditional supply and demand really dictate pricing, especially for reserve currencies like the US dollar? Does this unique dynamic fundamentally alter the economics of these markets, making them operate under a different set of rules compared to other fixed income instruments?
It absolutely does alter the economics, and this is a key insight. While supply and demand in the broadest sense always play a role for reserve currency sovereign debt, they operate within a unique framework. The non-economic demand creates a higher, more stable baseline bid for these securities.
Putting a floor under the price.
Effectively, yes. It puts a floor under their prices and helps keep yields lower than they might otherwise be, based purely on, say, the country's fiscal metrics alone. This means that even if a country's budget deficit is large, or its debt-to-GDP ratio is high, factors that would normally push yields up significantly for a corporate or even a non-reserve currency sovereign, the systemic demand from central banks needing reserves or financial institutions needing regulatory liquidity can keep those yields relatively low.
So they can borrow more cheaply than fundamentals might suggest.
Often, yes. It allows these governments to borrow at rates that would be unimaginable for a corporate entity or even many other governments with a similar financial profile. So yes, the economics are fundamentally altered. It's a market driven as much by policy, regulation, and global financial architecture as it is by pure risk-adjusted return calculations. It truly operates under a different rulebook in many respects.
Okay, now that we've thoroughly explored the world of sovereign debt, let's expand our view a bit. Because while sovereign debt is foundational, the public sector is far more diverse than just national governments, isn't it?
Absolutely.
There's a whole world of other public sector entities that issue fixed income instruments, and their funding choices seem incredibly diverse, reflecting their varied roles and revenue structures. We're talking about non-sovereign governments, quasi-government entities, often called agencies, and these big international bodies, supranational organizations.
That's right. The level and type of funding these different entities require can vary widely, even within the same country, but especially across different countries. It fundamentally depends on how specific public goods and services are structured. Are they provided and financed at the national level, the regional level, or the local level? And their ability to meet their debt obligations also differs significantly because they rely on distinct revenue sources. It could be local taxes, specific user fees from a service they provide, or maybe direct budget allocations from the national government. The predictability and stability of these revenue sources are naturally key determinants of their credit quality and their ability to access funding across various maturities.
What seems fascinating here is how the source of repayment really determines the nature and ultimately the credit quality of these non-sovereign bonds. Let's delve into local and regional government authorities first. What are the main types of bonds they issue?
Right. Local and regional government authorities are non-sovereign government entities. Think provinces, states, cities, municipalities that issue debt. Their bonds generally fall into two main categories based on that repayment source. First, we have general obligation, bulk bonds.
Okay, go bonds.
The purpose of these bonds is usually to fund general public goods and services within that non-sovereign's limited jurisdiction.
Think basic provincial or state-level functions like schools, maybe general infrastructure not tied to a specific revenue stream, or public safety.
Broad purposes.
Exactly. And crucially, these bonds are typically repaid by the taxing authority and the general revenues of the issuer, meaning they are backed by the full faith and credit of that local or regional government. They are generally unsecured, meaning they aren't tied to specific assets or specific revenue streams, but rather to the overall financial health and taxing power of that entity. A great real-life example of a go-go bond is the province of Ontario, Canada, 1.55% 2029 Global Green Bonds. This is a large issuance, CAD 2.75 billion. It's an unsecured bond. Its repayment is backed solely by the provincial tax revenues and general funds of Ontario.
And the green bond part.
That specifies how the proceeds are used. In this case, the money raised was specifically allocated to eligible green projects within the province, things like clean transportation initiatives, energy efficiency upgrades, clean energy generation, climate adaptation projects. But while it serves a specific environmental purpose, its fundamental security for investors comes from the province's general revenue stream, making it a go-go bond.
Got it. So the use of proceeds is specific, but the backing is general. What's the other main type?
In contrast, we have revenue bonds. These are issued specifically to fund particular projects or infrastructure that do generate their own revenue stream. Think toll roads, bridges, tunnels, airports, water systems, public power utilities.
So the project pays for itself, ideally.
That's the idea. The crucial distinction here is that their repayment is directly linked to and usually solely dependent on the specific revenue stream generated by that project. So a toll road bond would be repaid only by the tolls collected from that road. A water utility bond only by the water usage fees collected. Revenue bonds usually involve longer-dated funding, with maturities often designed to match the expected revenue-generating life and the cash flow profile of the specific project they finance. This direct link to project revenues makes their credit analysis quite different from bonds.
Oh, so?
Well, for a revenue bond, you're effectively analyzing the economic viability and cash flow generation potential of that specific project, not the general taxing power or overall budget of the government entity. It's much more focused.
Okay, that makes sense. Now, this brings us to a slightly different but equally important category. Government agencies, or quasi-government entities. These aren't quite the central government itself, but they're very closely tied to it, often operating with a specific government mandate or charter. What kind of debt do they issue, and how is it secured? This seems a bit blurry.
Yeah, these entities can be fascinating, sitting in that space between pure government and private enterprise. Government agencies issue debt to fund the government-sponsored provision of specific public goods or services based on sovereign or local law. Their debt structures, including maturities, are generally designed to be consistent with the underlying activities they finance. Now, when it comes to repayment, the primary source of cash flow for these agencies typically comes from their own operations or specific guarantee fees related to their activities. However, and this is the key aspect that elevates their credit quality, they often have sovereign government backing as a secondary source of repayment. This implicit or sometimes explicit guarantee is vital.
So they stand on their own feet first, but the government is behind them.
That's a good way to put it. Let's consider a global example. The Airport Authority of Hong Kong, AAHK. This is a statutory agency responsible for operating and developing the Hong Kong International Airport, a major global hub. AAHK issues a combination of short-term and long-term debt to meet the airport's specific working capital needs and fund its significant capital investments, like building new runways or terminals. The primary source of repayment for this debt comes from the cash flows generated by airport operations, things like landing fees charged to airlines, concession revenues from shops and restaurants, parking fees, etc.
Makes sense.
However, if those operational revenues were to fall short for some reason, its sovereign government backing, the backing of the Hong Kong government, acts as a crucial secondary source of repayment, enhancing its creditworthiness significantly compared to a purely private airport operator.
Okay. And you mentioned a U.S. example earlier, Ginnie Mae.
Right. For a U.S. context example, we can look at the Government National Mortgage Association, universally known as Ginnie Mae. Now, it's really important not to confuse Ginnie Mae with Fannie Mae or Freddie Mac. There are different types of entities in the complex U.S. mortgage market, with different structures and government relationships.
Good clarification.
Ginnie Mae's specific purpose is to securitize and guarantee certain types of U.S. mortgage loans, primarily those insured or guaranteed by other federal agencies like the FHA or VA. This is done to subsidize and promote home ownership, particularly for low and moderate income borrowers or veterans. Ginnie Mae issues callable agency debt securities. Callable meaning the issuer can redeem them before maturity, which introduces reinvestment risk for the investor. These securities have maturities designed to match the expected cash flows, including prepayments of the underlying mortgages it guarantees.
And repayment.
The primary source of repayment for Ginnie Mae's debt comes from the mortgage-based guarantee fees it charges and other cash flows generated from its operations. But critically, and similar to AAHK, it benefits from the full faith and credit of the U.S. government as a secondary source of repayment. This makes Ginnie Mae's securities essentially carry the same credit risk as U.S. Treasuries.
Okay, that distinction between the primary operational cash flow and the secondary sovereign backing is very clear now. But you mentioned a nuanced point earlier. While these agencies borrow at yields very close to their sovereign guarantor, they don't quite achieve the full liquidity premium of sovereign debt itself. Could you elaborate on why that small difference might exist?
Yes, that's a subtle but important point for investors comparing these instruments. While these sovereign-backed agencies like AAHK and Ginnie Mae are typically able to borrow at a yield to maturity, YTM, that is very, very close to that of their sovereign guarantor.
Just a few basis points difference, maybe.
Often, yes, very small. They generally do not benefit from the full liquidity premium associated with direct sovereign debt itself. Sovereign debt, especially the on-the-run issues, often has an additional pricing advantage due to its unparalleled liquidity, its absolute benchmark status, and that strong non-economic demand we discussed earlier from central banks and regulated entities. Agency debt, while incredibly safe due to the government backing, is often less actively traded in the secondary market, might have slightly smaller individual issue sizes, or might serve a more niche investor base compared to the broad appeal of treasuries. So, while the default risk is virtually identical to the sovereign, there might be a very subtle but real liquidity premium difference reflected in the yield. Meaning agency bonds might trade at a few basis points higher yield than a comparable maturity direct sovereign bond to compensate for that slightly lower liquidity.
Okay, that's a fine point, but important for precise pricing. Now, if we connect this to the bigger picture, you mentioned supranational organizations. These seem to represent another critical layer of public sector debt, often boasting the highest credit quality of all these issuers, even higher than many sovereigns sometimes. Can you explain what these organizations are and what gives them such high standing?
Right. Supranational organizations are truly fascinating entities in the global financial system. They are established and supported by multiple sovereign governments, their member states, all working together in pursuit of a common objective.
Like the UN.
Well, the UN is a political body, but in finance, prominent examples include the World Bank, officially the International Bank for Reconstruction and Development, IBRD, the International Monetary Fund, IMF, and regional development banks like the Asian Development Bank, ADB, the European Investment Bank, EIDASB, the Inter-American Development Bank, IDB, and others.
Okay, these big development banks.
Exactly. Their purposes are broad and significant, ranging from fostering economic cooperation and sustainable development, promoting global trade, providing financial stability assistance, to providing crucial financing, often on concessional terms, to emerging economies in pursuit of things like poverty reduction, infrastructure development, or climate action.
And their credit quality.
What gives these organizations their exceptionally high credit quality, often AAA ratings, the highest possible, and their strong ability to access capital markets across all maturities, is the collective support of their member states. These member states, which often include the world's most stable and wealthy economies, typically share decision-making authority and provide both implicit and explicit financial support, including substantial amounts of callable capital pledged to these organizations.
So they're backed by multiple strong governments.
Correct. This collective backing results in them having arguably the highest credit quality among all non-sovereign issuers, allowing them to borrow very cheaply and then lend those funds onwards for their development mandates. Let's consider a real-life example. The Asian Development Bank, ADB, issued some 7.80% global medium-term notes due 2034. Now, the principal amount was denominated in Indonesian rupiah, IDR 1.2 trillion, a significant amount.
Okay, an EM currency bond.
Yes, but here's the twist. Crucially, the interest and principal payments to investors were structured to be payable in U.S. dollars.
Ah, so it removes the currency risk for a dollar investor.
Not entirely, and this is where you have to read the details.
Yeah.
While the payments are in USD, the amounts are calculated based on the fixed Indonesian rupiah amounts. The actual U.S. dollar payments are determined using the spot USD-IDR exchange rate prevailing, usually 2 business days prior to each payment date.
So the investor still takes the exchange rate risk.
assets. Exactly. The investor is still assuming the currency risk between the US dollar and the Indonesian rupiah, as the actual US dollar amount they receive will fluctuate depending on that exchange rate movement. This highlights the nuances. Even within very high credit quality supranational debt, you need to understand the exact payment structure and any embedded currency exposures. Always read the prospectus. Furthermore, it's worth noting that supranational and sovereign organizations sometimes partner up to form specific quasi-government agencies, particularly to address certain development or infrastructure needs in a country.
Like a joint venture.
Sort of. For example, PT Indonesia Infrastructure Finance, ISF, was established with indirect Indonesian government ownership, but also received strong financial support from a consortium of public sector entities, including the Asian Development Bank, the World Bank Group's private sector arm, the International Finance Corporation, or IFC, and even the German Sovereign Government Development Bank, KfW. This type of partnership allows such blended finance agencies to issue debt potentially at a lower cost than the emerging market sovereign government might achieve on its own, leveraging the collective credit strength and expertise of its international backers to pool resources for large-scale, essential infrastructure projects.
Okay, this raises a really important practical question then. We've covered this huge landscape. National sovereigns, DM versus EM, local regional governments issuing GO and revenue bonds, specialized quasi-government agencies with varying levels of backing, and these massive supranational bodies backed by multiple countries. Each has unique funding mechanisms, repayment sources, explicit or implicit guarantees. How does an investor even begin to compare the risks and returns across these different types of government-linked debt? It seems like a complex matrix of factors to weigh.
That really is the million-dollar question, or maybe the billion-dollar question, for a fixed-income investor navigating this space. It can seem daunting, but the key is to have a systematic approach. You start by understanding the ultimate source of repayment for each specific instrument. Is it the general taxing power of a national government? Is it the specific revenue stream of a particular project? Is it the operational cash flow of an agency with a secondary government backstop? Or is it the combined capital and backing of multiple sovereign states in a supranational?
Identify the primary source first.
Exactly. Then you need to assess the strength, stability, and predictability of that primary revenue source. How resilient is it to economic downturns? How concentrated is it? For non-sovereign and quasi-government debt, you absolutely need to evaluate the nature and strength of any explicit or implicit sovereign backing. Understand the legal framework. Is it a full guarantee or something less concrete? And assess the political willingness, not just the ability of the guarantor to step in if needed.
Right. Willingness matters too.
Definitely. For supranationals, it's about understanding their capital structure, their internal governance, and the ongoing financial health and political commitment of their key member states. And finally, that ADB example showed, never ever forget the currency dimension, especially for emerging market or certain supranational bonds where payments might be linked to exchange rates or involve convertibility risks. It's a multi-layered analysis, no doubt. But by breaking it down systematically, source of repayment, strength of source, nature of backing, currency risk, you can navigate this complex yet absolutely essential segment of the fixed income market with much greater confidence. #outro.
Wow. Okay, that was an incredibly rich and really comprehensive deep dive into fixed income markets for government issuers, Module 5. We've truly distinguished the nuances of public sector debt and dissected how these critical markets function.
We covered a lot of ground.
We really did. We started by exploring the fundamental powers of sovereign governments, that ability to tax, provide public goods, understanding how that sets their debt apart. Then we delved into those crucial differences between developed market and emerging market sovereigns, looking at economic stability, currency implications, vividly exemplified by that Sri Lanka external debt crisis.
Cautionary tale.
Definitely. Then we moved into the fascinating mechanics of government debt management, distinguishing fiscal policies how much from debt compositions what kind. We saw how real-world governments, like the U.S. Treasury with its 30-year bond saga, navigate things like rollover risk to maintain market stability, not just technical solvency.
The practical side?
We also looked at the intricate processes of government debt auctions, contrasting single price with multiple price methods, and observed the Reserve Bank of India's strategic shift in its bond auctions, alongside that Singapore example. And finally, we expanded our view beyond the sovereign. We explored non-sovereign entities, dissecting general obligation and revenue bonds from regional players like the province of Ontario. We examined the specific functions and debt characteristics of quasi-government agencies like the Airport Authority of Hong Kong and the U.S.'s Ginnie Mae. And we ascended to the highest tier, with supranational organizations like the Asian Development Bank noting those unique currency risks that can exist even within their high-quality issuances.
Right.
Ultimately, we highlighted the core differences, the role of taxing authority, revenue predictability, and that really distinct presence of non-economic investors in shaping these uniquely vital markets.
Yeah, and if we connect all of this to the bigger picture, considering these unique characteristics of government issuers, their unparalleled ability to tax, their fundamental role in monetary policy, the significant influence of their non-economic investors, it raises a profound question for you, the listener, to ponder. Does this truly mean that default risk-free debt exists in an absolute sense, or are there simply different, perhaps more subtle or systemic, forms of risk to consider, even for the most stable and powerful governments in the world? What new risks emerge when the traditional rules of finance seem bent by sovereign power or global necessity, and how do you truly account for them in your investment decisions? Something to think about.
That's a great thought to leave us with. Okay,
Yeah.
that officially wraps up Module 05. We've laid the essential groundwork for understanding who issues government debt, the various types they issue, and how they actually do it from the grand scale of sovereign treasuries right down to the specialized roles of agencies and supranationals.
Good foundation built.
Absolutely. Next up, we'll dive straight into Module 06. And that's where we'll take all this understanding and learn how to value bonds using yields and prices. Get ready to put some numbers to these concepts and truly understand what drives their market value. We'll see you there.
Okay, let's unpack this. Welcome back, Deep Divers, to another exploration of the financial universe. Today, we are immersing ourselves in the CFA Level I-2025 Fixed Income Volume 6 curriculum. And specifically, we're diving deep into Module 06, Fixed Income Bond Valuation, Prices and Yields. This is really where we move beyond just, identifying bond features and markets. We start to uncover the underlying mechanics of how bond prices are actually determined and what those numbers truly signify for you as an informed investor. It's really a foundational module, kind of the bedrock for understanding fixed income.
Precisely. Our mission today is quite comprehensive, actually. We want to equip you with the practical tools, but also the conceptual understanding you need to calculate bond prices. And crucially, to grasp the relationships which can sometimes seem a bit counterintuitive between a bond's price, its coupon, its maturity, and its yield to maturity. We'll even tackle the complexities of valuing bonds when they trade between coupon payments, accounting for accrued interest, and explore the essential technique of matrix pricing for those less liquid securities. Then, looking ahead, after mastering these valuation techniques, we'll set our sights on Module 07. That's where we'll delve into yield and yield spread measures for fixed-rate bonds, building directly on today's concepts.
Right. So what does all this mean for you, our dedicated learner, as you navigate the intricacies of fixed income? By the end of this deep dive, you'll not only possess the analytical skills to calculate bond prices, like a seasoned pro, hopefully, but more importantly, you'll develop an intuitive sense for how various market forces and bond characteristics influence those prices. This isn't just about memorizing formulas. It's about gaining, an investor's Rosetta Stone, right? Allowing you to translate these sometimes abstract market movements into tangible insights for investment decisions, whether you're evaluating government securities, high-yield corporate debt, or anything in between. So at its very core, valuing a bond is really an elegant application of discounted cash flow analysis, isn't it? If you think back to our fundamental discussions on the time value of money, that's the absolute bedrock here. We're essentially mapping out all those future predictable payments a bond promises its stream of coupon payments and that final principal repayment, and then precisely determining what that entire package of future cash flows is worth in today's terms.
It's quite different from valuing, say, an equity where future cash flows can be highly speculative. A bond, it offers a refreshing degree of predictability in its cash flow stream.
Exactly. And what's truly fascinating here is how straightforward yet powerful this concept is. A bond's price, or its present value, is fundamentally a function of two main things. First, as you said, it's highly predictable cash flows, the regular coupon payments, usually semi-annual or annual, and the lump sum principal repayment or face value at maturity. And second, the critical interest rate used to discount those future cash flows back to the present. Now, this interest rate isn't just any rate, it's what we term the market discount rate. You'll often hear it referred to interchangeably as the required yield or the required rate of return.
Ah, okay, so that's the rate the market is demanding now for that type of bond.
Precisely. It essentially represents the return that investors currently demand for holding a bond with a specific level of risk under prevailing market conditions. Naturally, the higher the perceived risk of the bond, or maybe the higher the general level of interest rates in the market, the higher the required discount rate will be. And consequently, the lower the present value of those future cash flows reflecting that higher demanded return. Makes sense.
Yeah, that makes perfect sense. Higher required return means you pay less upfront for the same future cash flows.
Exactly. To crystallize this, let's just quickly look at the mathematical representation. It's not as scary as it sounds. The price or present value of a bond is simply the sum of the present values of all its future cash flows. So if we denote coupon payments as PMT and the face value as FE, and we discount them at the market discount rate R over n periods, the formula looks like this. PV divided by 1 plus R to the power of 1 plus PMT divided by 1 plus R squared, and so on, all the way to the last payment, which is PMT plus FE divided by 1 plus R to the power of n.
Okay, so each payment, coupon or principal, gets pulled back to today's value.
Exactly. Each future coupon payment, from the first to the last, and that final principal payment at maturity, is individually discounted back to its present value using that market discount rate. And a key point, if a bond pays semi-annual coupons, then NEN would be twice the number of years to maturity, right? 2 periods per year. And crucially, would have to be the semi-annual market discount rate, not the annual rate. You need consistency. This methodical, step-by-step discounting process is really the analytical engine behind all bond valuation.
Okay, so this interaction between a bond's fixed coupon, sort of its fixed salary, and the market's ever-shifting demands, the required yield, this is where the real story of bond pricing unfolds. It's what helps us understand if a bond is trading, at a bargain, at its fair value, or maybe at a premium. Using that analogy, if the bond's coupon is its salary, and the market discount rate is what the current job market offers for similar skills, can you walk us through how that comparison determines if a bond trades at par, a discount, or a premium?
That fixed salary versus job market analogy is actually quite vivid, and it leads us directly to these 3 crucial relationships. First, let's talk about a par bond. This is the simplest case. The bond's price, PV, exactly equals its face value, FV. This happens when the bond's fixed coupon rate is precisely equal to the prevailing market discount rate for bonds of comparable risk and maturity. So, for example, think about a hypothetical bond, maybe the Bright Wheels automotive bond, paying a 3.2% annual coupon. If the current market discount rate for similar corporate bonds is also 3.2%, well, then the bond would trade at 100% of its par value. Its coupon offers exactly what the market demands. Equilibrium.
Okay, so par means coupon rate equals market rate. Price equals face value. Got it.
Right. Next, we have a discount bond. This is when a bond's price, PV, is less than its face value, FE. This situation arises when the bond's fixed coupon rate is less than the current market discount rate. Here, the bond's coupon payments are deficient. They don't quite meet what the market is currently offering for new bonds of similar risk. So to make this bond attractive to new investors, its price must fall below par. This price drop effectively increases the buyer's overall return. Why? Because they not only receive the deficient coupons, but also get a capital gain at maturity when the bond redeems at its higher face value. The lower price compensates for the lower coupon, bringing the total yield up to the market required return.
Ah, so the discount price makes up for the lower coupon payments, delivering the market yield overall.
Exactly. And finally, a premium bond. This is one where its price, PV, is greater than its face value, FV. This occurs when the bond's fixed coupon rate is greater than the current market discount rate. In this case, the bond's coupon is excessive, you could say. It offers a better return than what the market generally demands for new, similar risk bonds. Because it's so attractive, investors will bid up its price above par. Now, the buyer pays a premium up front, sure, but they are compensated by receiving those higher than market coupon payments over the bond's life. The premium paid is effectively amortized over time by the higher coupon income, leading to a total return that aligns with the lower prevailing market discount rate.
Let's really ground this with some real-world scenarios. Picture a 5-year U.S. corporate bond issued by Apple Inc. Let's say it has a 2% annual coupon and a face value of $1,000. Now, if the market discount rate for similar rated corporate bonds is also 2%, this bond would logically trade at par, right?
Okay.
Exactly $1,000. A perfect match. But here's the crucial part. What if the market discount rate for comparable corporate debt rises to 3%? Suddenly, any newly issued bonds from a company like Apple would need to offer a 3% coupon to attract investors. Our existing 2% Apple bond now carries that deficient coupon relative to market expectations. So to make it competitive and offer a new buyer that 3% market required return, its price must fall below $1,000. This drop in price signifies it's now trading as a discount bond.
For instance, a quick calculation would show its price dropping to around maybe 956 locals or so to yield that 3%.
Right. The price adjusts to offer the market yield.
Exactly. And on the flip side, what if the market discount rate falls to 1%? Now, our 2% Apple bond has an excessive coupon compared to what the market is generally demanding. It's offering a more generous income stream than new issues, so its price will be bid up above $1,000, making it a premium bond. Investors are willing to pay more upfront for those higher, more attractive coupon payments. In this scenario, its price would rise to approximately $1,048 or $1,049 to yield 1%.
And these dynamics are absolutely universal. They hold true across global markets. Let's consider a 7-year Indian corporate bond issued by Infosys Ltd, maybe carrying a 6% annual coupon, and a face value of $10,000. If the prevailing market discount rate for similar risk corporate bonds in India is also 6%, well, the Infosys bond would trade precisely at par, $10,000.
Same principle. Coupon equals market rate, price equals par.
Exactly. Now, imagine a scenario where, perhaps due to a general increase in Indian interest rates, or maybe a slight shift in how the market perceives Infosys's credit risk, the market discount rate for such bonds increases to 7.5%. The existing 6% coupon on our Infosys bond is now undeniably less attractive than what the market demands. To entice new buyers to achieve a 7.5% yield, the bond's price would have to drop significantly below $10,000, making it a discount bond. This allows the buyer to earn that higher market rate through a combination of the coupon income and the capital appreciation towards par at maturity.
So the price has to fall to make the overall return work out to 7.5%.
Correct. Conversely, if the market discount rate in India decreases to 4% for comparable bonds, that 6% coupon offered by the Infosys bond becomes exceptionally appealing. It offers a much higher income stream than new issues. Investors would eagerly seek out this bond, driving its price above $10,000, making it trade at a premium. These principles of discounted cash flow valuation are incredibly robust and apply consistently, whether you're analyzing a bond in New York or Mumbai.
So next time you encounter a bond quotation, maybe online or in a report, and you hear it's trading at a discount or at a premium, you'll understand it's far more than just financial jargon. It's a direct, almost instant reflection of that interplay between the bond's fixed coupon rate and what the broader market is currently demanding for that specific level of risk and maturity. It's that direct comparison, a sort of real-time market referendum, that tells you the story of its value right then and there. Okay, we've just explored how to calculate a bond's price given a market yield. That makes sense. But what happens when the market presents you with a price and your mission is to uncover the implied return? The return an investor would earn if they bought that bond at its current market price and held it until maturity. That's where yield to maturity, or YTM, becomes our essential compass. It's a term often used, maybe loosely sometimes, synonymously with market discount rate. But it carries a very precise meaning and, crucially, a set of critical underlying assumptions you absolutely need to be aware of, especially for your CFA studies.
Indeed. That's a key distinction. The YTM is essentially the internal rate of return, the IRR, on a bond's cash flows. It's that single annualized interest rate that, when used to discount all the future coupon and principal payments, makes their total present value exactly equal to the bond's current market price. You can think of it as the implied or observed market discount rate based on the current price. It's widely considered the promised yield, the total return an investor can expect, but, and this is a critical caveat we need to emphasize, this promise is contingent upon 3 specific, rather idealized assumptions actually holding true.
Ah, the assumptions. Always important in finance. What are they?
Okay, let's delve into those 3 core conditions for an investor's actual rate of return to precisely equal the calculated YTM. First, and quite straightforward, the investor must hold the bond until its maturity date. No selling early. If you sell it prematurely, your actual return will be dictated by whatever the market price is at the time of sale, which could be higher or lower than your purchase price. Your realized return might diverge significantly from the initial YTM.
Right, selling early introduces price risk.
Exactly. Second, the issuer must make all coupon and principal payments on time and in full. No defaults. This is why YTM is considered the promised yield. It inherently assumes 0 default risk. If the issuer, for any reason, fails to meet these obligations, your actual return will obviously be lower, potentially drastically so.
Okay, hold to maturity, no default. What's the third one? You mentioned it was nuanced.
Yes, the third one is perhaps the most challenging assumption in practice. It assumes that all coupon payments received must be reinvested at the exact same YTM rate throughout the bond's life. This implies a perfectly consistent interest rate environment where you can always redeploy your coupon cash flows at the very yield you initially calculated when you bought the bond. This idealized scenario, as you can imagine, rarely mirrors the volatile reality of financial markets where interest rates are constantly changing.
You've highlighted that crucial third assumption about reinvestment. That sounds like a really big if. Realistically, how often does that actually hold true in today's dynamic interest rate environment? And what are the practical implications for an investor who relies on that promised YTM only to find market rates have shifted when those coupons actually arrive?
That's an excellent and very practical question. In reality, the perfect reinvestment assumption is often just that, an assumption, an idealized measure. If interest rates fall after you buy a bond, you'll likely have to reinvest your received coupons at a lower rate than your original YTM. This means your actual realized return over the life of the bond will likely be less than what the YTM initially promised. Conversely, if rates rise, you might be able to reinvest your coupons at a higher rate, potentially leading to an actual return greater than the original YTM.
Oh, interesting. So rising rates after purchase could actually boost your total return, assuming you reinvest.
Potentially, yes, due to the reinvestment effect, although the bond's price itself would likely fall. It's a trade-off. So while YTM serves as a powerful benchmark and a standardized way to compare bonds at a given point in time, it's definitely not a guaranteed return, especially for long maturity bonds with many coupon payments to reinvest. Investors, particularly portfolio managers, are keenly aware of this reinvestment risk, and they factor it into their strategies.
Makes sense. It's a benchmark, not a crystal ball.
Exactly. And while typically YTMs are positive, reflecting a return for lending money, they can even be zero or, quite strangely, negative. This might sound utterly counterintuitive. I mean, why would any rational investor accept a guaranteed negative return? This phenomenon became quite prevalent after 2012, again more recently in certain developed markets like Japan and parts of Europe, largely due to extreme central bank policies. Faced with below-target inflation and sluggish economic growth, central banks resorted to things like quantitative easing and even negative policy interest rates, which pushed some bond yields into negative territory.
Negative yields. So you pay more than you get back. How does that even happen?
Well, bonds with negative yields to maturity don't typically start that way when issued. They usually occur when bonds initially issued at positive yields experience significant price appreciation in the secondary market due to overwhelming demand. Essentially, buyers are pushing prices so high well above par that they are effectively paying more upfront than the total sum of future principal and coupons they will receive back. This can also happen with newly issued zero-coupon bonds that are priced at a premium to their face value. Investors might accept negative yields for a variety of reasons. Maybe a flight to safety during extreme market uncertainty, or perhaps regulatory requirements force certain institutions to hold specific types of seemingly risk-free assets, regardless of yield. Or sometimes it's just a desperate search for liquidity, where the ability to easily convert an asset to cash trumps a small guaranteed loss.
Let's consider a practical example of that negative YTM. Imagine a 5-year U.S. Treasury bond, maybe a zero-coupon strip, with a face value of $100. If this bond is trading in the market at a price of, say, 100.763 cents, an investor buying it today and holding it to maturity would receive exactly $100 in 5 years, but they would have paid 100.763 upfront, a guaranteed loss, right? Now, if we plug these values into our present value formula, PV equal FV1 plus RT, and solve for R, that is 100.763 equals $100 1 plus R5, we find that R is approximately negative 0.15% annually.
A small negative yield.
Exactly. And this isn't just an academic exercise. This reflects real periods where investors prioritizing absolute safety, perhaps during times of extreme market turmoil, or maybe for regulatory compliance, were willing to accept a small guaranteed loss for the perceived security and liquidity of holding a U.S. Treasury asset. It's a stark reminder that in certain market conditions, return can become secondary to capital preservation or liquidity needs.
Absolutely. And we can observe the theoretical possibility, if not widespread occurrence, in the Indian context too, demonstrating this isn't just a U.S. or European phenomenon. While perhaps less common for primary issues in India, if an existing highly sought-after Indian government security, JUSEC, maybe a 3-year zero-coupon bond issued by the Reserve Bank of India, RBI, saw truly unprecedented demand from large institutional investors, perhaps for specific liquidity management needs or to fulfill reserve requirements, its price could theoretically be bid up significantly above par. For example, if a zero-coupon G-Sec maturing in 3 years with a face value of €1,000 somehow traded at 1,005 today, the implied YTM for a new buyer holding to maturity would undeniably be negative. This signifies a strong safe haven demand, where investors might be willing to pay a small premium to hold what they perceive as the safest asset, even if it means accepting a nominal loss upon maturity. They're prioritizing security and liquidity over a positive yield in that specific scenario.
So despite these theoretical assumptions and the occasional, oddity of negative yields, YTM remains an incredibly powerful and widely used indicator in the market. When financial news reports that yields are rising, it's universally understood as shorthand for market discount rates are going up and consequently bond prices are falling. It's a crucial barometer for the entire fixed income market, offering you a concise snapshot of what investors are currently demanding for their capital across various risk profiles and maturities. It's the pulse, really. Okay, we've established how bonds are valued on their coupon payment dates. That seems fairly clean, relatively straightforward. But the reality of bond trading is that transactions don't always conveniently line up with those neat dates. What happens if you buy or sell a bond in between coupon payments? You're not just paying the sticker price for the bond itself, are you? There seems to be an extra yet critical layer of accounting that comes into play to ensure fairness between buyer and seller.
Exactly right. When a bond trades between coupon dates, the actual amount exchanged isn't just a single simple number. It has two distinct components. There's the flat price, which is also widely known as the quoted price or the clean price. And then there's the accrued interest, or AI. The sum of these two parts is what we call the full price, often referred to as the invoice price or the dirty price. And this full price is the actual monetary amount the buyer pays the seller on the settlement date. So the fundamental relationship is quite straightforward. PV full, PV flat plus AI.
Okay, full price equals flat price plus accrued interest. The two different prices. Why not just quote the full price?
Good question. The flat price, PV flat, is the price you typically see quoted by bond dealers and on trading screens. It's the bond's price stripped of any interest that has accumulated since the last coupon payment. This convention is adopted specifically to prevent misleading investors. Think about it. If dealers quoted the full price, you would observe a bond's price appearing to rise steadily every single day, just due to the natural accumulation of interest, even if the underlying market discount rate, or YTM, hadn't changed at all. Then, poof, on a coupon payment date, the price would suddenly drop significantly by the amount of the coupon paid. That looks messy and volatile. By quoting the flat price, investors can clearly discern the true market-driven price fluctuations, isolated from the predictable daily accrual of interest. It's cleaner.
Ah, I see. So the flat price shows the real economic value change, separate from the interest buildup. Makes sense. What about the accrued interest part then?
Right. The accrued interest, AI, is the portion of the next coupon payment that the seller has effectively earned and is therefore owed by the buyer. The rationale is simple fairness. The buyer, who will be the owner of record on the upcoming coupon date, will receive the entire next coupon payment from the issuer. But since the seller held the bond for a portion of the current coupon period, from the last payment date up to the settlement date, they are rightfully entitled to their pro rata share of that interest. So the buyer compensates the seller for the interest that has accumulated during the seller's holding period. This ensures that the full price accurately reflects both the economic value of the bond itself, the flat price, and the interest earned but not yet paid.
Okay, so this isn't just some trivial accounting detail. It's a vital mechanism for ensuring a fair trade happens. But how do we actually calculate that accrued interest amount? It sounds like it depends very precisely on how many days have passed since the last payment down to the exact day. What are the methodologies involved there? How does that work?
It absolutely is about precision, and it's a direct proportional calculation. The accrued interest is determined by taking the fraction of the current coupon period that has elapsed since the prior coupon payment and multiplying it by the coupon payment for that period. The formula for accrued interest is AI each TT A PMT. Here, T represents the number of days from the prior coupon payment date right up to the bond's settlement date. T is the total number of days in the current coupon period from the last payment date to the next one. And PMT is simply the coupon payment per period.
Okay, T over T times the payment. But how do you count T and T? Are there different rules for counting days?
Ah, yes, that's crucial. The calculation of T and T depends heavily on specific day count conventions. These are standardized rules that dictate exactly how we count days for interest calculations, and they vary by bond type and market convention. Two of the most common you'll encounter are, first, 3360. This convention assumes, mainly for calculation simplicity, that every month has exactly 30 days and a year has 360 days. It's frequently used for U.S. corporate bonds and municipal bonds. Second, actual. This convention uses the actual number of days in each calendar month and the actual number of days in the year, so 366 for a leap year. This is the standard for U.S. Treasury bonds and many sovereign bonds globally because it's obviously more precise. And it's vital to recognize. Accrued interest depends solely on the coupon rate, the coupon frequency, and the specific day count convention being used. It does not depend on the bond's yield to maturity. Only the flat price is influenced by changes in market interest rates.
Let's run through a couple of detailed examples to see these day count conventions in action. It sounds like getting the convention wrong could lead to a mistake. Let's consider a U.S. municipal bond paying a 4.375% annual coupon with semi-annual interest payments on May 15th and November 15th. Suppose the settlement date for a trade is June 27. We'll use the 360-day count convention, which you said is standard for many U.S. munis and corporates.
Okay.
Our last coupon payment was on May 15th. The next is November 15th. First, we calculate T, the number of days from May 15 to June 27 using 3360. Days remaining in May, 3015, assuming 30 days in May. Days in June until settlement, 27 days. So total T15 plus 2070s was 42 days.
Correct, using the 30-day-a-month assumption.
Next, we calculate T, the total number of days in the current coupon period, May 15th to November 15th, using 3360. This is a 6-month period, so 6 months times 30 days per month equals 180 days. The semi-annual coupon payment, PMT, for a 4.375% annual coupon on a $100 par bond is 4.3752, equals 2.187 to 5s. So the accrued interest, AI equals TT, PMT equals 42,180. It's 2.1875 cents, which comes out to about 0.51 SOVO per $100 of par value. That's what the buyer adds to the flat price.
Perfect calculation. And now, transitioning to an Indian context, let's take an Indian corporate bond, maybe a non-convertible debenture or NCD, from a major company like Reliance Industries. Let's say it pays an 8% annual coupon with interest payments on April 1st and October 4th. Suppose the settlement date for a transaction is June 20. For this, we'll use the actual day count convention, which is common for many Indian securities.
Okay, actual this time. Last payment, April 1. Next is October 1, settlement June 20.
Right. First, the actual number of days from April 1 up to, but not including June 20. April has 30 days, May has 31 days, June has 20 days until settlement. So total T equals 30 plus 31 plus 20 equals 81 actual days.
Okay, 81 days.
Next, T, the actual number of days in the current coupon period, from April 1 up to but not including October 1st. April 30 plus May 31 plus June 30 plus July 31 plus August 31 plus September 30 to 183 actual days.
183 days in that period. Different from the 180 we got with 3360.
Exactly. The annual coupon payment, PMT, for an 8% annual coupon on a 100 par bond is simply 8. So using actual AI, A PMT equals 8,183, 8 rate, which calculates out to roughly 3.5409 per 100 of par value. You can clearly see how the specific day count convention significantly influences the precise calculation of accrued interest. It's not a minor detail. It's critical for accurate settlement in bond trading. Now, just to briefly touch on how we actually calculate the full price, PV full, when we're between coupon dates using a modified discounted cash flow approach. The standard bond pricing formula we discussed earlier assumes you're valuing the bond right on a coupon date. When you're in between, the formula needs a slight adjustment. One way is to modify the discount factor exponent to account for that partial period until the next coupon. Instead of simply discounting for full periods, 1, 2, 3, you discount for, say, 1 minus the fraction of the period passed for the first coupon, then 2 minus the fraction of the period passed for the second, and so on. It gets a bit messy.
Sounds complicated. Is there an easier way?
Yes. Often more practically, especially if you're using spreadsheet software, you can calculate the bond's present value as if it were trading on the previous coupon date. Let's call that PV-Prev. Then you simply compound that value forward to the actual settlement date using the market discount rate for the fraction of the period that has passed. So PV full, PV-Prev multiplied by 1 plus R raised to the power of TT, where T is days from the last coupon to settlement and T is total days in the coupon period. This effectively rolls the theoretical value of the bond forward from the last coupon date to the exact settlement date, incorporating the time value of money for that partial period.
Okay, that makes sense. Calculate price at last coupon date, then grow it forward to settlement date. So this whole system of flat price, accrued interest, and full price really ensures fairness and transparency, doesn't it? The seller is rightly compensated for the interest they earned while holding the bond, and the buyer, in turn, pays for it, confident that they'll receive the full coupon payment when it's actually due. It's a clean and precise way to handle transactions, ensuring neither party is unfairly disadvantaged when bonds change hands mid-coupon cycle. For someone new to bond trading, understanding this prevents that common mistake of miscalculating the actual cash amount due at settlement, which could lead to some unwelcome surprises, I imagine.
Absolutely. It standardizes the process globally.
Okay, with those foundational pricing principles locked in DCF, part premium discount, YTM, accrued interest, please zoom out a bit. How does the market's pulse, specifically shifts in interest rates, actually move a bond's price? The answer, as we'll see, isn't always as simple as it might seem at first glance, and understanding these relationships is absolutely crucial for grasping bond risk and managing any fixed income portfolio effectively.
You're right, it's fundamental. The most basic and enduring rule which underpins all bond valuation is the inverse relationship. Bond prices and yields to maturity move in opposite directions. When YTMs rise, prices fall, and conversely, when YTMs fall, prices rise. This is a direct mathematical consequence of the discounting process. A higher discount rate invariably reduces the present value of a bond's future cash flows. However, the magnitude of that price change isn't uniform across all bonds. This is where specific bond features come into play, creating different levels of sensitivity. And the first we'll discuss is the coupon effect.
The coupon effect. So how does the coupon rate affect price sensitivity?
The coupon effect states that the lower a bond's coupon rate, the greater its percentage price change for a given change in YTM. To truly understand why, think about where the value comes from. Bonds with lower coupons, or especially zero-coupon bonds, rely much more heavily on their final principal payment at maturity for their total return. That distant principal payment is discounted over a much longer period, making its present value extremely sensitive to even small shifts in the discount rate. In our formula, a zero-coupon bond, by definition, has 100% of its cash flows concentrated way out at maturity, making it the most sensitive to yield changes for a given maturity. Conversely, bonds with higher coupons provide more frequent, larger interim cash flows. These nearer-term cash flows are less sensitive to discounting over long periods, thereby cushioning the overall price impact of yield changes.
That's a powerful insight for risk management. So lower coupon means more bang for the buck when rates change, both up and down. To illustrate this, let's compare two hypothetical 30-year U.S. Treasury bonds. One has a very low 1% annual coupon, maybe issued when rates were low. The other has a higher 5% annual coupon, perhaps issued earlier. Let's say both initially yield 3%. If the YTM for both bonds suddenly rises by 100 basis points, or 1%, from 3% to 4%, the 1% coupon bond will experience a significantly larger percentage price drop compared to the 5% coupon bond. For example, the 1% bond might drop by, maybe over 20%, while the 5% bond might drop by around 17%. This is because the present value of that distant $100 principal payment for the 1% coupon bond constitutes a much larger proportion of its initial value, and that portion is heavily impacted by changes in the discount rate over 30 years. The 5% coupon bond, with its more substantial near-term cash flows, has its price volatility dampened somewhat. Understanding this coupon effect isn't just academic, it's fundamental for portfolio managers who need to precisely manage their interest rate risk exposure.
Exactly. It directly impacts duration, which we'll cover later.
So lower coupons mean more volatility. That's a clear takeaway. But what about the length of time an investor is holding a bond, or, more accurately, its term to maturity? Does maturity play an equally significant role in determining a bond's price sensitivity?
Absolutely. And this brings us neatly to the maturity effect. Generally speaking, the longer a bond's time to maturity, the greater its percentage price change for a given change in its YTM. This is a direct and pretty intuitive consequence of having a higher N, the number of periods, in our present value formula. Discounting cash flows further out into the future magnifies the impact of the discount rate. A small change in R has a much more pronounced effect on the present value of a cash flow that's 30 years away compared to one that's only, say, 5 years away. The cash flows that are furthest in the future are the most heavily discounted, and thus the present values are the most sensitive to changes in that discount rate.
So longer time horizon, more impact from discounting changes. Makes sense. Are there any exceptions?
While this relationship generally holds true, it's worth noting some theoretical nuances, just for completeness. Rare exceptions to the strict maturity effect can occur, but typically only for very low coupon, though not zero coupon, long-term bonds that are already trading at a deep discount. In these specific, somewhat unusual cases, the complex interplay of duration and convexity can sometimes lead to a slightly less pronounced sensitivity compared to, say, a slightly shorter-term, higher coupon bond. However, for zero-coupon bonds, and for the vast majority of bonds priced at par or a premium, the maturity effect consistently holds. Longer maturity almost invariably means greater percentage price sensitivity to yield changes. For practical purposes, think longer maturity, more volatile price.
Let's consider an Indian example to cement this concept of the maturity effect. Imagine comparing a 10-year Indian government security, GSEC, with a 7% annual coupon to a 30-year GSEC with the exact same 7% annual coupon. If the market YTM for both rises by, let's say, 50 basis points, or 0.50%, the 30-year GSEC will, without question, see a much larger percentage decline in price compared to the 10-year GSEC. The cash flows that are 20 to 30 years out in the longer-term bond are far more heavily discounted and therefore exhibit significantly greater price sensitivity to that relatively small yield change. This is a key reason why long-term bonds are generally considered to carry higher interest rate risk than their shorter-term counterparts.
Precisely. That time dimension is critical for risk assessment.
Interesting. So we know longer and lower coupon bonds are generally more sensitive to interest rate changes, but what happens to a bond's price as it simply approaches maturity, even if market rates stay perfectly constant? Does it just kind of glide towards its face value, or is there a predictable trajectory there?
That's an excellent question, and it describes a fundamental concept called the constant yield price trajectory, often more colloquially referred to as the pull to par. Even if the market discount rate, or YTM, remains completely constant throughout a bond's life, which is unlikely, but let's assume it for a moment, its price will still change purely due to the passage of time. As a bond steadily approaches its maturity date, its price will inevitably pull to par. What does this mean in practice? A bond that was initially trading at a discount, price less than par, will see its price gradually increase towards its par value as maturity nears. Conversely, a bond initially trading at a premium, price greater than par, will see its price gradually decrease towards its par value. This convergence happens because at the very end, at maturity, the bondholder receives exactly the par value regardless of the bond's initial issue price or its trading price throughout its life. It's an inevitable and predictable price path if yields hold steady.
So discount bonds accrete value towards par. Premium bonds amortize value down towards par just due to time passing.
That's a perfect summary.
And finally, there's another fascinating and maybe more subtle aspect of this price-yield relationship. It's not a straight line on a graph, is it? It's curved. If interest rates move up by a certain amount, the price drops by 1%. But if rates move down by the same amount, the price doesn't necessarily go up by the exact same percentage. This nonlinear behavior is called convexity, right? And it has significant implications.
Precisely. You've hit on a critical nuance. The relationship between bond prices and yields is undeniably convex, not linear. This means that for a given absolute change in yield, let's say 1%, a bond's percentage price increase when yields fall by 1% is generally greater in absolute value than its percentage price decrease when yields rise by that same 1%. This phenomenon is known as positive convexity, and it's generally favorable to bondholders. It essentially implies that the upside potential in bond prices when yields fall is larger than the downside risk when yields rise by an equivalent amount.
So the gains from falling rates are bigger than the losses from rising rates at the same magnitude. That sounds like a good thing.
Generally, yes, it is. Think of it graphically. The price-yield curve for a typical plain vanilla bond is bowed outwards, away from the origin. This curvature means its slope, which represents its price sensitivity or duration, actually changes as yields change. It's not constant. This positive convexity becomes more pronounced for bonds with longer maturities and lower coupons, essentially, for those bonds that already have higher interest rate sensitivity, longer duration. Understanding convexity is vital for accurately measuring and managing interest rate risk, especially for more sophisticated bond portfolio managers. It helps in assessing not just the direction of price movements, but the asymmetry of those movements for a given yield shock. It offers a much more complete picture of risk than duration alone, especially for larger yield changes.
Okay, that's a lot on how prices react. Now, so far, we've kind of assumed that for our valuation exercises, we either have a readily available market price to infer a yield, or we have a clear market yield to calculate a price. But what if a bond isn't actively traded? Perhaps it's a new issue just coming to market, or belongs to a smaller, less liquid issuer. How do you figure out its price then? You can't just look it up on a Bloomberg screen or rely on consistent market data.
This raises an incredibly important practical challenge. Because unlike, say, large-cap equities which trade constantly, many bonds, particularly certain corporate bonds or those issued by smaller municipalities, are quite illiquid. They might not trade for days, weeks, or even months. This lack of robust trading complicates price discovery significantly. For these new bonds, or those that are thinly traded, we employ a sophisticated estimation process called matrix pricing. It's a pragmatic method that essentially leverages observable information from comparable, more frequently traded bonds to derive an approximate fair price and yield for the illiquid security.
Matrix pricing. Okay, so
Nah.
you're using a matrix of comparable bonds.
Essentially, yes. The core concept of matrix pricing is to estimate the price and YTM of a new or illiquid bond when direct transactional data is scarce or non-existent. The method relies heavily on identifying actively traded bonds that are as similar as possible to the bond we're trying to price. These comparable bonds must share similar characteristics across 3 key dimensions. Their times to maturity must be close. Their coupon rates should ideally be in the same ballpark. And critically, their credit quality or rating must be very similar. It's almost like finding a set of close cousin bonds in the market for which you can see prices and yields to help you determine the fair value of your unique, untraded family member.
Okay, so we're looking for actively traded cousin bonds that share a similar financial DNA, maturity, coupon, credit quality. What's the step-by-step process for actually performing matrix pricing, from identifying these comparables to actually arriving at a price estimate?
The process typically involves 4 main systematic steps. It's quite logical. Step 1, you begin by identifying those actively traded comparable bonds. As we just discussed, these comparables should align closely with your illiquid target bond in terms of time to maturity, coupon rates, and credit quality. For example, if you're trying to price a specific 3-year bond from, say, XYZ Corporation, you'd look for other bonds from XYZ if possible, or from very similar corporations in the same industry and with the same credit rating that have maturities clustering around 3 years. You're trying to build a reference universe of bonds for which observable prices and yields do exist.
Okay, find the comparables. Step 2.
Step 2. Next, you calculate the yields to maturity, YTMs, for each of these comparable bonds using their current market prices. If you happen to find several comparable bonds for a specific maturity year, you find 3 different 2-year bonds from similar issuers, you calculate the YTM for each and then average them to get a representative yield for that specific maturity bucket. So if you're valuing that 3-year bond, you might find actively traded 2-year bonds and maybe some 5-year bonds from similar rated entities, and you'd calculate the average YTM for the 2-year group and the average YTM for the 5-year group.
Right, average yields for nearby maturities. Then
Step 3. With those average YTMs for your comparable maturities bracketing your target maturity, you then perform linear interpolation. This is where you mathematically estimate the YTM for your illiquid bond's specific maturity, in our example, 3 years, assuming a relatively smooth yield curve for bonds of that particular credit quality. For instance, if your average 2-year comparable bond YTM turned out to be 3.8035% and your average 5-year comparable bond YTM was 4.1885%, and you need to estimate the 3-year YTM, you'd use the interpolation formula. It looks like this. Estimated 3-year YTM equals YTM 2AR plus 3OR 2YR, 5R 2YR, YTM 5R, YTM 2YR. Plugging in the numbers, 0.038035 plus 13, 0.038035 plus 3Y, 0.030385, giving you about 3.932%. You're essentially assuming a straight line relationship for yield between your 2 known maturity points, 2 years and 5 years, to estimate the yield at the intermediate point, 3 years.
Okay, interpolate to get the estimated yield for the exact maturity I need. Step 4 must be pricing the bond then.
Exactly. Step 4. Finally, once you have this carefully estimated YTM for your illiquid or new bond, 3.932% in our example, you use that yield to calculate the bond's price. You simply plug that estimated YTM into our standard bond pricing formula, discounting all of the bond's future coupon and principal payments back to the present using that rate. So for that 3-year, 4% semi-annual bond we were hypothetically pricing, you'd use your estimated semi-annual YTM, which would be half of the 3.932% annual rate, to discount its 6 semi-annual payments and the final principal repayment. This process effectively translates the market's pricing of similar traded bonds into a fair estimate for your untraded one. Now, it's important to remember that the scarcity of truly perfect comparable bonds or the need to make subjective adjustments for subtle differences in credit quality or liquidity can introduce some estimation error, but it remains the best, most logical approach in situations where direct market prices are unavailable.
let's walk through a concrete example from the U.S. market to really bring this process to life. Imagine an analyst needs to price an illiquid 4-year, 4.5% annual coupon bond for a mid-sized U.S. regional bank. Let's call it XYZ Bank. These bonds just don't trade very often.
Okay, a realistic scenario.
The analyst searches the market and identifies 2 actively traded comparable bonds from similarly rated regional banks. 1, a 3-year, 5.50% annual coupon bond from ABC Bank, trading at $107,500 per $100 par. Using a financial calculator or software, this price implies a yield to maturity, YTM, of 2.856%. 2. A 5-year, 4.50% annual coupon bond from DF Bank, trading at 104.75 cents per $100 par. This implies a YTM of 3.449%.
Good, we have our bracketing yields and maturities.
Yeah, now to estimate the YTM for XYZ Bank's 4-year bond, the analyst performs linear interpolation between these 2 points, 3-year and 5-year. Estimated YTM for 4-year bond equals YTM 3-year plus, target maturity 4 or 5 or 3, YTM 5-year all play or. Estimated YTM 449% plus 43.3, estimated YTM 2.856% plus 12.593%, estimated YTM 2.856% plus 3.8593%, estimated YTM yields 2.856% plus 3.2965% equals 3.1525%.
Makes sense. Exactly halfway between the 3-year and 5-year yields.
Exactly. Rounding slightly to 3.153%, the analyst then uses this estimated YTM to calculate the price of the XYZ Bank's 4-year, 4.5% annual coupon bond. Discounting its 4 annual coupon payments of $4.50 and the final $100 principal at this 3.153% discount rate would yield an estimated price of approximately 104.911 francs per $100 of par value. It seems like a very robust and widely accepted method for finding a fair price even without direct market quotes for that specific bond.
It absolutely is. And in the Indian context, let's consider an investment bank that's underwriting a new 5-year bond issuance for a growing Indian infrastructure company, maybe like L&T Finance Holdings. This company might not have a lot of existing publicly traded debt, making pricing tricky. The underwriters need to determine what yield they should offer to make the bond attractive to investors.
Okay, pricing a new issue using matrix pricing concepts.
Exactly. They might identify, say, an existing 4-year 3% annual coupon bond from a comparably rated infrastructure company, perhaps Shrem Finance, that is actively trading at 102.400000 par. This implies a 2.36% yield to maturity for that bond. Now, to establish a benchmark, they look at risk-free Indian government securities, GSECs. They find current 3-year GSECs yielding 0.75% and 5-year GSECs yielding 1.45%. Using linear interpolation, just like before, they can estimate a 4-year GSEC yield. Estimated 4-year GSEC YTM equals 0.75% plus 1.45%, 0.75%. Estimated 4-year GSEC YTM equals 0.75% plus 12.70%, 1.10%.
Okay, so they have the yield on the comparable corporate bond, 2.36%, and the estimated yield on a risk-free GSEC of the same maturity, 1.10%.
Precisely. Now, they calculate the estimated yield spread for that 4-year comparable corporate bond over the 4-year GSEC. 2.36% Shrem Finance YTM minus 1.10% estimated 4-year GSEC YTM equals 1.26% or 126 basis points. This 126 basis point spread derived from the traded comparable can then be used as a key reference point. They'd likely add this spread or something very close to it, maybe adjusted slightly for maturity or specific issuer factors, to the yield of the 5-year GSEC, 1.45%, to estimate the required yield for the new 5-year bond from L&T Finance Holdings, so 1.45% plus 1.26% for 2.71%. That estimated 2.71% yield would then be used to determine the appropriate offering price for the new bond. It's a critical tool for bringing new corporate debt to market in a rational and market-aligned way.
So this is essentially how underwriters get a handle on what yield a new bond issue needs to offer, especially for corporate bonds where liquidity might be inherently lower than for, say, large sovereign government bonds like treasuries or GSECs. It's a bridge from the known traded market to the unknown untraded or new issue, ensuring that even illiquid or nascent markets can function efficiently. It effectively transforms abstract market data into a concrete pricing strategy.
Indeed. Matrix pricing is very widely used, not just for valuing illiquid existing bonds in secondary markets, but it's also an indispensable tool in the primary market for the underwriting of new bonds. It helps to estimate that required yield spread over a benchmark government rate, providing a credible basis for pricing that new issue. It's a pragmatic and essential approach to price discovery in what can often be a less transparent and more fragmented market compared to the equity world. So, to wrap up this deep dive on Module 06, we've walked through the fundamental principles of fixed income bond valuation, which is really a cornerstone of financial analysis. We began by understanding how those predictable cash flows and the all-important market discount rate precisely determine a bond's price using discounted cash flow. We then delved into the crucial concept of yield to maturity, examining its definition as an internal rate of return, and importantly, critically assessing its underlying, often idealized, assumptions like reinvestment risk. We demystified the practical distinction between full price and flat price when trading bonds between coupon dates, highlighting the importance of accrued interest and day count conventions for transactional clarity. Furthermore, we explored how intrinsic bond features like coupon rate and time to maturity profoundly impact price sensitivity to interest rate changes, the coupon effect and maturity effect, including the generally favorable impact of positive convexity. And finally, we learned about matrix pricing as a practical and essential tool for estimating the price and yield of illiquid or newly issued bonds by carefully comparing them to actively traded similar securities using interpolation. This robust understanding of fixed income bond valuation brings us to the close of Module 06 of our CFA Level I 2025 Fixed Income Volume 6 course.
We've certainly covered a tremendous amount of ground today, hasn't it been insightful? From the foundational discounted cash flows to navigating the complexities of illiquid markets with matrix pricing. It truly highlights the intricate mechanisms beneath what often looks like just a simple price tag in the fixed income world. Now that you have a solid grasp on why a bond's price moves the way it does and how to quantify those movements and relationships, next time we'll dive into Module 07. We'll expand on today's foundation and learn how to value bonds using yield and yield spread measures for fixed-rate bonds, building on what we've covered today with even more sophisticated metrics and comparisons. As you ponder everything we discussed today, here's a final thought. If market participants often just say yields are rising, instead of the more technically precise but cumbersome market discount rates are rising, and consequently bond prices are falling, what does that common shorthand tell you about the mental shortcuts they're taking? And how might that influence decision-making, especially for those less informed or less experienced in the nuances of fixed income? It's perhaps more than just semantics. It might be a window into how information is processed and acted upon in fast-moving markets. Recognizing that distinction between the shorthand and the full reality is potentially a powerful advantage. Welcome back to the Deep Dive. Today we're really getting into the weeds with CFA Level I 2025 Fixed Income Volume 6. Our main focus for this session is Module 07, Yield and Yield Spread Measures for Fixed-Rate Bonds. This module, it's all about giving you the right tools, the tools to really understand, interpret, and maybe most importantly, compare different bond yields properly. We're going to sort of pull back the curtain on how things like different compounding frequencies,
Periodicity.
right, periodicity, and also unique bond features like embedded options,
Yeah.
and how market benchmarks influence the yields we use for fixed-rate securities. It's about getting way beyond just the surface numbers and really understanding what they mean for your investment decisions.
Absolutely. It's about translating those numbers into real-world implications.
No, see, why should you care? Well, because getting yield measurement right isn't just like academic. It's the absolute foundation for making smart investment choices. And just looking ahead after we've really dug into fixed-rate bonds here, we'll shift gears in the next module.
Module 08, yeah. That's yield and yield spread measures for floating rate instruments. A different beast altogether.
Exactly. But for now, let's dive deep into these fixed-rate yields and spreads. It's all about making sure you're comparing apples to apples.
Or maybe callable bonds to non-callable bonds, right?
Precisely. And understanding the compensation you're actually getting for the risks you take. Okay, so let's start with maybe a concept that can sometimes trip people up a bit. Periodicity. In simple terms, it's just the assumed number of times interest gets compounded within 1 year.
Think about your savings account maybe, or a fixed deposit. Does it compound interest just once a year? Or maybe twice a year, or quarterly?
Right. And that frequency, it might seem like a small detail, but it actually has a really profound impact on the total return you get from an investment, including bonds.
It does. The more often interest is calculated and, crucially, added back to your principal, the sooner that new interest starts earning its own interest.
It's that snowball effect, isn't it? It kind of accelerates your returns over time.
And that's exactly where it gets interesting, or maybe a little complex. What's really fascinating, I think, is this inverse relationship between the stated annual rate of a bond and its periodicity, especially if we're looking at two bonds that give the same effective return.
Okay, say more about that inverse relationship.
Well, imagine two bonds. They end up giving you the exact same overall return at the end of the year. If one bond compounds more frequently, let's say quarterly instead of annually, its stated annual rate can actually be lower than the other bond's rate.
And it still gives the same final return.
Exactly. Because of the power of more frequent compounding, that lower stated rate, compounded more often, can be entirely equivalent to a higher stated rate compounded less often. It's really critical to get this for accurate comparisons. If you just look at stated rates without considering periodicity, you could easily think one bond is better when it's just different accounting, basically.
A common mistake, I bet.
Mm-hmm.
That actually leads perfectly into why we need something like the effective annual rate, or EAR. Because to standardize things, to cut through that confusion you mentioned, we often use the ERR. It's the true actual annual rate of return you'd get, factoring in that full compounding effect.
You kind of levels the playing field, right?
It does. It standardizes every yield by assuming just one compounding period per year. So an ER is the unvarnished truth of the annual return.
And conceptually, how do we get there? We sort of imagine each coupon payment gets reinvested.
Exactly. You assume each coupon payment is immediately reinvested at the bond's periodic rate for the rest of the year. Think of it like calculating the future value, your initial investment plus all those reinvested coupons over the year. We don't need to dive into Excel functions, but the logic is like an FV function.
Okay, let's make this concrete. Maybe a U.S. example. Imagine a hypothetical corporate bond, say from Apple, pays coupons quarterly. If it pays 1.25% each quarter, its stated annual rate is simple enough. 1.25% times 4, so 5%.
But here's the kicker, right? If those quarterly coupons are immediately reinvested at that same 1.25% rate,
Which is the standard assumption.
then the actual effective annual rate, the EAR, works out to be 5.0945%.
See that little bit extra?
Yeah, that 0.0945%. That's the compounding effect in action. Shows you the true annual return if you reinvest.
Which is why ER is so important. It gives a clearer picture of your potential earnings. And building on that, it's really important for you listening to know that in many big bond markets like the US and the UK, the most common periodicity is actually 2.
Why 2? Oh, because most bonds pay coupons twice a year.
Semi-annually.
Exactly.
Yeah.
Most government and corporate bonds follow that convention. So when we talk about an annual rate that assumes a periodicity of 2, we call it a semi-annual bond basis yield, or sometimes semi-annual bond equivalent yield.
Okay, semi-annual bond basis yield.
Got it. But here's a crucial distinction, something the CFA exam loves to test, that semi-annual bond basis yield is not the same thing as the yield per semi-annual period.
Ah, okay. How are they different? Let's clarify. If a bond is quoted as yielding, say, 2% per semi-annual period.
So 2% every 6 months.
Right. Then its semi-annual bond basis yield is simply 4%. You just multiply the periodic rate, 2%, by the number of periods in a year, which is 2.
So periodic rate times frequency gives the basis yield.
Exactly. Getting those terms straight is key to avoid calculation errors when you're comparing bonds. Precision matters here.
Okay, this is really where, like you said, the rubber meets the road analytically. If you're an analyst looking at 2 different bonds, maybe one pays quarterly, the other pays semi-annually, you absolutely need a consistent way to compare their yields.
Can't just compare the stated rates directly.
No way, because the compounding is different. And that's where periodicity conversion comes in. We use a formula, right, to convert an annual percentage rate, APR, from one compounding frequency to another.
The whole goal being to make sure you're comparing apples to apples, bringing yields to a common ground like the ERR maybe, or a common frequency.
And the general formula looks like 1 plus APRM S1 plus APRN yen. What's the intuition behind that formula?
It's basically ensuring that the effective annual rate stays the same, even if you change the stated rate and the number of compounding periods.
Ah, so the left side is the ER for M periods, the right side is the ER for N periods, and you set them equal.
Precisely. You're finding the stated rates, APRM and APRN, that produce the exact same true annual return. It's all about finding that equivalent growth.
Okay. And is there a rule of thumb, like more frequent compounding means?
Yeah, the general rule is compounding more frequently at a lower annual rate gives the same effective return as compounding less frequently at a higher annual rate. You can use that as a quick sanity check.
Let's try a U.S. example, maybe with zero coupon bonds. Periodicity seems a bit weird there, no coupon.
It does, but the principle still holds.
Okay, imagine a 5-year zero coupon U.S. Treasury bond, priced at 80, meaning 80 cents on the dollar. If we just assume annual compounding, periodicity of 1, its yield to maturity, the YTM, is, let's say, 4.564%. Straightforward enough. Now, what if we decided to look at that exact same bond, same price, same maturity, but assume quarterly compounding, periodicity of 4?
Okay.
The yield per quarter, the periodic yield, would be 1.1220%. If we annualize that by multiplying by 4, we get an annual YTM of 4.488%.
See, the stated annual yields are different, 4.564% versus 4.488%. And this perfectly shows that inverse relationship we talked about. Those two stated annual yields, 4.564% annual, 4.488%, quarterly, they look different, but they actually result in the exact same effective annual rate of 4.564% when you compound them appropriately.
Ah, so the underlying return is identical.
Precisely. For any given set of cash flows, the stated annual rate and the periodicity are inversely linked. More frequent compounding needs a lower stated rate for the same effective outcome.
And less frequent compounding needs a higher stated rate.
Exactly. This example really hammers home why understanding periodicity conversion is vital, even for simple zeros. The yield quote depends heavily on the convention used.
Okay, let's try this in an Indian context. Maybe comparing strip bonds to regular coupon bonds. Similar to how Canadian strips are analyzed. In India, you can get strip bonds made from GSECs, government securities, basically zero coupon bonds created from coupon bonds.
Right. Tailored for investors who want a specific lump sum cash flow later, avoids reinvestment risk.
So imagine a hypothetical 20-year Indian GSEC strip bond, priced at, say, 69.43 per 100 face value.
Okay.
And an analyst needs to compare its yield to a new 20-year Indian government coupon bond. This one pays 2% semi-annually, and its semi-annual bond equivalent yield is quoted as 1.880%.
Right, so we need a fair comparison, different structures. First, you'd calculate the strip bond's yield, assuming annual compounding. Let's say that gives an effective annual rate of 1.841%.
Okay, the ER for the strip.
Then you use our conversion formula to turn that 1.841% AR into a semi-annual bond equivalent yield, just like the coupon bond. In this case, it would convert to 1.833%.
So 1.833% for the strip versus 1.880% for the coupon bond on the same basis.
Exactly. Now you have a direct, fair comparison between those two Indian government securities. It reveals their true relative value. It's all about standardizing the return measure, not comparing apples and mangoes.
And just to show how universal this is, let's quickly look at negative yields. We saw those in Europe, right?
He did, yeah. German government bonds, for instance.
Okay, take a 5-year German zero coupon bond issued at a price above par, say 103.72 per 100. That means a negative yield baked in.
Paying more than you get back at maturity.
If we calculate its yield assuming annual compounding periodicity 1, it comes out negative 0.7278%. Now convert that to semi-annual compounding periodicity 2. The yield becomes 0.7291%.
A little more negative.
And then convert it to monthly compounding periodicity 12. It goes even further, negative 0.7303%.
Yeah, that often makes people pause. Why does it get more negative with more frequent compounding?
It seems backwards somehow.
It's the same math principle, just flipped. To get the same negative effective annual rate, the same erosion of your principal over the year, you need a lower periodic rate when you compound more often.
Lower meaning more negative in this case.
Exactly. More frequent compounding just amplifies the effect of the periodic rate, positive or negative. So with negative rates, it means more negative hits more often, hence the numerically smaller, more negative yield. The math works the same way.
Okay, so beyond yield to maturity, which is kind of the big comprehensive measure if you hold to maturity, there are other yield measures you'll see out there. They offer different angles, like the current yield. This was really basic, right? Often just for a quick look.
Very basic. Just the bond's annual coupon payment divided by its current flat price. Simple division.
So if we had a bond from, say, Reliance Industries in India, maybe an annual coupon of 32 rupees, and its current price is 987 rupees, the current yield is just 32 divided by 987.
Yep, which comes out to 3.242%. Gives you that quick snapshot of the income stream relative to the price you pay today. But, and this is the important question, why do sophisticated analysts consider it a bit, well, crude?
What's it missing?
It ignores quite a bit that affects the total return. First, it doesn't care about coupon frequency, which we just established, matters for compounding.
Okay.
More importantly, it completely ignores interest on interest, the time value of money piece.
Right, the reinvestment part.
And crucially, it tells you nothing about capital gains or losses. If you buy at a discount, you get a gain at maturity. Buy at a premium, you get a loss. Current yield ignores that completely.
So good for a quick income check, but not the full picture of return.
Exactly. Not comprehensive at all.
Okay, another area where details matter is the timing of cash flows. Like what happens if a coupon payment is due on a Saturday or a public holiday?
You don't usually get paid that day.
Right. It gets pushed to the next business day. This brings us today, count conventions. Understanding these is key for accuracy. The first one is the street convention. This one's kind of the easy way out.
You could say that. It just assumes cash flows happen exactly on their scheduled dates. Ignores weekends, holidays, everything.
Simplifies the math a lot, I imagine, and it's used pretty often in practice.
Very common for quick quoting and trading, yeah.
But then there's the more precise way, the true yield.
This one accounts for the actual payment dates. If a payment falls on a Saturday, it gets pushed to Monday in the calculation.
Okay, so it reflects reality more closely, and because payments might get delayed,
The true yield is never higher than the street convention yield. It's always equal or slightly lower because you're getting the cash slightly later.
Makes sense.
Now, connecting this to market practice, the difference between street and true yield, it's usually tiny, like less than a basis point or two.
So for most day-to-day stuff, street convention is probably fine.
Generally, yes. It's simpler and usually close enough. But for really precise models or maybe some regulatory things, you might need the true yield. It's a nuance, but an important one in fixed income.
Day count conventions get even more critical when comparing different types of bonds. Like in the U.S., corporates versus treasuries.
Right, different conventions there.
Corporates often use 3360. Assumes 30 days a month, 360 days a year. Like, simplifies the calendar.
Yeah, a throwback maybe, but still common.
Whereas U.S. treasuries usually use actual, counts the real number of days.
Which makes perfect sense, but means they're calculated differently.
And that difference can mess up direct yield comparisons. Which brings us to the government equivalent yield.
Yes, the equalizer.
This basically restates a yield from that 3360 basis onto an actual basis, so you can compare them fairly.
How's it usually done? Just a simple adjustment factor.
Often, yeah. Multiply the 3360 yield by 3650/360. Adjusts for those extra 5 days in the year. Let's make this real with a U.S. example. Say a fictional BRWA 5-year corporate bond. Pays 3.2% semi-annually, uses 3360. We compare it to a similar 5-year U.S. Treasury yielding 2.3%, using actual. At first glance, the difference is 90 basis points, right? 3.2 minus 2.3. Looks like a 90 BPS credit spread. But wait, we need that government equivalent yield for the corporate bond. So 3.2% times 360, that comes out to 3.2444%.
Slightly higher because of the actual basis.
Exactly. Now, the true comparable yield difference isn't 90 BPS anymore. It's 3.2444% minus 2.3%, which is 94.4 basis points.
So that day count convention added over 4 basis points to the perceived spread?
Yeah. And a few basis points might seem small, but in tight markets, making precise comparisons, that matters a lot for trading or relative value calls. It's a subtle but potentially significant adjustment.
And it's definitely not just a U.S. thing. Same applies in India. Imagine an investor comparing a corporate bond from, say, State Bank of India, SBI. That might well use a 3360 convention. They're comparing it against an Indian GSEC, which uses actual.
And they need to do the conversion.
Absolutely. Calculate the government equivalent yield for the SBI bond to get a truly fair comparison of the credit premium over the GSEC. Without that step, the spread they see is distorted. Could lead to bad judgments about the risk versus the reward. It's a practical step for evaluating Indian credit.
Okay, one more yield measure to mention quickly. The simple yield. This one's less common globally, right?
Yeah, quite specific. It's mainly used for quoting Japanese government bonds, JGBs.
How's it calculated? It's not just coupon over price.
No, it's the annual coupon payments plus a straight line amortization of any discount or premium, all divided by the flat price.
So it tries to account for the gain loss to maturity, but in a simplified way.
Kind of, yeah. Using straight-line amortization isn't as precise as YTM calculations, but it's the convention for JGBs. Just a reminder that different markets have their own quirks.
All right, so far we've mostly talked about bonds that are pretty straightforward. Pay coupons, pay back principal at maturity.
The plain vanilla stuff.
But what happens when there's a twist? Like, what if the issuer, the company or government, has the right to buy the bond back from you before maturity?
The world of embedded options.
These aren't separate options you can trade, right? They're built into the bond itself.
Exactly. Part of the bond's structure, inseparable. The classic example is a callable bond. You can think of it as having a buyback clause.
So the issuer can call the bond back.
Yes. They have the right, but not the obligation, to redeem the bond early, usually at specific prices set out in the bond agreement, and often only after an initial call protection period. Now, from your perspective as an investor, these options fundamentally change things. They affect the cash flows, the yield, the risk.
How so?
The key thing is, the issuer will only call the bond when it's good for them.
Not when it's good for me, the investor.
Definitely not. This usually happens when interest rates fall. If rates fall below the bond's coupon rate, the issuer can call back that expensive high coupon debt and issue new debt cheaper.
So they refinance. But that leaves me, the investor.
With cash, you now have to reinvest at those new lower market rates. That's reinvestment risk, and it's a major downside of callable bonds for investors. Your potential upside gets capped when rates fall.
So I lose out on those nice high coupon payments I thought I'd be getting.
Exactly. You get compensated for taking that risk, usually with a higher initial coupon or a lower price compared to a non-callable bond, but the risk is real.
Okay, so if a callable bond might not even reach maturity, yield to maturity isn't the only yield we care about.
Correct. You have to consider the possibility of it being called early.
So we calculate the yield to call, or YTC. How does that work?
It's basically the same logic as YTM calculating an internal rate of return.
Yeah.
But instead of using the par value at maturity,
You use the call price at the call date.
precisely, you plug the specific call price and the number of periods until that call date into your present value calculation and solve for the yield.
Price, PMT, 1 plus R, 1 plus R plus PMT plus call price, 1 plus R, where N is periods to call. Let's use that U.S. example again. VIVU Inc. 7-year callable notes, 6.5% semi-annual coupons, so $3.25 per period, callable after 3 years. And there's a schedule of call prices, right? Like maybe 103.25% in years 3-4, then 1 or 2.5% in years 4 to 5.
Yep, often a declining schedule. Let's say the bond's current price is 106.50.
Okay, to calculate the yield to first call, YTC, we assume it gets called at the earliest possible time. End of year 3 here, so 6 semi-annual periods away. The call price is 103.25. So we set the price 106.55 equal to the present value of 6 payments of $3.25, plus the present value of the call price, so $103.25, plus that final $3.25 coupon at period 6.
Right. Then you solve for R, the semi-annual yield, and annualize it.
And in that example, it came out to 5.149%.
Okay. And you do similar calculations for all the other possible call dates and also the yield to maturity if it's never called, which leads to the crucial question for an investor. You've got potentially multiple YTCs plus the YTM. Which one matters most?
There must be one definitive answer.
There is. It's the yield to worst, YTW.
Yield to worst. Sounds ominous.
It's simply the lowest yield among all the possible yields to call and the yield to maturity.
Why the lowest?
Because it gives you the most conservative return estimate. It assumes the issuer will always act in their own best interest, which usually means calling the bond, if doing so, results in the lowest yield for the investor, which corresponds to the lowest cost for the issuer.
So in that VIVU example, if that 5.149% yield to first call was the lowest of all the calculated yields,
then 5.149% is the yield to worst. That's the minimum return you should reasonably expect, assuming the issuer acts rationally. It's a really critical metric for assessing callable bonds.
can we get even more precise? You mentioned valuing the option itself earlier.
Yes, absolutely. Using option pricing models, we can estimate the value of that embedded call option.
Okay.
And the key idea is, if that call option has value to the issuer, the callable bond itself must be priced lower than an identical bond without the call option.
The investor gets a discount for taking on the call risk.
Exactly. Or you can think of it as value of call option equals price of the equivalent option-free bond minus the price of the callable bond. Now, connecting that valuation to yield gives us the option-adjusted yield. This is a really refined measure.
How's it different?
It's the yield calculated after adjusting the bond's price for the value of that embedded option. It essentially tries to strip out the option's impact to show the yield based purely on the underlying bond characteristics.
So it lets you compare a callable bond to a non-callable bond on a more level playing field, focusing just on credit and liquidity risk.
Precisely. It gives you a cleaner sense of the bond's underlying return, removing the distortion caused by the option. Very useful for relative value analysis.
Okay, let's switch gears a bit now and talk about why bond yields move around and how we analyze those movements. It's really useful, isn't it, to break down a bond's yield to maturity into 2 main parts.
Definitely. We typically split it into a benchmark rate and an issuer-specific spread.
Why do that? What does that separation tell us?
It's a powerful framework. It helps us distinguish between the big macro factors affecting all bonds in a market.
Like overall interest rate levels.
Right. And the specific granular factors unique to that particular issuer or bond. It helps pinpoint where the risk and therefore the compensation is coming from. Think of the benchmark rate as capturing the top-down stuff. Expected inflation, the expected real return investors demand just for lending risk-free, the central bank's policy. Things that set the general level of rates.
Okay, the tide that lifts or lowers all boats.
Pretty much. Then the spread captures the bottom-up micro factors. Credit risk is the big one, the chance the issuer defaults. but also liquidity risk, how easy is it to trade the bond, and maybe tax effects.
So benchmark is the market-wide rate. Spread is the extra bit for the specific bonds risks, like in Exhibit 5 often shows, right? YTM equals benchmark plus spread.
Exactly that visualization.
Now, when we choose that benchmark rate, what do we typically use?
The most common benchmark is usually the most recently issued government bond for that currency and maturity. We call these on-the-run securities.
On the run, why are they preferred?
They're usually the most liquid. They trade a lot, have tight bid-ask spreads, easy to buy or sell large amounts. Plus, their coupons are typically close to current market rates, so they trade near par value. All makes them a good, stable reference point. And the opposite of on the run is...
Off-the-run bonds. These are just older government bonds issued previously.
Right, and there's a subtle but important point here. On-the-run bonds often trade at slightly lower yields than off-the-run bonds of similar maturity.
Even though they're both government debt. Why?
It's usually down to that extra liquidity. There's higher demand for the on-the-run issues. Maybe they're easier to finance in repo markets. So that slight yield difference, that liquidity premium, is something to be aware of when picking your benchmark.
Okay, so once we have our benchmark, a really common way to measure the spread is the G spread, or government spread. This sounds straightforward. It's just the yield difference over a government bond.
Pretty much. It's the yield spread in basis points over an actual government bond yield. Or, very often, an interpolated government bond yield if you don't have an exact maturity match.
Interpolated, meaning you calculate it if there isn't one trading.
Exactly. It represents the extra return you get for taking risks beyond the sovereign benchmark, and that interpolation is key in practice. You rarely find a government bond with the exact same maturity as your corporate bond. So if you need a 24-year benchmark yield, but you only have yields for the 20-year and 30-year government bonds.
You don't just pick the 20 or the 30.
No, you calculate a weighted average to estimate the 24-year point on the yield curve. It ensures more accurate comparison, avoiding distortions from maturity mismatches.
Let's use that example of a Russian Federation bond denominated in U.S. dollars over U.S. Treasuries. Say it's a 30-year bond issued 6 years ago, so 24 years less, yielding 3.756%.
Okay.
For our benchmark, we look at U.S. Treasuries. The 20-year yields 2.00%. The 30-year yields 2.25%.
No 24-year treasury listed there, so we interpolate.
Right. The formula was 30-24, 30-20, 2.00% plus 24-20, 2.25%. That gives us
0.60% weight to the 20-year, 40% to the 30-year. Comes out to 2.10% for the interpolated 24-year treasury yield.
perfect. So the G spread is just the Russian bond yield minus that interpolated benchmark. 3.756% minus 2.10% equals
1.656%, or 166 basis points. Now, why is that 166 BPS G spread so significant? What's the big deal?
It tells you exactly how much extra yield you're getting for the specific risks of that Russian bond, right, compared to the risk-free U.S. Treasury.
Precisely. It bundles up the compensation for credit risk, political risk, maybe liquidity risk, all relative to the U.S. government benchmark. If same logic applies in India, right, for comparing corporate bonds to GSECs.
Absolutely. An investor looking at, say, an Infosys corporate bond needs to know its G spread over a comparable Indian GSEC.
If that Infosys G spread widens suddenly, say from 50 BPs to 75 BPs, it could mean trouble at Infosys specifically, or maybe just broader worries about the Indian corporate bond market, making all corporate debt look riskier compared to GSECs. Or maybe liquidity dried up?
And a tightening spread suggests the opposite, improving credit or more demand.
Exactly. It's a vital indicator for tracking credit health relative to the sovereign benchmark in India.
Okay, moving on from G spread, there's also the I spread, or interpolated spread.
Yeah.
What's the benchmark here?
Instead of government bonds, the I spread uses interest rate swap rates as the benchmark. Same currency, same tenor.
Swap rates, why use those?
It's very common for pricing and quoting euro-denominated corporate bonds. Often, the swap curve in euros might be seen as a more consistent or liquid benchmark across all maturities compared to individual government bonds from different Eurozone countries.
Ah, okay. And it helps issuers compare funding costs.
Yeah, it helps them compare issuing fixed-rate bonds versus alternatives like floating-rate bank loans, which are often priced off swap rates. The I spread is often seen as a good measure of pure credit risk, especially if the swap rate itself is considered a better reflection of a market-based funding rate than a government bond yield, which can sometimes have its own specific supply-demand quirks.
You mentioned asset swaps earlier. How do they relate?
Right, an asset swap basically converts a fixed coupon bond into a floating rate payment plus a spread. That resulting asset swap spread is itself a market-based measure of the bond's credit risk over a floating reference rate, kind of like the I spread. So the I spread gives you that market perspective on credit relative to the swap market benchmark.
Can we see both G spread and I spread for the same bond? Like on a Bloomberg terminal?
Oh, yeah, absolutely. Take that hypothetical 3.75% Apple bond maturing way out in 2047.
A Bloomberg screen, like the FIRV function, might show its G spread over treasuries as, say, 76 basis points. But its I spread over the relevant swap rate might be shown as 106 basis points.
Now, that's fascinating, isn't it? The I spread is bigger than the G spread for the same Apple bond. What does that tell you?
It must mean that the benchmark treasury yield was lower than the benchmark swap rate at that time?
Exactly. Maybe there was huge demand for treasuries pushing their yields down, a flight to quality, or something specific was happening in the funding markets affecting the treasury swap spread.
So understanding why the spreads are different gives you deeper market insight.
Absolutely. It helps you connect the dots between different parts of the fixed income world.
Okay, now for a more complex one, the Z spread, or zero volatility spread. How is this different from G spread or I spread?
It's quite different. G spread and I spread are simple differences between two single yields, YTM versus benchmark YTM or swap rate. The Z spread is more sophisticated. It's a constant spread that you add to every single spot rate along the benchmark zero coupon yield curve.
The entire curve, not just one point.
The entire curve. And you find the one constant spread that makes the present value of all the bond's cash flows, when discounted using those spread-adjusted spot rates, exactly equal to the bond's current market price.
Okay, so the intuition is it accounts for the whole term structure of interest rates, not just one benchmark yield.
Precisely. It doesn't assume a flat yield curve like comparing YTMs implicitly does. It uses the actual shape of the benchmark spot curve.
The formula looks more involved. Price, PMT, 1 plus Z1 plus Z1 plus Z1 plus Z1 plus ZN, 1 plus ZN plus ZN, where Z's are the spot rates and Z is that constant spread we solve for.
Yep, that's the concept. You typically need a solver to find Z. So why bother with this complexity? Why use the Z spread?
It must give a better picture somehow.
It does. It's often called the static spread because it's constant across maturities. It's really good for looking at the term structure of credit spreads for an issuer. Gives you a more robust view of how credit risk is priced across different time horizons.
Because it uses the actual spot rates for discounting each cash flow.
Exactly. It's a more accurate measure of the spread, especially when the yield curve isn't flat.
Let's try that Indian context example. PT Indonesia Infrastructure Finance, IIF bond. USD denominated 1.5% semi-annual coupon, 2 years left, trading at 100.45.
Okay, and we'd need the benchmark government spot rates for 6, 12, 18, and 24 months.
Right. Now, first we could calculate the simple G spread. If the IF-YTM is 1.271% and the comparable government YTM is 0.373%, the G spread is 89 basis points.
Okay, baseline comparison.
But for the Z spread, we'd use that formula. Plug in the price, 100.45, the cash flows, $1.75 coupon at 6, 12, 18 months, $100.75 principal plus coupon at 24 months. And the corresponding government spot rates, Z1, Z2, Z3, Z4. Then we solve for that constant Z that makes the equation balance. Using a solver, maybe it comes out to 27 basis points.
Yeah, look at that. The G spread was 89 BPs, but the Z spread is only 27 BPs. Quite different.
Why the big difference?
It highlights that the Z spread, by using the whole spot curve, gives a more accurate, holistic picture of the spread compensation, especially if the curve is steep or humped. The G spread, relying on YTMs, can be distorted by the curve shape. The Z spread is generally considered a superior measure of the true static spread over the benchmark curve.
Okay, finally, let's bring options back into the picture. We have callable bonds, putable bonds. How do we measure spreads for them?
That's where the option-adjusted spread, or OAS, comes in. It builds directly on the Z spread.
Option adjusted, so it accounts for the option value.
Precisely. It takes the Z spread and then adjusts it for the value of any embedded options, like that call option we discussed. It tries to strip out the option's impact on the spread.
How is it calculated? Z spread minus the option value.
Essentially, yes. OAS is Z spread option value, expressed in basis points per year. Why is OAS so powerful? What does it represent?
It must be giving us the pure spread without the option noise.
Exactly. It represents the yield spread over the benchmark spot curve that's purely compensation for the bond's credit and liquidity risks after accounting for the value of the embedded option.
So it allows a truly clean comparison between callable, boopable bonds
and option-free bonds.
That's the goal. It gives you the cleanest possible measure of the non-option related spread, making it invaluable for relative value analysis involving bonds with embedded options. Understanding OAS is really a hallmark of sophisticated fixed income analysis. #tag outro.
Wow, okay, that was quite a deep dive today, wasn't it?
We covered a lot of ground on yields and spreads.
We really did. We tackled all those complexities of yield and spread measures for fixed-rate bonds, really tried to unpack what goes into accurate analysis. We started with periodicity, right? How compounding frequency changes things, and how vital it is to convert yields to compare them fairly.
Getting that ear right.
Then we looked at other yield measures, like current yield, and the importance of day count conventions, street versus true, 3360 versus actual, and that government equivalent yield calculation. And then the whole section on embedded options, callable bonds, yield to call, and that crucial yield to worst concept for finding the most conservative return.
Yeah, understanding what happens when the issuer has choices.
And finally, we really dug into the spreads. G spread, I spread, the more robust Z spread, using the whole spot curve, and then capping it off with the option-adjusted spread, OAS, to handle those embedded options cleanly.
Quite the toolkit. So what's the bottom line for you, the learner, working through this? It means you now have this really comprehensive set of tools. You can go way beyond just looking at a yield number.
You can actually understand what you're being compensated for.
Exactly. Is it credit risk? Liquidity risk? Is there an option involved? This knowledge helps you make much smarter investment decisions, spot relative value, and really grasp the nuances of fixed income.
Okay, so that officially wraps up Module 07. We've built a really strong foundation here for fixed-rate bonds. Next time, we'll dive straight into Module 08, and our focus will shift to yield and yield spread measures for floating-rate instruments.
Yeah, floaters bring their own unique set of calculations and considerations. It'll be interesting. And as you digest all this, maybe think about this. We live in a world just drowning in data, in numbers. But the real edge, the real power, doesn't just come from having the numbers.
They come from understanding them.
Exactly. Understanding how they're calculated, what assumptions are baked in, and what they truly represent about risk and return. So the question for you is, how might this deeper understanding of yields and spreads fundamentally change how you evaluate every single investment opportunity that comes across your desk? Welcome, curious learners, to the Deep Dive. Really glad you could join us today. We're continuing our journey through the CFA Level I 2025 Fixed Income Volume 6 course, and today we're diving into Module 08, Yield and Yield Spread Measures for Floating Rate Instruments. This is where things get, well, a bit more dynamic than the fixed-rate bonds we've looked at so far. We're talking instruments that react to market changes, which is super important for actual investing.
Absolutely. Fixed-rate bonds, they're foundational, no doubt. But, a huge chunk of the debt market globally doesn't work that way. We're talking variable cash flows or things with really short maturities. So understanding floaters and money market stuff, too, it's not just theory. It's really essential for managing risk day to day, for how companies get funding, for making smart investment choices when rates are moving around. So today, we'll break down how they work, how we measure their yields, and critically, how to compare them without getting tripped up.
Sounds like a plan. Building the practical toolkit. And just a quick heads up, after we get through this module, we'll be moving right along to Module 09, the term structure of interest rates, spot, par, and forward curves. That one builds directly on what we covered today about yields and rates. So good stuff ahead. Okay, let's start unpacking these floating rate instruments, or FRNs. When we talk about them, what's the fundamental difference compared to the fixed-rate bonds we're maybe more familiar with? What makes them float?
Right, good place to start. The core idea of an FRN, a floating rate note, is, well, it's right there in the name. The interest payments aren't fixed, they float. What that means practically is the interest you get, the coupon, it's based on two main things. First, there's an observed market reference rate, the MRR. I think of that as a benchmark like SOFR in the US or Euribor in Europe or maybe MIBOR in India. Moves with the market. And second, there's a quoted margin. That's a specific spread, could be added to or sometimes even subtracted from that MRR. So your coupon is basically MRR plus or minus that fixed margin on an annualized basis.
Okay, so MRR plus a spread. But how often does that change?
Good question. That's the dynamic part. These interest payments are reset periodically, could be every quarter, maybe semi-annually, sometimes even monthly. And on each reset date, the coupon adjusts based on whatever the MRR is at that time. And the payment itself is usually made in arrears. That just means the rate for a period, say January to March, is determined right at the start on January 1st.
But the actual cash payment happens at the end, March 31st.
Exactly. Paid in arrears. Rate set at the beginning, payment at the end. It gives certainty for the period. And just like with fixed-rate bonds, you need to pay attention to day count conventions like actual 360 or actual 365. They matter for calculating the precise coupon amount. It ensures everyone's on the same page, calculation-wise.
Got it. So the rate adapts to the market, but that quoted margin, you said it's specified, like fixed. Is that where the issuer's specific risk comes in?
You're jumping ahead a little bit. Yes, that's exactly right. The quoted margin is fixed when the bond is issued. It's part of the contract. And initially, yes, it's meant to compensate for the issuer's credit risk compared to the benchmark rate. Before we get deeper into the margins, and there are two important types, let's quickly touch on why anyone would even use these things. Why issue or buy an FRN with this variability?
Right, yeah. Why bother with the float? What's the strategic advantage? It seems more complicated than just a fixed coupon.
Well, the biggest reason for both issuers and investors is a significant reduction in price risk when market interest rates are bouncing around. Think about a standard fixed-rate bond. If rates go up after you buy it, the value of your bond goes down, right? Because its fixed coupon is suddenly less attractive. FRNs, not so much. Because their coupon resets periodically to the current market rate, their price tends to stay much, much closer to par value. That automatic adjustment is huge in volatile rate environments.
Oh, okay. So less worry about the price crashing if interest rates spike.
Exactly. It dampens that price volatility significantly. Beyond that, they're also really powerful hedging tools. Imagine a bank. A lot of their funding might come from short-term deposits, which are essentially floating rate liabilities. The interest they pay can go up if market rates rise. Now, if that bank also makes floating rate loans, which are assets for the bank, their income also goes up when rates rise. See the match?
Yeah, income goes up, cost of funds goes up. They kind of offset each other, asset and liability matching.
Precisely. It's crucial for banks. If their liabilities are mostly floating, they really want their assets to be floating too. Otherwise, a sudden rate hike could crush their profit margins. Their funding costs would soar, but their loan income would stay flat. That's a recipe for disaster. In fact, that's why most commercial loans, business loans, even some mortgages are floating rate. It helps the lender manage their own interest rate risk.
That makes a lot of sense for banks managing their balance sheets. Okay, so we've got the why. Now back to those margins you mentioned. You said the quoted margin is fixed. But what happens if the market's view of the issuer's risk changes after the bond is issued? Like, if a company starts looking shakier, this is where the two types of margin come in, isn't it?
Exactly right. This is probably the most important concept for understanding FRN pricing after issuance. You absolutely have to distinguish between the quoted margin, QM, and the required margin, which is also called the discount margin, DM. They sound similar, but they do different things. The quoted margin QM, that's the easy one. It's the fixed spread over or under the MRR that's stated right in the bond contract when it's issued. So if a bond launches as SOFR plus 150 basis points, that 150 BPs is the QM. Its job initially is to compensate the investor for the issuer's credit risk relative to whatever risk is in the MRR itself. If the MRR is near risk-free, the QM is pretty much just the credit spread for that specific company at that time. And interestingly, for super safe issuers, think maybe a top-tier sovereign entity or a AAA-rated global corporation, they might even issue with a negative quoted margin. Investors might accept slightly less than the MRR because the security is so safe and liquid.
Okay, QM is the promise made at the start. What about the required margin, the DM?
Right, the required margin DM or discount margin. This one is dynamic. It's the spread over or under the reference rate that the market demands right now for that specific FRN, such that the FRN would be priced exactly at par on a reset date. Think of it like the market's current required yield spread for that specific bond's risk. It reflects all the current information, the issuer's creditworthiness, the bond's liquidity, maybe tax changes, anything that affects its perceived risk today. So while the QM is stuck in the contract, the DM floats with market sentiment. If a company gets downgraded, the market will demand a higher DM instantly. If it gets upgraded, the DM might fall.
Okay, so QM is the contract, DM is the current market reality. Huge difference. So
Yeah.
how does this play out in the price? What determines if the FRN trades at par or above it or below it? This feels key.
It is the key. On a reset date, the price hinges entirely on how the fixed QM compares to the current market DM. It's quite straightforward once you see it. If quoted margin equals required margin, QM equals DM, the FRN trades right at par value, the market's happy, the contractual spread is exactly what the market currently demands for that risk. No premium, no discount. Equilibrium.
Makes sense. The contract matches reality.
If quoted margin is greater than required margin, QMDM, the FRN trades at a premium, above par. Why? Because the fixed QM is offering more compensation than the market currently requires for that level of risk. Investors value those extra basis points each period, so they're willing to pay more than par to get them. The premium is basically the present value of all those future excess payments. The market is saying, hey, this bond pays better than it needs to right now.
Okay, higher contracted payout than currently needed means a higher price.
Got it. And if quoted margin is less than required margin, QMBM, the FRN trades at a discount, below par. Here, the fixed QM is not enough compared to what the market now demands. This usually happens if the issuer's risk profile has worsened. Investors will only buy it below par to make up for the deficient coupon payments. The discount represents the present value of that shortfall. The market's saying, this bond isn't paying enough for its current risk, so it better be cheaper.
That explains why the price moves even though the coupon adjusts. It's all about that required margin changing. Can we walk through a quick example?
Absolutely. Let's use the numbers from the learning materials. Imagine an FRN resetting today. Scenario 1. QM is 150 BB size, but the market's required margin, DM, is now 165 BPS. Here, QM 150 is less than DM 165. The bond isn't paying enough by 15 BPs per period, according to the market. Result, it trades at a discount. Scenario 2. QM is 140 BPS and the market's required margin DM is only 128 BPs. Here, QM 140 is greater than DM 128. The bond is paying an excess 12 BPs per period. Result, it trades at a premium. And if QM happened to be, say, 150 BPs and the DM was also 150 BPs,
Then it would trade right at par.
exactly. So you see, the price on the reset date directly reflects the market's current assessment of the issuer's credit risk via that required margin, compared to the original deal struck via the quoted margin.
That's crystal clear. It demystifies the price movements. Now, the next step, how do we actually put a number on it? How do we value one of these FRNs, especially with both the coupon and the discount rate potentially changing?
Right, the calculation. Well, the good news is the underlying principle is the same as any bond. Present value of future cash flows. It just looks a bit different because the inputs are variable. The simplified model, let's call it equation 1 from your text, captures this. When you calculate the present value, PV, or the price, the cash flow for each future period, the payment, PMT in the numerator, is based on the current market reference rate, MRR, plus the quoted margin, QM. You annualize that, divide by the payment frequency, M, and multiply by the face value, FV. That's your expected coupon payment based on the contract and today's MRR. Then the discount rate you use in the denominator for each period is based on the current MRR plus the discount margin, DM, again divided by M. This reflects the return the market currently requires for that cash flow.
Okay, so MRR plus QM determines the payment, but MRR plus DM determines the discount rate used to value that payment.
Precisely. So conceptually, the formula looks like summing up terms like MRR plus QMM, FV1 plus MRR plus DMT for each period T, plus the final principal repayment, FV1 plus MRR plus DMN, where, just to recap, PV is price, MRR is the reference rate, QM is quoted margin, FV is face value, M is periods per year, DM is discount margin, and N is total periods left. Now, there are simplifying assumptions, like we usually value it right on a reset date, no accrued interest, maybe assume a simple day count like 3360, and often use today's MRR for all future periods, which is obviously a simplification. But it gives the core mechanics.
Can we try that Antilis example from the source, the 2-year semi-annual one?
Sure. So Amplis AG FRN 2-year semi-annual, so M2, and with 4 periods. Inputs were MRR 1.0125M, QM 0.50%, 0.050, FV equals 100. And the market's required discount margin, DM, equals 0.000%, 0.00440. If you plug those into the formula, calculating each semi-annual payment using MRR plus QM and discounting using MRR plus DM, the result is a price, PV, of about 100.196.
And that's a premium, which makes sense because the quoted margin of 0.50% is higher than the required margin of 0.40%.
Exactly. The formula confirms our QM versus DM rule. Now, what's often more useful in practice is the reverse.
Yeah.
You see the market price, and you need to figure out what discount margin the market is implying.
Like solving for yield to maturity on a fixed bond.
Very similar concept. Let's adapt that other Antilis AG example. A 4-year FRN, quarterly payments, M4 and 16. Let's say MRR, managed in 0.55%, negative 55 BPs, quoted margin, QM, inform 50 BPs, 0.0250. And it's currently trading in the market at a price, PV, of 97. What's the implied DM? First, find the periodic payment using the quoted margin, PMT, MRR plus QM, FEM, HO 0.00055 plus 0.08250, 104 equals 0.4875 per quarter. Now, use your financial calculator spreadsheet.
PV equals an evenness 97 outflow, FE equals 100 inflow at end, PMT equals 0.4875 in inflow 16. You solve for the periodic interest rate, the calculator gives you our enter 0.06861222. Sign is 0.0 plus DMM, so 0.00686122 needs 0.0055 plus DM4. Solve that equation for DM. Multiply the rate by 4, then add back 0.00055, and you get DM 0.0329, or 329 basis points.
Wow. So the contract promised 250 BPs over MRR, but the market is demanding 329 BPs based on that price of 97.
Precisely. That tells you the market perceives significantly more risk in Antless AG now compared to when the bond was issued, hence the discount price. That 79 BPS difference, 329,250, is the extra compensation the market demands today. That's a really powerful piece of analysis you can derive from the market price.
That really brings it home. Okay, let's make this even more concrete. Can we think about how this plays out for, say, a well-known U.S. company and a major Indian bank, like real-world scenarios?
Great idea. Let's take the U.S. context first. Imagine Apple Inc., a company usually seen as having very low credit risk. Suppose Apple issues a 5-year FRN linked to SOFR, plus a really tight quoted margin, maybe just 50 basis points, resetting quarterly. It's snapped up by investors. Now, fast forward a year. Let's say there's a sudden sharp downturn in sentiment towards big tech stocks globally. Maybe new regulations are announced, or iPhone sales forecasts are unexpectedly slashed. Even if Apple is still fundamentally strong, investors might get nervous about the whole sector, or maybe Apple's credit outlook gets a negative revision. What happens? Investors start demanding a higher required margin for holding tech debt. Maybe Apple's DM bumps up to 75 basis points. The FRN's quoted margin is still stuck at 50 BPS. Since QM50 is now less than the market's required DM 75, that Apple FRN will start trading at a discount to par. The market is pricing in that increased uncertainty or perceived risk.
Even for a giant like Apple. Okay, now how about an Indian example? Maybe a bank.
Okay, Indian context. Let's think about the State Bank of India, SBI, a major public sector bank. Suppose SBI issues a 3-year floating rate bond, FRB, linked to MIBOR, plus a quoted margin of, say, 120 basis points, resetting semi-annually. It's well received initially. Then imagine the RBI, Reserve Bank of India, takes aggressive action to combat inflation, maybe sharply hiking the repo rate multiple times. Or perhaps there's a general concern about rising non-performing assets, NPAs, in the Indian banking system. These events could tighten liquidity and make investors demand higher compensation for holding any bank debt. The required margin for SBI's debt might increase across the board. Let's say it moves up to 150 BPs. What happens to our SBI FRB? Its quoted margin is still 120 BPS. Since QM 120 is now less than the required DM 150, the SBI FRB will trade at a discount on its next reset date. That 120 BPs isn't enough anymore for the market. So for analysts tracking Indian markets, watching how these FRBs trade relative to par gives real-time signals about the market's perception of credit risk for issuers like SBI, independent of that fixed quoted margin.
Now, this brings up another common question people have about floaters. Given they adjust, are they completely free of interest rate risk?
Right. That seems logical at first glance, but maybe too simple. It probably depends on how often they reset, doesn't it?
Yeah.
Like the frequency.
Exactly. You hit the nail on the head. They reduce interest rate risk dramatically compared to fixed-rate bonds, but they aren't entirely immune. The key factor is the time remaining until the next coupon reset date. See, in the period between resets, that coupon rate is effectively fixed. For that short window, whether it's a month, a quarter, or 6 months, the FRN behaves like a short-term fixed-rate bond. So floaters with longer reset periods, maybe annual resets, are actually more exposed to interest rate changes and price swings during that year. If rates jump right after the reset, you're stuck with the old rate for a whole year.
So a longer time between adjustments means more time for the price to deviate if rates move.
Precisely. Conversely, floaters with shorter reset periods quarterly or even monthly have much less price fluctuation. Because the time until the next adjustment is so short, the bond behaves like a very, very short-term fixed-rate instrument. Anyway, changes have minimal impact because the coupon will catch up very quickly. That's why shorter resets are generally preferred if your main goal is minimizing interest rate risk. The sensitivity isn't zero, but it's directly related to that reset frequency.
That's a really important nuance. Okay, this has been fantastic on floaters. Shall we pivot now to that other key part of this module? Money market instruments, these are the really short-term guys, right?
Spot on. We're shifting gears to the very short end of the yield curve now. Money market instruments are defined as debt securities with original maturities of 1 year or less. They are the absolute workhorses of short-term finance. Think about how businesses manage daily cash flow, how banks manage reserves, how governments fund immediate needs. It often happens through the money market. The common types you need to know for the CFA exam and that you see constantly in the real world conclude things like overnight repos, repurchase agreements, super short-term collateralized loans, vital for central bank operations and interbank lending, bank certificates of deposit, CDs, time deposits with banks, commercial paper, CP, short-term IOUs from large corporations like, say, Reliance in India or maybe General Electric in the U.S., treasury bills, T-bills, short-term government debt issued by the U.S. Treasury or the RBI in India, considered very safe. Also things like bankers' acceptances, often used in trade finance, and simple time deposits. They're a huge source of funding, and for investors, they're key alternatives to just holding cash in a bank account, especially via money market mutual funds.
High liquidity, generally low risk. Okay, now this is really, really important. If you just try to apply your regular bond math to money market instruments, you are going to run into trouble. You'll miscalculate returns, you'll make bad comparisons. There are three fundamental differences you have to get straight.
Okay, lay them on us. What are the traps?
First, simple versus compounded interest. Bond yields, like yield to maturity, are annualized and compounded. Money market returns. They're usually annualized, but based on simple interest. No compounding within the year is assumed in the standard quote. That's a big difference in how the return actually accrues. Second, periodicity. Bonds often have a standard periodicity, like semi-annual in the U.S., money market instruments. Their periodicity for the annual rate is all over the place, typically linked to their actual maturity. A 90-day instrument has a different implicit period than a 180-day one, makes comparing quoted rates directly very difficult. Third, non-standard pricing. Bonds use standard time value of money discounting. Money markets. They often use these unique, quote, conventions, specifically discount rates and add-on rates, which require different formulas and have different implications.
Okay, simple interest, weird periodicities, and non-standard quotes. Got it. Let's tackle those quotes. You mentioned discount rates. This sounds like the price is lower than face value, right? Which instruments use this?
Exactly. Instruments like commercial paper, CP, treasury bills, T-bills, and bankers' acceptances are very often quoted on a discount rate basis. The concept is that the interest is kind of front-loaded into the face value. You buy the instrument at a discount to its face value. At maturity, you just get the full face value back. The difference between what you paid, PV, and the face value, FE, is your interest earned. The formula to find the price, PV, is PV equals FE AA 1, days year, AGR. Where days is days to maturity, year is the convention, often 360 for T-bills, sometimes 365, and DR is the annual discount rate quote. And if you know the price, you can find the discount rate, DR equals year days, FV, PV, FE.
Okay, that formula seems straightforward. Wait, look at the denominator in that second formula. It's FV, the face value.
Ah, you spotted it. That is the critical point about discount rates. The interest earned is FVPV, but the rate is calculated by dividing that interest by the face value, FV, not by the present value, PV, which is what you actually invested. Since PV is always less than FV, if there's any interest, dividing by the larger FV makes the calculated discount rate lower than the true rate of return on your actual invested capital.
So the quoted discount rate always understates your actual return percentage, like an optical illusion.
Exactly. It understates the investor's return and the issuer's true cost of funds. It's just a quoting convention, but you have to know its limitation. Let's take that Indian T-bill example. A 91-day T-bill, face value INR 10 million, quoted DR of 3.45% using a 360-day year. Price PD equals 10 million, PE 91,360, EPOPOL 0.0345, INR 9,912,625. You invest 9.91 million, get back 10 million. The interest is about 87K. But the 3.45% rate was calculated using the 10 million FE in the denominator, not your 9.91 million investment. So 3.4% understates your actual return on investment. Crucial to remember that when looking at RBI auction results or T-bill quotes. Okay, so that's discount rates. The other main type is the add-on rate, AOR, and this one tends to be much more intuitive. The name says it all. The interest is calculated on your principal and then literally added on to determine what you get back. This is commonly used for things like bank CDs, repos, and also for those market reference rates, MRRs themselves. The formula is usually shown solving for the future value, FV, PVA, 1 plus days year, AOR.
Here, PV is your initial principal. FV is what you get back, principal plus interest. Days is days to maturity. Year is the day count, 360 or 365. And AOR is the annual add-on rate. And if you want to calculate the AOR itself, AOR, your days, PV.
Ah, look, the denominator there is PV, the actual amount invested.
Exactly. That's why AOR is a much better reflection of the true simple interest return on your investment. It directly compares the interest earned, FVPV, to the amount you actually put in, PV. Makes much more intuitive sense.
Sure.
Let's use that U.S. context example. A big bank like JP Chase issues 90-day CDs. The quoted AOR is 0.12% using a 365-day year. If you invest USD 20 million PV, FE equals 20 million, 1 plus 90,365, AP is 20 million, 5,918. You get your 20 million back plus about $5,918 in interest. That interest was calculated based on the 20 million principal. Straightforward.
Okay, so we have discount rates understating returns, add-on rates being more direct, plus different day counts. It really is a mess for comparison. So, the million-dollar question, if I'm looking at a T-bill quoted on a discount basis with a 360-day year and a CD quoted on an add-on basis with a 365-day year, how do I actually figure out which one gives me a better return? How do we make it apples to apples?
That is the core challenge, and you've nailed why it's so important. Direct comparison of those raw quotes is completely misleading. You need a level playing field. The solution is the bond equivalent yield, BEY. Think of BEY as a universal translator for money market instruments. A BEY is defined as a money market rate stated on a 365-day add-on rate basis. That's the standard. So the process is to convert any money market quote, whether it's DR or AOR using 360 or 365 days, into this standard BEY format. Once they're all in BEY, you can compare them directly.
Okay, how do we do that conversion, especially from a discount rate?
It's a two-step process, typically, when converting from a discount rate, DR, to a bond equivalent yield, BEY. Step 1. Find the price, PV. Use the discount rate formula PV equals FE, 1 day's year, FDR, making sure to use the correct day count convention, 360 or 365, associated with that specific DR quote. You need to know the actual investment amount. Assume FV100 is not given. Step 2. Calculate the 365-day add-on rate. Now, using the PV you just calculated and the FE, usually 100, calculate the equivalent add-on rate. BUT, crucially, you must use 365 for the year in the AOR formula. AOR, 365 days, S, FE, PV, TV. This resulting AOR is the bond equivalent yield.
Got it. Calculate the real price first, then calculate the add-on return based on that price, always using 365 days for the final AOR calculation.
Perfect. Let's apply that to the Indian context comparison. We had a 90-day Reliance CP, DR equaled 0.100% 360-day year, and a 90-day HDFC Bank CD, AOR equal 0.120% 365-day year. For the Reliance CP, step 1, price. PV equals 193,060 and 0.001 99.975. Step 2, BEY. BEY is 365.90, 899.975, and 0.1014, or BB1.101%. Now, the HDFC Bank CD, it's already an AOR using a 365-day year, so its BEY is 0.101%. Conclusion, the HDFC Bank CD actually offers the higher comparable return. Assume a similar risk. See how the conversion was essential.
Definitely. The initial quotes, 0.100%, WEOs 0.120%, were misleading without the BEY conversion. Okay, how about that U.S. example with 4 instruments? Does BEY change the ranking there too?
It often does. Let's revisit those 480-day U.S. instruments. AT-bill, DR 4.33%, 360-day. BCP, DR 4.36%, 365-day. C-mini CV, AOR 4.35%, 365-day. If you meticulously convert each one to its BEY, calculate PV for A and B, then calculate the 365-day AOR for all. Instrument A T-bill converts to a BEY of 4.487%. Instrument B, CP, converts to a BEY of 4.456%. Instrument C, Moody CD, needs conversion because it used a 360-day year. Its BEY is 4.410%. Instrument D, Bank CD, is already a 365-day AOR, so its BEY is 4.450%. Look at the ranking now. The T-bill A, with the lowest initial DR quote, actually has the highest BEY at 4.487%. And Instrument D, which looked highest initially at 4.45%, is actually third. Instrument C is lowest. It powerfully demonstrates never trust the raw quotes. Always convert to BEY for comparison. Okay, one final conversion sometimes needed. We've compared money market instruments to each other using BEY, but what if you need to compare money market yield to, say, a longer-term bond yield that's quoted with semi-annual compounding?
Ah, right. BEY gets us to a standard money market basis, but bonds often compound differently.
It's exactly. Money market BEY is still a simple interest, 365-day add-on rate. Its implicit periodicity in EM is 365 days. A bond might have periodicity in T-bill 2, semi-annual. We need to bridge that gap using periodicity conversion. The formula connects rates with different compounding frequencies, 1 plus APRM, 1 plus APRNNN, or APRM is the rate with M periods per year, and APRN is the equivalent rate with N periods per year. Let's use that Indian rupee T-bill example. It's a 91-day T-bill with a BEY APRM of 3.50%. The periodicity M is 36591.
We want to find the equivalent rate APR on a semi-annual bond basis, and just 2. So 1 plus 0.035, 36591, 36591. You solve this for APR2. It requires a bit of algebra or a calculator function, but the result is APR2 pairwise EPR2 to 3515, or 3.515%. It's a small difference here, 1.5 pp's. But it shows that the compounding frequency matters. Converting the T-bill's BEY to an equivalent semi-annual bond yield gives you the truly comparable figure for portfolio analysis across different maturity sectors.
Wow, okay. We have covered a ton of ground today, from the way floating rate notes react to market demands via margins, all the way to the sometimes confusing world of money market quotes and the absolute necessity of BEY. If you had to boil it down, what are the absolute must-remember takeaways for our listeners from Module 08?
Okay, the big picture summary. For floating rate instruments, FRNs, remember their coupons float. MRR plus a quoted margin, QM. The absolute key insight is the difference between that fixed QM and the market's dynamic required margin, DM. Their relationship, QM versus DM, determines if the FRN trades at par, premium, or discount on reset dates. This reflects changes in credit risk. And remember why they exist. Managing interest rate risk, especially for institutions doing asset liability matching. Then, for money market instruments, think short-term, 1 year less, simple interest, and liquidity. Be super aware of the quoting conventions. Discount rates, DR versus add-on rates, AOR, and the 360 versus 365-day year issue. Critically, remember that DRs understate the true return because they use FE in the denominator. And therefore, for any comparison between different money market instruments, you absolutely must convert everything to the bond equivalent yield, BEY, the 365-day add-on rate. That's your level playing field. As you go further into finance, you'll just keep encountering more and more instruments, more conventions, more jargon. The real skill isn't just memorizing definitions.
It's about digging into the mechanics, understanding how things are priced, and crucially, recognizing how different ways of quoting things can sometimes obscure the reality. Always ask yourself, am I really comparing apples to apples here? Or is this just a difference in how the rate is presented? That kind of critical thinking, that questioning, that's honestly your best asset in this field.
That is a brilliant thought to end on. Always question the quote. Thank you so much for guiding us through all that complexity today. I really hope everyone listening feels much more confident tackling floating rate notes and money market yields after this deep dive into Module 08. Definitely review these concepts, maybe try those calculations yourself, and don't forget the fixed income journey rolls on. Next time, we'll be tackling Module 09, the term structure of interest rates. Spot, par, and forward curves. We'll build directly on today's yield concepts to see how rates behave across different maturities. It's going to be fascinating. Until then, keep learning, keep questioning, and keep deep diving into the world of finance. Welcome, everyone, to the Deep Dive. Today, we're pulling back the curtain on something really fundamental in fixed income. It's easy to think of the interest rate, but the reality is, well, much more dynamic than that. So we're digging into how interest rates actually behave across different time horizons. It's critical stuff. We're focusing on Module 09, the term structure of interest rates, spot par, and forward curves. This is, of course, from the CFA Level I 2025 Fixed Income Volume 6 course material. Our goal today is really to give you that deeper insight, maybe a shortcut to really grasping this.
That's exactly right. We need to move past this idea of just, a single interest rate for everything.
Yeah.
Our mission today is to define, calculate, and compare 3 really interconnected yield curves. We've got the spot curve, the par curve, and the forward curve. And look, these aren't just like theoretical concepts. They are the absolute foundation, the default risk-free foundation for valuing pretty much every fixed income instrument out there. Understanding them tells you about market expectations. It influences strategy. Honestly, it's non-negotiable if you're serious about finance.
Okay, so it sounds like we're really getting into the very fabric of bond pricing and what the market is thinking. I'm genuinely curious to see how these pieces fit, how they give us a more nuanced picture for making decisions. This feels like where the real analytical muscle comes in.
Indeed. And this knowledge, once we nail this down, it leads us perfectly into our next deep dive. So keep in mind, when we wrap up here, we'll be jumping straight into Module 10, interest rate, risk, and return. That's where we'll see exactly how changes in these rates affect bond portfolios, gains, losses, the whole picture. It's a direct link.
Okay, let's unpack this then. Before we build these other curves or try to guess future rates, we absolutely have to get our heads around the most basic one. The spot curve. This is the starting point, right? The pure time value of money.
You've hit the nail on the head. The spot curve is the cornerstone. So let's define spot rates. Simply put, they're the market discount rates on default risk-free zero-coupon bonds. You'll often hear them called zero rates too. Now, default risk-free, that's key.
We're talking about bonds with essentially zero credit risk. Think U.S. Treasuries or Indian government securities, GSECs. We're stripping out credit risk. And zero coupon is just as important. It means the bond makes only one payment right at maturity, no coupons along the way. So that eliminates reinvestment risk. You don't have to worry about what rate you'll reinvest your coupons at. This combination makes spot rates the purest measure of the time value of money for a specific maturity. No other complexities muddying the waters.
Okay, so it's like the pure cost of money for a specific length of time with no other noise. Is that the gist of it? And the spot curve itself is just like plotting these pure rates for different maturities.
You've got it, exactly. The sequence of these spot rates, from short-term out to long-term, that forms the spot curve. And their importance, it's huge. Because, you see, by using this specific sequence of spot rates to discount each separate cash flow of a bond every coupon, the final principle you get what's called the no arbitrage price. Think about no arbitrage. It basically means no free lunch. If a bond's price in the market was different from this calculated value, well, theoretically, an arbitrage opportunity would exist.
Ah, like buying low and selling high instantly with no risk.
Precisely. Smart traders would jump on that immediately, make a risk-free profit, and in doing so, push the price back to where the spot curve says it should be. So the spot curve shows us that fundamental equilibrium price. It's really powerful.
That makes a lot of sense. It's the theoretical ideal of the market's sort of internal benchmark for fair value. But imagine finding these perfect default risk-free zero coupon government bonds for every single maturity. That sounds tough. Like finding a needle in a haystack.
You're pointing out a really critical practical issue. It's a major challenge. Ideally, yes, we build the curve using actual traded zero coupon government bonds for all maturities that would perfectly satisfy the other things being equal. Idea, same currency, credit risk, liquidity, tax treatment, no reinvestment risk. Perfect. But reality, it's messy. Actively traded true zero coupon government bonds across all maturities. They're pretty rare. Most government bonds, U.S. Treasuries, Indian GSECs, they pay coupons. So you have that reinvestment risk we just mentioned.
Okay, so if the ideal ingredients aren't really available, how do analysts actually cook up these spot curves in the real world? What are the workarounds or compromises, and how reliable is the final result?
All right, this is where the practical side of bond analysis kicks in. There are a few key issues in how we deal with them. First, liquidity differences. Brand new bonds, the on-the-run ones, they trade a lot. Older bonds, seasoned ones, not so much. Their yields might be slightly different just because of that. Then there are tax differences. Depending on whether a bond trades at a discount or premium because rates have moved, there could be different tax implications, capital gains versus income. That can subtly affect yields too. And, of course, limited data points. Governments issue bonds at specific maturities, 2-year, 5-year, 10-year, 30-year maybe, but not for every single month in between. There are gaps.
Right. So the picture gets a bit blurry with these real-world bonds. What's the standard procedure analysts use to build a useful curve despite all this?
Okay, so in practice, analysts usually start with the most recently issued, most actively traded coupon-paying government bonds. These on-the-run issues tend to have similar liquidity and are often priced near par, which minimizes some of those tax distortions. Because we only have yields for specific maturities, we need to fill the gaps. One key technique is called bootstrapping. It's basically a step-by-step process. You might start with a short-term zero rate, if available, then use the yield of a 1-year coupon bond to figure out the 1-year spot rate, then use the 2-year coupon bond and the 1-year spot rate you just found to calculate the 2-year spot rate, and so on. You build it out sequentially.
Okay, building block by building block.
Exactly. And then, to fill the gaps between those calculated points, analysts use interpolation. Could be simple straight-line interpolation or more complex methods like splines to get a smooth curve. Also, very short-term stuff like treasury bills, 1 month, 3 month, 6 month, they're often quoted on a discount basis. Those need to be converted to a bond equivalent yield to be consistent with the rest of the curve. And one more crucial thing, all the yields used must be converted to the same periodicity, usually annual or semi-annual, for a fair comparison. You can't compare apples and oranges or annual yields and semi-annual yields directly.
That makes it much clearer. So we're constructing the best possible picture given the available data and tools. Now, once we have this spot curve, what does its shape tell us? Is an upward slope saying something different than a downward slope? It feels like reading the market's mood.
Oh, absolutely. The shape is incredibly informative. It gives us huge clues about market expectations. The most common shape is an upward sloping spot curve, often called a normal yield curve. This just means longer-term government bonds have higher yields than shorter-term ones. Exhibit 1 in the material shows this. Typically, this suggests the market expects economic growth or maybe inflation down the road. Investors demand more compensation for locking up money longer if they think rates might rise or inflation will eat away returns.
That seems logical. If the economy is expected to grow, you'd want a higher return for lending longer. But are these signals always accurate? Is an upward curve a guaranteed sign of growth? And what about other shapes, inverted curves?
Good point. It's not a perfect crystal ball. Sometimes a steep upward slope might just reflect a large-term premium extra compensation for the uncertainty of inflation far in the future, or maybe less liquidity in long bonds, not just pure growth expectations. Smart analysts always look at it alongside other economic indicators. Now, the opposite scenario is a downward-sloping spot curve or an inverted yield curve. This is when short-term yields are actually higher than long-term yields. It's less common, but historically it's been a pretty strong signal, often preceding economic slowdowns or recessions.
Why would that be?
Well, it suggests investors think future short-term rates will be lower. So they're willing to lock in today's long-term yields, even if they're lower than current short-term yields, maybe because they expect the central bank to cut rates soon to fight a recession. And then, of course, you can have flat curves, where rates are pretty much the same across maturities. That might signal uncertainty or expectations of stable conditions.
Okay, this is great for getting a feel for the market's pulse. Let's get down to the brass tacks now, the calculation. How do we actually use these spot rates to price a specific bond? This is where that no arbitrage idea becomes really concrete, isn't it?
Exactly. This is the direct application. The formula might look a bit scary, but the concept is straightforward. The present value, or PV, the price of the bond today, is found by taking every single future cash flow each coupon, the final principal payment, and discounting it back to today using the specific spot rate that matches its payment date. So for a bond paying coupons over N periods with coupon PMT and face value FV, it looks like this. PV equals PMT1 plus Z11 plus PMT1 plus Z22 plus twice PMT plus FV1 plus ZNN. Z1 is the 1-year spot rate, Z2 the 2-year, and ZN is the spot rate for the final maturity N. Each cash flow gets its own unique discount rate based on when it arrives.
Okay, let's walk through that example from the source material. A 3-year bond, 5% annual coupon, 100 par value, and the spot rates are 1 year is 2%, 2 years 3%, and 3 years 4%. How does the formula work step by step here?
Perfect. Let's break it down. Step 1. The year 1 cash flow is a $5 coupon. We discount it using the 1-year spot rate of 2%. So 5 divided by 1.02 to the power of 1. That gives us 4.902.
Okay, the present value of that first coupon.
Step 2. The year 2 cash flow is another $5 coupon. We discount this using the 2-year spot rate of 3%. So 5 divided by 1.03 squared. That comes out to 4.713.
Got it.
Step 3. The year 3 cash flow is the last $5 coupon plus the $100 principal, so $105 total. We discount this using the 3-year spot rate of 4%, so 105 divided by 1.04 cubed. That's 93.345.
Okay.
Step 4. Now just add them up. 4.902 plus 4.713 plus 93.345 equals 102.960. That 102.960 is the no arbitrage price of this bond today, given those spot rates. See how each payment is valued based on its specific timing. It's not just one rate slapped onto everything.
That's incredibly clear. It really shows how each piece contributes based on when it's paid.
Okay, but this example uses a risk-free bond. What about corporate bonds? Say something from Apple in the US or maybe Reliance in India. They have credit risk. Crucial distinction, absolutely. What we just calculated is for a default risk-free instrument. If you're pricing a bond with credit risks like Apple or Reliance, you need to adjust. You take those risk-free spot rates, Z1, Z2, Zn, and add a credit spread to each one. So the denominator becomes, say, 1 plus Zn plus credit spread N. That spread compensates investors for the extra risk, the risk the company might default, or maybe the bond isn't as easy to sell quickly, the liquidity risk. The size of the spread depends on the company's credit rating, the industry, market conditions, all sorts of things.
Okay, let's ground this with some real-world examples then. How does this spot curve concept play out in major markets like the US and India?
Certainly. In the U.S., the benchmark default risk-free instruments are U.S. Treasury bonds. Now, while many treasuries pay coupons, the market has a clever way to create zero-coupon instruments called strips. That stands for separate trading of registered interest and principal securities. Essentially, dealers take a regular treasury bond and break it down into individual coupon payments and the final principal payment, selling each piece separately as a zero-coupon bond.
Ah, so they create the zeros themselves.
Exactly. And the yields on these strips directly represent spot rates for various maturities. They're heavily used by, say, pension funds or insurance companies needing to match very specific future liabilities. So analysts build the U.S. Treasury spot curve using these strips, or by bootstrapping from coupon treasuries. This curve is the benchmark. Then, if an investment bank is pricing a new bond for, say, Apple, they'll take the Treasury's spot rates for each cash flow's maturity, add an appropriate credit spread for Apple's risk, and use our formula to find the price.
That strips example is really helpful for the U.S. What's the equivalent process in India? How is the benchmark GSEC spot curve built and used?
Very similar principles apply in India. The benchmarks are government securities, or GSECs, issued by the government via auctions managed by the Reserve Bank of India, RBI. Most GSECs also pay coupons. So market participants, banks, financial institutions, data providers like NSDL, they construct an implied GSEC spot curve. They typically use the bootstrapping method on actively traded coupon GSECs. This derived GSEC spot curve then becomes the foundation for pricing other rupee-denominated debt. For example, if State Bank of India, SBI, a large government-owned bank, issues a new bond, its price would be determined by discounting its cash flows using the relevant GSEC spot rates plus a spread reflecting SBI's specific credit standing. Or if a major corporation like, say, Infosys or Reliance Industries issues an NCD, a non-convertible debenture, they'd also reference the GSEC spot curve as their baseline before adding their corporate credit spread. This is the same methodology, just different benchmarks and currencies. The examples in the text for Canadian and Australian bonds reinforce this global application too.
Okay, so the spot curve is the fundamental pure measure. But you mentioned the practical challenges in building it perfectly for market data. It feels like we need a way to talk about yields across maturities that's maybe a bit more standardized, especially if the curves we see published daily aren't pure spot curves.
You've perfectly set up the need for our next curve, the par curve. It provides exactly that standardized benchmark. So what's a par rate? A par rate is the specific yield to maturity, YTM, that would make a hypothetical bond for a given maturity price exactly at par value, 100% of its face value. Put simply, if you issued a bond today with a coupon rate equal to its par rate, it would trade right at 100.
So it's the theoretical coupon rate needed to make a bond's price exactly 100, given the underlying spot rates. Why is this benchmark so important? What does it add beyond the stock curve?
It's important for a few key reasons. It gives us a different, often cleaner view. Firstly, par rates offer that standardized benchmark for comparing yields across the term structure. They help control for those distortions we talked about, like tax effects on bonds trading way above or below par, or slight liquidity differences between individual bonds. By thinking about a hypothetical bond always priced at par, we sort of normalize things, getting a clearer comparison of yields across different maturities. It strips away some market noise.
And is this par curve what people usually mean when they just say the yield curve in the news?
That's a really critical point. And yes, largely, the most widely cited yield curve, the U.S. Treasury yield curve, published daily by the U.S. Department of the Treasury. That's primarily a par curve.
Oh, okay.
So the curve most people see and talk about is actually showing par rates, not spot rates directly. While the yields on newly issued on-the-run treasuries are usually very close to par rates, they aren't identical. The par curve smooths these out into a consistent benchmark.
Right, that's a huge clarification. So we know what it is and why it's the common benchmark. How do we actually get these par rates? How are they derived from the spot rates we already understand?
It comes directly from bond pricing again, but we work backwards slightly.
Yeah.
We use the same spot rate discounting logic, but instead of solving for the price, PV, we set the price to 100 and we solve for the coupon payment, PMT, that makes it work. The formula looks like this: 100 PMT1 plus Z1 plus Z1 plus PMT1 plus Z2 plus Psi plus PMT plus 101 plus Z and N. Notice PMT is the unknown here, and we know all the spot rates, Z1, Z2, dot Z and N.
Okay, so we're finding the coupon payment that makes the present value exactly 100, using all the right spot rates for discounting. It's like solving for the coupon.
Exactly. It's reverse engineering in a way. You assume a bond is issued at par for a certain maturity, say 5 years. Then you use the 1-year, 2-year, 3-year, 4-year, and 5-year spot rates to figure out what annual coupon payment, PMT, would make the sum of the present values of all those coupons, plus the final principal, equal exactly 100. That PMT, expressed as a percentage, is the 5-year par rate. Remember, for a bond to trade at par, its coupon rate must equal its yield to maturity. So solving for the coupon PMT is the same as finding the par yield. It usually requires a financial calculator or software to solve iteratively for PMT.
Let's make that concrete with the example rates from the text. 1-year spot, 5.263%, 2-year, 5.616%, 3-year, 6.359%, 4-year, 7.008%. How would we find the 1-year and 2-year par rates?
Okay, let's do it. For the 1-year par rate, this is easy. Since it's just one period, the par rate has to equal the spot rate, 100 PMT plus 100, 1.05263. Solving for PMT gives 5.263%. Par rate equals spot rate for one period. For the 2-year par rate, this takes a bit more calculation. We set up 100 PMT, 1.05263, 1 plus PMT plus 100, 1.056162. You'd need to solve this equation for PMT. When you do the math, it comes out to about 5.606%.
Okay.
So a 2-year bond needs a 5.606% coupon to trade at par, given those spot rates. You'd calculate the 3-year and 4-year par rates similarly, using the 3-year and 4-year spot rates, respectively. The text shows they come out as 6.306% and 6.899%. Example 2 also shows calculating the 3-year Canadian par rate is 0.7952%.
That really connects the dots between spot rates and these benchmark par rates. How is this used day to day, maybe in the Indian market or for a U.S. company issuing bonds?
Okay, real-world application. In the Indian GSEC market, even if the RBI doesn't publish an official daily par curve like the U.S. Treasury, the concept is absolutely fundamental for market participants. Say, Reliance Industries wants to issue a new 5-year bond. Their treasury team or their bankers would definitely look at the implied 5-year GSEC par rate derived from the spot curve. That gives them the baseline risk-free yield for a 5-year par bond. Then, they add Reliance's specific credit spread on top to figure out the actual coupon they need to offer to attract investors. It's a key pricing input.
Makes sense.
And for a U.S. company, maybe a medium-sized tech firm issuing, say, 7-year debt, they'd look directly at the published U.S. Treasury par curve for the 7-year rate. Let's say it's 3%. Then they'd add their credit spread, maybe, 1.5% or 150 basis points if they're BBB rated. So they'd aim to issue around a 4.5% coupon. The par curve provides that clear, easily understood starting point for everyone involved, issuer, underwriter, investor.
Right. So the par curve is our clean, commonly cited benchmark. But what if we want to know what the market is expecting interest rates to be in the future? Not just today's rates, but next year's rates or the year after. That feels like the domain of forward rates, right? And that sounds incredibly useful for strategy.
Absolutely. Forward rates add this whole other dimension the market's implied forecast. Let's define implied forward rates. Think of them as break-even reinvestment rates. They represent the rate that would make an investor indifferent between two strategies over a longer horizon. Strategy 1. Buy a shorter-term zero-coupon bond now, and when it matures, reinvest the money in another future short-term zero. Strategy 2. Just buy a longer-term zero-coupon bond today that covers the whole period. The forward rate is the rate on that future short-term investment in Strategy 1 that makes the total return equal to Strategy 2. It ensures no arbitrage.
Okay, hold on. So these forward rates are basically what the market as a whole is implicitly predicting future spot rates will be. Is that the idea? It's like reading the market's mind about the future.
That's the core economic interpretation, yes. Forward rates reflect the market's collective expectations about future spot rates needed to link short-term and long-term investments without arbitrage. Now, a small caveat. They're implied expectations. They aren't perfect forecasts, because sometimes other things like risk premiums or liquidity preferences can get embedded in there too. But they're still a hugely valuable indicator of market sentiment about future rates.
Okay, got it. And there's a specific way to name them, right? Like 3Y, 1Y. Sounds a bit technical.
It is precise, but quite logical once you see it. 3YY is read as the 3-year into 1-year rate. The first number, 3Y, tells you how far into the future the rate period begins, so starting 3 years from today. The second number, 1Y, tells you the length or tenor of that future rate period, so it's a 1-year rate. Putting it together, 3Y, 1Y is the implied 1-year interest rate starting 3 years from now.
Yeah.
Similarly, 2Y, 3Y would be the implied 3-year rate starting 2 years from now. Standard market shorthand.
That clears up the naming. Okay, the crucial part. How do we calculate these forward rates from the spot rates we've already got? What's the math behind that no arbitrage link?
The calculation comes directly from that no arbitrage principle. The core formula ensures that investing long is equivalent to investing short and rolling over at the forward rate. It is 1 plus ZA, AA, 1 plus IFRA, BA, BAA, 1 plus ZBB.
Whoa, okay, let's break that down.
Sure, ZA is the spot rate for period A, the shorter period.
Yeah.
ZB is the spot rate for period B, the longer period. IFRA, BA is the implied forward rate starting at time A and lasting for B minus A years. The formula just says the total return from investing for A years at spot rate ZA and then reinvesting for the remaining BA years at the forward rate IFR must equal the total return from just investing for the full B years at spot rate ZB from the start. It locks everything together.
Okay, let's use the numbers from the text again to see it work. Calculating the 1-year forward rate 3 years from now, the 311 rate, We're given the 3-year spot rate, ZA, is 3.65%, and the 4-year spot rate, ZB, is 4.18%. So here, A3, B4, and the forward period, BA, Orwell's 1 year. How do we find IFR 3.1?
Exactly. We plug those into the formula. 1 plus 0.0365, 3 times 1 plus IFR 3.1 equals 1 plus 0.04184. First, calculate the known parts. 1.0365 is about 1.1.7647, so 1.17647, so 1.11647, 1.141364, which is about 1.05641. So 1 plus IFR 3.1 equals 1.05641. That means IFR 3.1 is 0.05641, or 5.64%. That's the implied 1-year forward rate 3 years from now.
5.64%. Okay, what does that mean for an investor? How does that number actually inform a decision? This feels like where the strategy comes in.
This is exactly where it gets practical. The 5.64% is the market's break-in rate. If you as an investor believe the actual 1-year rate 3 years from now will be higher than 5.64%, you might prefer to buy the 3-year bond today and plan to reinvest for that 4th year at hopefully a rate better than 5.64%.
Kind of betting against the market's implied forecast.
Right. Conversely, if you think the actual rate will be lower than 5.64%, you'd be better off locking in the 4-year rate of 4.18% today by buying the 4-year bond. The forward rate tells you the threshold. Your decision depends on whether your own expectation is above or below that threshold. It's fundamental for relative value trades and hedging. Example 3 shows calculating the 2x1 Canadian forward rate as 1.26%, applying the same logic.
It's fascinating how these expectations get baked into the rates. Now, you mentioned earlier that spot rates and forward rates are two sides of the same coin. You can get one from the other. Can you explain that link more? And crucially, could we price a bond using only forward rates? And would it give the same answer as using spot rates?
Absolutely, they're fundamentally intertwined. Just like we derive forwards from spots, we can derive spots from forwards. A multi-year spot rate is essentially the geometric average of the sequence of 1-year forward rates covering that period. For example, the 2-year spot rate, Z2, comes from the current 1-year rate, which is the A/Y1Y forward F01, and the 1-year forward rate starting 1 year from now, the 1Y1 forward F11. The formula is 1 plus Z22 equals 1 plus F01 plus F11.
Okay, so if we had that sequence of 1-year forwards, 0Y1Y 1.88%, 1Y1Y is 2.77%, 2Y1Y 3.54%, 3Y1Y 4.12%, how would we find the implied 2-year spot rate?
Using that geometric average idea, 1 plus Z22, 1 plus 0.0188 times 1 plus 0.0277, 1.08277, which equals about 1.04718. So 1 plus Z2 is the square root of 1.04718, which is about 1.02322. Therefore, Z2 is 0.0322 or 2.32%. It works because investing for 2 years at 2.32% compound gives the same result as 1 year at 1.88%, followed by 1 year at 2.77%. No arbitrage holds.
Perfect sense. And the big payoff. If they're interchangeable like this, can we price bonds using forwards directly? And does it match spot rate pricing? Please say yes.
Yes, absolutely. This is a key confirmation. You can value a bond identically using either the spot rates or the sequence of forward rates. It's just a different way of applying the same underlying information. When using forwards, you discount each cash flow, CF, by the cumulative product of the 1-year forward rates up to its payment date. So PV equals to CF11 plus F01 plus CF21 plus F11 plus CF10 plus F01 plus 1 plus F and count 1. Example 4 in the text demonstrates this clearly. It prices a 3-year Canadian bond using forward rates and gets 99.126, which is exactly the same price obtained using spot rates. 2 paths, same destination. It validates the whole framework.
Fantastic. It really locks in that consistency. Okay, let's talk about how people actually use these forward rates in the real world. What are some concrete examples?
All right, let's make it tangible. In the U.S. market, traders dealing in interest rate swaps or futures on treasuries, they live and breathe forward rates. Imagine a portfolio manager deciding, buy a 5-year treasury now, or buy a 2-year treasury and plan to roll it into a 3-year treasury in 2 years. They would look very closely at the implied 2Y3Y forward rate derived from the treasury curve. If they think the actual 3-year rate in 2 years will be higher than that implied forward, they might choose the rollover strategy. If they think it will be lower, they lock in the 5-year yield now. Forward rates are key inputs for these kinds of duration management and relative value decisions, and also for pricing derivatives like swaps, where payments are explicitly based on future rates.
That's a very clear portfolio management example. What about in the Indian context? How are forward rates used by banks or companies there?
Equally valuable. In India, implied forward rates from the GSEC curve are critical for, say, banks managing their asset liability management, their ALM. Imagine an Indian bank writing a 5-year fixed-rate loan. Their own funding might be shorter term, maybe rolling over commercial paper deposits every year. They look at the 1Y, 2Y1Y, 3Y1Y, 4Y1Y forward rates to help price that loan, because those forwards give them an idea of their expected future funding costs. It guides their pricing and their hedging strategy against rising rates using instruments like overnight index swaps, OIS. Similarly, a large Indian corporate, maybe Tata Motors, planning a big capital expenditure that requires issuing bonds in, say, 2 years. They'll look at the relevant forward rates today to estimate their likely future borrowing cost, which helps them plan financially and decide maybe whether to lock in some funding now via forward-starting loans or swaps. It's about managing future interest rate risk.
So we've defined spot, par, and forward curves, calculated them, seen the no arbitrage links. This is great. But the really fascinating part, I think, is how their shapes relate to each other. What does an upward sloping spot curve imply about the par and forward curves? What story are the relative positions telling us? This feels like where we unlock the market's deeper message.
You're right. This is where interpretation really comes in. It's like a dance between the curves. Because par and forward rates are mathematically derived from spot rates, the shape of the spot curve absolutely dictates the shape and the relative position of the other two. They always move in predictable relation to each other.
Okay, let's summarize those relationships, maybe thinking about Exhibit 8 in the material. What's the typical picture when we have that normal upward sloping spot curve?
Right, the most common scenario. Upward sloping spot curve, normal yield curve. Longer-term spot rates are higher than short-term ones. We saw this in the Canadian-Australian examples, in this case. The par curve will lie below the spot curve. The gap usually widens a bit at longer maturities. And the forward curve will lie above the spot curve.
Okay, why is that? What's the intuition?
Well, for the spot curve to slope upwards, the market has to be implicitly forecasting higher short-term rates in the future. Those are the forward rates. That's what pulls the long-term spot rates up. The par curve is lower because it's like an average. A par bond involves discounting early cash flows using the lower short-term spot rates. To get the price back to 100 par, the coupon rate, the par rate, needs to be lower than the final higher spot rates. It gets pulled down by the initial low rates. This shape often signals growth or inflation expectations, or maybe just a positive term premium.
That makes sense. Forward curve leading the way up, par curve lagging behind. What about a flat spot curve? That sounds simpler.
Much simpler. If you have a flat spot curve, all spot rates are the same, say 2.5% across all maturities, like Exhibit 6 then. The par curve is equal to the spot curve, and the forward curve is also equal to the spot curve. Economically, it implies the market expects no change in future rates. The break-even reinvestment rate, the forward rate, is just the current spot rate. It might suggest stable conditions or perhaps market uncertainty with no clear direction.
Okay, nice and tidy. Now the interesting one, the downward sloping or inverted spot curve. What happens then, and what's the market usually whispering when we see that?
The downward sloping inverted spot curve. Short-term spot rates are higher than long-term ones, like Exhibit 7. This is often the recessionary signal. Here, the relationships flip. The par curve lies above the spot curve, and the forward curve lies below the spot curve.
Okay, the opposite of the upward sloping case.
Exactly. If long-term spot rates are falling, it means the market expects future short-term rates, the forwards, to be lower than current rates. That's why the forward curve is below the spot curve. Investors might be locking in current long yields, fearing rate cuts, or just piling into safe long-term bonds, anticipating a downturn. The par curve is higher because those high initial short-term spot rates mean you need a higher coupon payment on a bond to bring its price down to 100 par.
These relationships are like a code for reading market expectations. It's really powerful. But wait, the source material also mentions something really unusual, negative spot rates in places like Germany or Switzerland. How does that fit in? Do the rules break down?
That's a fascinating point, and a phenomenon we saw quite a bit after the 2008 crisis. Central banks in some places pushed policy rates below zero to fight deflation and stimulate their economies. Exhibit 9 shows this. You might think negative rates break everything, but here's the key. The mathematics we've discussed. They still hold. The formulas for deriving par and forward rates from spot rates work exactly the same way, even if some of the spot rates, the Z's values, are negative.
Okay, the math still works, which is good to know, even if negative rates feel weird. But what was really mind-bending was the idea that you could have an upward-sloping negative spot curve, but still get positive forward rates way out in the future. How is that possible?
Yes, that's a really interesting outcome. An upward-sloping negative spot curve means rates are, say, deeply negative short-term, but become less negative as maturity increases, maybe even turning slightly positive very far out. Even in this scenario, you can calculate positive forward rates for future periods. The example from Switzerland showed negative spot rates, but the implied 9Y1 forward rate, the one-year rate starting in 9 years, was actually positive, around 0.537%.
How?
Because for the long-term spot rate to be less negative than the short-term rate, the implied intervening forward rates must be higher than the initial spot rates. If the spot curve is rising from, say, negative 0.75% to negative 0.25%, the forward rates connecting them have to be higher than negative 0.75%, potentially even positive, to make that climb happen mathematically. It implies that even when current rates are negative, the market expects them to eventually rise back towards zero or positive territory in the distant future. It's pricing in an eventual normalization, even if it's far off.
Wow. Okay, so this all boils down to some really practical insights for anyone in fixed income. It's not just about one yield number anymore. It's about understanding this whole landscape of rates and what the curves are telling us.
Precisely. Knowing these relationships gives you powerful clues about market views on rates, inflation, growth, and it directly impacts investment choices. So let me pose a question to you, the listener. Think about this. You have a 5-year investment horizon. Option 1. Buy a 3-year government bond today at a 3% spot yield and plan to reinvest the proceeds for the remaining 2 years when it matures. Option 2. Just buy a 5-year government bond today at a 4% spot yield and hold it. How do you decide?
You'd need to know what rate you expect to get on that reinvestment in 3 years' time.
Exactly. You'd calculate the implied 2-year forward rate, starting 3 years from now, the IFR 3.2. Let's say, hypothetically, the curve tells you that forward rate is 5.52%. That 5.52% is your break-even. If you personally believe the actual 2-year rate in 3 years will be higher than 5.52%, then option 1, buy the 3-year and roll, looks better. If you think the actual rate will be lower than 5.52%, then option 2, locking in the 5-year at 4%, is the way to go. The forward rate gives you the market's implied forecast to compare your own view against. That's active management using the term structure.
That's a fantastic practical takeaway. Wow, what an incredible deep dive this has been. We really started by letting go of that single interest rate idea and embracing this whole world of the term structure. We defined spot rates, the pure time value, the no arbitrage foundation.
That's right. And then we built on that with the PAR curve, the key benchmark, the one we often see quoted, standardizing comparisons. And then we got into the forward curve, which is really fascinating, giving us that glimpse into the market's future expectations.
And finally, seeing how they all interact, the dance of the curves, you called it. How their shapes are linked and tell us stories about market sentiment, whether they're pointing up, down, flat, or even doing strange things with negative rates but positive forwards.
Understanding this term structure isn't just, academic theory. It is absolutely essential. For pricing bonds accurately, for managing risk effectively, for making smart investment decisions in fixed income, it's foundational.
Well, that wraps up our detailed look at Module 09, the term structure of interest rates. Spot, par, and forward curves from the CFA Level A 2025 Fixed Income Volume 6 course. We've really unpacked these relationships.
And next time, we'll take this knowledge and apply it directly as we dive into Module 10, Interest Rate, Risk, and Return. We'll explore how changes in these rates actually impact bond prices and returns and how we measure that sensitivity. It's the logical next step.
Definitely. So as you continue your studies, here's something to think about, a little takeaway challenge. Take a look at the current yield curve in your own market, maybe the U.S. Treasury curve or the Indian G-Sec curve. What shape is it right now? And based on what we've discussed, what story might it be telling? Is it signaling growth, inflation fears, a slowdown, something else entirely? The curves are talking. Hopefully you can now understand their language a bit better. Thank you so much for joining us on the Deep Dive. We look forward to exploring more critical topics with you very soon.
Welcome to the Deep Dive, your shortcut to being well-informed.
Here!
Today, we're cutting straight to the chase on a topic that's, absolutely foundational for anyone navigating the bond market.
Couldn't agree more. This is core stuff.
We're embarking on Module 10 of the CFA Level I 2025 Fixed Income Volume 6 course. The topic, interest rate, risk, and return.
Yep, a big one.
This deep dive, it really has one core mission: to help you truly understand how interest rate movements can, dramatically shift your bond returns.
And importantly, how to measure it.
Exactly. And more importantly, to arm you with the powerful tools we use to measure and manage that sensitivity. Because look, for many people, bonds feel kind of stable, predictable even.
That's the perception, yeah. Safe as houses, some might say.
Right. But the reality is they're constantly dancing to the tune of interest rate changes. And if you don't understand that dance, well, you could be in for some costly surprises. So we're going to pull back the curtain. We'll look at the 3 key ways you actually earn money from a bond.
The building blocks.
Then we'll unravel this silent, often conflicting battle between two opposing interest rate risks.
The seesaw effect we'll get into.
And finally, we'll introduce a, frankly, brilliant concept called Macaulay duration, a measure that can really become your strategic compass in these sometimes volatile waters.
What's truly fascinating here, and I think often a major blind spot for investors, is how consistently people fixate on a bond's yield to maturity, the YTM.
Oh, absolutely. It's everywhere.
It is. You see it plastered in financial news on bond quotes. It's so easy to just treat it as like gospel, your guaranteed return.
Yeah, the number they give you.
But as we'll meticulously unpack today, that YTM, it's really only a promise under very specific and often, let's be honest, quite idealized conditions.
Okay.
So this deep dive isn't just about defining terms. It's about uncovering what truly, practically drives your fixed income returns and, crucially, how to manage the risks that inevitably come with them. We're moving way beyond that initial headline yield.
That's it, exactly. And it's about building that intuition, which is so valuable for the CFA program and just for being a smart investor generally.
Absolutely.
So once we've thoroughly navigated the intricacies of interest rate risk today, we'll then seamlessly transition into Module 11, yield-based bond duration measures and properties.
Building on today's foundation.
Right. We'll expand on Macaulay duration, explore other critical risk metrics that offer even more nuanced insights. So let's get started.
Let's do it.
All right, so if bonds were like a financial house, right, before we talk about weatherproofing it against these interest rate storms,
What is an analogy?
we first need to understand what its foundational structure is actually made of. Because when you invest in a fixed-rate bond, your return isn't just one single brick.
Nope.
It's actually a combination of three distinct elements. Think of it like a sturdy, three-legged stool for your investment.
And if one leg is wobbly?
Exactly. Your entire return stream can become unstable. Okay, so the first, and probably the most straightforward component, is the receipt of promised coupon and principal payments.
The bread and butter.
Totally. This is the stuff everyone thinks of when they buy a bond. It's those regular scheduled interest payments, the coupons that you get throughout the life of the bond.
Usually twice a year, right? But sometimes annual.
Yeah, depends on the bond. And then right at the very end, you get the repayment of the bond's face value, its principal, back at maturity.
Like getting your salary plus a bonus, you said earlier.
Kind of, yeah. It's the most visible part. And, under normal circumstances, it's the most predictable part of a bond's return. Like if you hold a 10-year Indian government security, a GSEC, issued by the RBI, this is the regular interest hitting your account and then the full face value back after those 10 years. Simple enough, right?
Seems so. But there's more.
Oh, there is. Now, the second source. This one is critically important, but honestly, it's often woefully overlooked, especially if you're investing for the long haul. It's the reinvestment of coupon payments.
The compounding effect.
Exactly. This refers to the interest you earn on those coupons after you receive them, and then, crucially, you put them back to work. This is that magic of interest on interest, or compounding.
It's huge over time.
It really is. If you get a coupon payment and just let it sit in your checking account earning practically nothing,
Which people do.
you're basically leaving money on the table. You're actively missing out on this powerful compounding effect. The rate at which you can reinvest these payments, it directly, and sometimes significantly, impacts your total ultimate return from that bond.
So it's not just getting the coupon.
No.
Oh.
It's about what you do with the coupon once you get it.
Right. Okay. That's two legs of the stool. What's the third?
The third leg is potential capital gains or losses. Now, this one only comes into play if you decide to sell the bond before its maturity date.
Okay. So not for the buy and hold folks necessarily.
Exactly. If the market value of your bond has gone up since you bought it, maybe because interest rates have fallen, which makes your bond's fixed coupon look more attractive.
Relative to new bonds.
Precisely.
Yeah.
Then you'll sell it for more than you paid, and boom, you realize a capital gain.
Nice.
Conversely, if market interest rates have risen, your bond's price will likely have fallen to make its yield competitive with new bonds. So selling it then would result in a capital loss.
The painful side.
Yeah. So for that pure buy and hold investor, someone who intends to hold their bond right up until maturity, this particular leg of the stool, it effectively doesn't exist for their overall realized return. They just get the par value back from the issuer at the end.
And that par value at maturity is exactly why, like you said, for our buy and hold listeners, that YTM seems so appealing, so certain.
Yeah.
But you mentioned earlier it comes with these if-then statements. What are those crucial conditions? What really makes YTM more of a promise than a cast iron guarantee? Because honestly, people do fixate on just the coupon rate or that initial YTM.
They really do.
But if you neglect the reinvestment part or the potential for capital gains or losses if you need to sell early, you're just not getting the full picture, are you? Your total return could be quite different. What stands out to you as the biggest trap here for our listeners?
Oh, that's a good question. I'd say the biggest trap is definitely underestimating that reinvestment component. It's like the silent force. It can either supercharge your returns or totally derail them over time, and people just don't focus on it enough.
Agreed.
But to your point about those if-then statements, let's tackle that common misconception about YTM head-on. Lots of investors believe a bond's yield to maturity is a guaranteed annual return they will receive.
Yeah, it sounds like it should be.
It does. And look, YTM is undeniably a powerful metric. It's a standard in the industry. We use it all the time. But it's really more of a forecast. And it comes with a few crucial, often unmet assumptions. It's definitely not a promise set in stone. Okay, so old bonds YTM will equal an investor's actual annualized compounded rate of return.
The key word being will.
Yeah. Only if these specific assumptions hold true throughout the bond's entire life. If any one of these conditions gets violated, even just a little bit, your actual realized return will likely differ from the YTM you saw when you bought the bond.
Okay, assumption number one.
First one's maybe the most obvious, holding to maturity. Simple. You got to hold the bond till its maturity date.
No selling early.
Right. If you decide to sell it early, the price you get could be way different from what you paid. That introduces a capital gain or loss, and that directly messes with your total return calculation relative to the initial YTM.
Makes sense.
So for instance, imagine an investor in India buys a 10-year Indian government security, a GSEC, maybe in an RBI bond auction. If their plan is solid, hold it for the full 10 years, they avoid that capital gain or loss for market swings. So they're more likely to realize the YTM, assuming the other conditions hold too.
But if they bail after 5 years?
Exactly. If they sell after 5 years, the market price on that specific day becomes a critical factor in their actual return.
Got it. What's assumption two?
Assumption 2 is no default by the issuer. Pretty straightforward.
Yeah, you want to get paid back.
You do. It means the entity that issued the bond, the government, the company, whoever, must make all of its promised coupon payments and the final principal repayment fully and on time.
Now, the risk level there varies a lot, right?
Hugely. It's a significant risk for some, maybe lower-rated corporate or municipal bonds. But for others, like, say, U.S. Treasury bonds, that risk is considered extremely low, almost negligible.
The risk-free rate benchmark, practically speaking?
Pretty much. You know, a large U.S. pension fund might invest heavily in U.S. Treasuries precisely because that expectation of no default is just very, very high. But this assumption is absolutely critical across the board. If an issuer defaults, well, obviously your realized return is going to be far, far less than the YTM you initially calculated.
Game over for that YTM promise.
Pretty much. Okay, now the third one, and this is perhaps the most critical assumption, and honestly, it's the one that is almost always tested, if not outright broken, for most investors in the real world.
Oh, I'm listening.
It's that all coupon payments are reinvested at the same rate as the bond's original YTM.
Ah, back to the reinvestment challenge.
Exactly. This is where that interest-on-interest concept we talked about becomes absolutely central. Just think about it.
Yeah.
If market interest rates change after you buy the bond, and they do change, often then you probably won't be able to reinvest your received coupons at that initial YTM rate.
Rates go down, you reinvest lower. Rates go up, you reinvest higher.
Precisely. If rates have fallen, you're stuck reinvesting at a lower rate. If they've risen, great, you reinvest at a higher rate. But either way, it's almost never exactly the original YTM. This assumption alone can cause a significant divergence between your calculated YTM and your actual realized return over time.
Host, you've really hit on the most crucial point there. That annualized compounded rate of return you mentioned, that's effectively what we call your horizon yield,
Right.
or your holding period return. It's essentially your personal internal rate of return, IRR, for that investment.
Okay, define IRR quickly for us again.
Sure. It's just the discount rate that makes the present value of all your expected cash inflows, So coupons plus final principal or sale price equal to the present value of your cash outflows, which is usually just the initial purchase price. It's calculated based on what you actually earn over your specific investment horizon. So if any of those assumptions, especially that reinvestment rate, don't hold true, then your actual realized return, your horizon yield, is going to diverge from the initial YTM. And this divergence, that's precisely where interest rate risk truly begins to bite, or maybe even reward you.
So YTM's the starting point. Horizon yield is the final score.
That's a great way to put it. YTM is the forecast. Horizon yield is your ultimate report card.
Okay.
And it's also important to briefly touch on the constant yield price trajectory. This concept helps us visualize that YTM assumption playing out perfectly.
How so?
It basically illustrates that if the YTM remained absolutely constant throughout the bond's life, the bond's price would follow this predictable, smooth path, moving gradually towards its par value at maturity.
So if you bought it at a discount, it drifts up to par. If it had a premium, it drifts down.
Exactly. And this path implies that if you were to sell the bond at any point along this trajectory, you wouldn't incur any capital gain or loss relative to that path. The discount or premium you paid just amortizes away over time. So your return earned would equal the YTM.
It's like the theoretical ideal path.
Precisely. It's a theoretical path where the YTM promise holds perfectly true. It acts as a benchmark for how a bond should perform if rates just magically stay put.
Which they rarely do.
Yeah.
Okay, let's look at an example that makes this concrete. We'll pull one from the sources, and we'll use basis points, or BPS. Remember, that's 1/100%. So 100 BPS is 1%.
Got it.
Now, imagine two investors. Both buy the exact same bond, a BRWA 10-year 6.2% annual coupon Euro bond, and they both buy it at par, meaning they pay $100 for a bond with a $100 face value. So their initial YTM is 6.2%.
Okay, same starting point.
Right. Now, scenario one. Assume stable rates. This is our ideal world. Interest rates across the market, including the rate they can reinvest their coupons at, stay exactly at 6.2% for the entire time.
The theoretical constant yield world.
Exactly. So investor A, let's call them the Vizwan family office, VFO, is a classic buy and hold investor. They buy the bond for $100, plan to hold it for the full 10 years until maturity. If all their incoming $6.20 annual coupons are reinvested at that original 6.2% YTM, their total return over the 10 years, annualized, will indeed be 6.2%.
As expected.
Right. No capital gains or losses because they held to maturity, and the reinvestment rate perfectly matched the YTM. All assumptions met.
Makes sense. What about the other investor?
Investor B is Baywhite Financial. They have a shorter 4-year investment horizon. They purchase the same bond at par, but they fully intend to sell it after just 4 years.
Okay, different plan.
If their coupons over those 4 years are reinvested at 6.2%, and the bond also sells at par after 4 years, which it would because the YTM remained constant at 6.2%, so its price followed that constant yield trajectory.
Right, no price change relative to the path.
Then Baywhite's total annualized return for their 4-year horizon will also be 6.2%.
Interesting. So even with different holding periods.
Even with different holding periods, the conclusion here is almost deceptively simple. In a perfectly stable rate environment where all our critical assumptions are met, the YTM accurately equals the realized return, the horizon yield, for both investors.
It's the ideal world.
It is. But, how often do we actually live in that ideal world?
Almost never, which brings us to the real complexity, I assume.
Exactly, which brings us to the dynamic duo of risk. Now, this next part, okay, here's where it gets really interesting. Because once interest rates start moving, and believe me, they do start moving those 3 sources of return we just discussed, well, they stop playing nice together.
The harmony breaks down.
Completely. In fact, they start pulling in radically different directions. 2 powerful types of interest rate risk emerge, and they have this almost like cinematic inverse relationship.
Constant tug of war.
Totally. They're locked in this silent, continuous battle. And understanding this dynamic, it's absolutely key to navigating the bond market like a seasoned pro.
Okay, lay them out for us. Risk number 1.
Let's first define reinvestment risk. This is the risk that those future coupon payments you receive from your bond will have to be reinvested at a lower interest rate than the bond's original yield to maturity.
So rates fall after you buy the bond.
Exactly. Think about it. When market interest rates fall, the future value of your reinvested coupons actually decreases. If you're getting a nice, healthy 6% coupon, but suddenly new market rates are only, say, 4%.
You earn less on your earnings.
Right. You'll earn less interest on interest when you put those 6% coupons back into the market at that lower 4% rate. This directly reduces the total compounding effect over the life of the bond. It diminishes your overall return.
It's like a slow leak in your return potential.
That's a great way to put it. It's a subtle but powerful drain on your potential earnings, especially for longer-term investments where compounding is supposed to do the heavy lifting.
Okay, that's reinvestment risk. What's its opposite number?
On the flip side, we have price risk. This is the risk that your bond's market price will decline, and therefore its yield will rise if interest rates in the broader market rise.
So rates go up, bond price goes down. Why again?
Because new bonds being issued will naturally offer higher yields to attract investors in that new higher rate environment.
Makes sense.
So, to make your existing bond, with its now lower than market coupon, competitive in the secondary market, its price must fall. It has to fall enough so that a new buyer gets a yield comparable to what they could get on a brand new bond.
So the yield adjusts through the price change.
Exactly. So when interest rates rise, the sale price of your bond decreases if you try to sell it before maturity, and that potentially leads to a capital loss.
The immediate hit.
Right. This is the immediate, often painful hit to your principal if you need to liquidate your position when rates have gone up.
Okay, so you can really see this fascinating inverse relationship now.
Crystal clear, right? When market rates rise, price risk increases. Your bond price falls. But at the exact same time, reinvestment risk decreases because, hey, you can reinvest your incoming coupons at those new, higher rates, boosting your interest on interest.
One person's pain is another's gain, sort of?
Kind of. Conversely, when rates fall, price risk decreases. Your bond price rises, giving you a potential capital gain if you sell. But reinvestment risk increases because now you're forced to reinvest your coupons at those lousy lower rates, eating into your compounding returns.
It really is like a financial seesaw. One side goes up, the other goes down.
Exactly. And your challenge as an investor is finding the balance point on that seesaw, or at the very least, understanding where your weight and thus your primary exposure lies. This isn't just theory. It's the silent battle every single bond investor is fighting, whether they realize it or not.
And that silent battle, as you call it, is often kicked off, or at least heavily influenced, by the actions of central banks, right?
Absolutely. Central banks are major players here.
Yeah, if we connect this to the bigger picture, think about institutions like the U.S. Federal Reserve or the Reserve Bank of India, RBI. When they make policy decisions like raising or lowering their benchmark interest rates, these shifts send ripples across the entire financial system. They directly impact the magnitude of these two risks for bond investors everywhere.
Their actions can immediately shift the balance of that seesaw.
Precisely. Let's consider a U.S. context example for price risk. Imagine an investor holds an Apple Inc. corporate bond. They bought it a year ago. It has a certain fixed coupon rate.
Okay.
Now, if the Federal Reserve, maybe trying to combat inflation, decides to raise the federal funds rate, its main policy rate, this leads to higher borrowing costs across the U.S. economy.
Right.
Consequently, new corporate bonds, maybe even new bonds issued by Apple itself, will have to offer higher yields to attract investors in this new environment.
Makes sense.
So, what happens to the existing Apple bond our investor holds? To make it attractive in the secondary market, its price has to fall. It needs to fall enough to offer a competitive yield compared to the new, higher-yielding bonds.
Creating price risk.
Exactly. If our investor needs to sell that bond before its maturity, they would likely incur a capital loss due to this increased price risk. It's a direct consequence of the Fed's policy move.
Clear example. Now, how about reinvestment risk in India?
Okay, for an Indian context example, focusing on reinvestment risk. Picture an investor who holds an SBI bond issuance. State Bank of India, very common corporate bond issuer in India. Let's say it provides a fixed semi-annual coupon payment. Now, imagine the Reserve Bank of India, RBI, unexpectedly cuts interest rates. Maybe they're trying to stimulate a slowing economy.
Okay, rates are going down.
So our investor, as they receive their coupon payments every 6 months, finds that they have to reinvest those funds at the new, lower prevailing market rates.
Less bang for the buck.
Exactly. This reduction in the interest-on-interest income over the remaining life of the bond will significantly reduce their overall realized return, their horizon yield from that SBI bond. It's a very real scenario where RBI policy decisions directly translate into a loss of potential earnings from compounding for existing bondholders.
So, price risk hurts when rates rise. Reinvestment risk hurts when rates fall. Got it. That distinction between price risk and reinvestment risk is absolutely critical. We've established that.
Yeah.
But there's another layer to this puzzle, one that's intensely personal to you as an investor.
Okay.
It's your investment horizon. Essentially, just how long you plan to hold a particular bond, this timeline. It acts like your personal thermostat for these interest rate risks.
Ah, so my holding period determines which risk I feel more.
Precisely. It dictates which of these two risks you're more exposed to, and therefore which one will likely dominate your overall return experience with that specific bond.
Interesting. Tell me more.
Okay, think about it. If you have a long-term investment horizon, maybe you plan to hold the bond for many, many years, perhaps even until it matures.
Like our VFO example earlier.
It's exactly like VFO. In that case, reinvestment risk tends to matter more. Why? Because the cumulative impact of reinvesting coupon payment after coupon payment, potentially dozens of them over a long period at potentially different and especially lower rates, can really add up. It becomes a huge chunk of your expected total return.
So the longer you hold, the more coupons you have to reinvest, the bigger the potential impact if rates fall.
You got it. For that true buy and hold investor who holds red to maturity, they don't really face price risk from selling the bond itself, right? They get par back. Their entire interest rate exposure comes from how those numerous coupon payments can be redeployed over the life of the bond. If rates fall and stay low, that compounding effect they were banking on, it just might not materialize as strongly as they initially thought.
Okay, so long horizon, more focus on reinvestment risk. What about short horizons?
Conversely, if you have a short-term investment horizon, let's say you plan to sell the bond relatively quickly, maybe in a few months, a year, maybe just a couple of years.
Like Baywhite Financial.
Just like Baywhite. In that scenario, price risk matters much, much more. If you know you need to sell that bond quickly, any changes in interest rates will directly and immediately impact its market value when you go to sell.
A quick gain or a quick loss?
Right. A slight tick up in market rates could mean a swift capital loss on your sale, potentially eating into or even wiping out your entire return for that short period.
Ouch.
And think about an extreme example. An investor buys a bond and sells it before the very first coupon payment is even received.
Wow, okay.
In that specific scenario, they face only price risk. There are simply no coupons yet to worry about reinvesting. The duration of their investment is so short that the price fluctuation between buying and selling is pretty much the sole determinant of their capital gain or loss.
That really highlights the horizon effect.
Doesn't it?
Yeah, this is a critical insight, host, because it hammers home the point. Two investors holding the exact same bond can have entirely different interest rate risk exposures. Why? Simply because their investment horizons differ.
Same asset, different risk profile based on the holder's plan.
Exactly. There's no single right amount of risk inherent in the bond itself, independent of the investor. It's always specific to your personal goals and your timeline. And this relationship, this interplay between your horizon and which risk dominates, that's precisely what Exhibit 3 in our source materials summarizes so elegantly. It basically lays out a roadmap for navigating this dynamic.
Okay, break down that roadmap for us. What does the exhibit say?
It connects the investment horizon to this thing called Macaulay duration, which we're about to get into properly. But the key takeaways are, if your investment horizon is greater than the bond's Macaulay duration, the dominant risk you face is reinvestment risk. Your primary concern, therefore, should be about interest rates falling, because those lower rates will erode your interest-on-interest income over your long holding period.
Okay, horizon duration means worry about falling rates. Got it.
Yeah. Then, if your investment horizon is less than the Macaulay duration, the dominant risk is price risk. In this situation, your primary concern is about interest rates rising, as you're worried about the bond's market value declining if you need to sell it before that Macaulay duration point.
Horizon duration means worry about rising rates.
Okay, and crucially, the sweet spot. If your investment horizon is approximately equal to the Macaulay duration, then price risk and reinvestment risk are roughly equal. They can largely offset each other.
The balance point.
That's it. This is that magical immunization horizon we alluded to, where your overall return becomes relatively insensitive to small parallel shifts in interest rates. The seesaw is balanced, at least for that specific time horizon.
That's a powerful concept.
It really is. And we can put this into another U.S. context example. Imagine a mutual fund manager in the U.S. They purchase a municipal bond, maybe a 10-year muni, for a client. Now, client A has only a 2-year horizon. They'll need their cash back relatively soon. For them, on this 10-year bond, their horizon is much shorter than its likely Macaulay duration. So they are heavily exposed to price fluctuations if interest rates rise. They face significant price risk.
Makes sense. Short horizon, worried about the sale price.
Exactly. Now, client B, using the same fund manager, also holds this 10-year muni, but their investment horizon is, say, 8 years.
Longer horizon.
Much longer. Their horizon might be closer to or even longer than the bond's Macaulay duration. So the second client would be more concerned with interest rates falling and hurting the reinvestment rate on their coupons over those 8 years. For them, reinvestment risk would be the more dominant concern.
Wow. Same bond, same manager, completely different primary risks for the two clients.
All because of their individual investment horizons. It really drives the point home.
Okay, let's revisit our BRWA bond example now with VFO and Baywhite and see how these risks actually played out when rates did move in the source examples. This should really solidify things.
Good idea. Context is key.
Remember, 10-year, 6.2% annual coupon Eurobond, bought at par. VFO holds for 10 years, Baywhite for 4 years. Initial YTM is 6.2%. Now, scenario 2. Interest rates rise by 100 basis points, 1%, immediately after purchase. So the market rate jumps from 6.2% to 7.2%.
Okay, rates up. What happened?
First, VFO, our buy and hold investor. They actually benefit from this rate hike. Why?
Because they hold to maturity, no capital loss.
Exactly. No capital loss because they hold it all the way. Instead, all their future $6.20 coupon payments can now be reinvested at the new, higher 7.2% market rate.
More interest on interest.
Right. This boosts their compounding income significantly over the 10 years. As a result, their horizon yield, their actual realized return, goes up from the initial 6.2% to 6.43%. For VFO, the gain from reinvesting coupons at a higher rate was a net benefit. Reinvestment risk actually worked for them here, or rather the lack of negative reinvestment impact coupled with higher rates helped.
Interesting. So the rate hike was good for the long-term holder. What about Baywhite?
Now, Baywhite Financial, with its short 4-year horizon, they also get a small boost from higher reinvestment rates on the few coupons they receive over those 4 years. However,
Here comes the price risk.
you got it. A capital loss from having to sell the bond at a lower price after 4 years because rates rose, making its 6.2% coupon less attractive, and thus lowering its market value. That capital loss more than offsets the small gain they got from reinvestment.
Ouch.
Yeah. So their horizon yield goes down from the initial 6.2% all the way to 5.28%. For Baywhite, that shorter horizon made price risk the dominant force, and it worked strongly against them when rates rose.
Big difference in outcome. Okay, now flip it. What if rates fall?
All right, scenario 3. Interest rates fall by 100 basis points,
Say.
1%, immediately after purchase. Market rates drop from 6.2% down to 5.2%.
Okay, rates down. How does VFO fare?
VFO, the buy and hold investor, suffers here. They don't get a capital gain, obviously, since they hold to maturity. Instead, they are now forced to reinvest all those future coupon payments at the new, lower 5.2% rate.
Reinvestment risk bites.
It bites hard over 10 years. This significantly reduces their interest on interest income. As a result, their horizon yield goes down from the initial 6.2% to 5.98%. For VFO, with their long horizon, reinvestment risk was dominant, and falling rates worked against them.
Okay, long-term holder hurt by falling rates. What about Baywhite?
Baywhite Financial, with the 4-year horizon. They are hurt by the lower reinvestment rates on the few coupons they get over those 4 years. That part's negative, however.
Ah, the price effect.
Exactly. The capital gain they get from selling the bond at a higher price after 4 years because rates fell, making its 6.2% coupon more attractive, and thus increasing its market value. That capital gain more than offsets the loss they took from lower reinvestment income.
So they come out ahead.
They do. Their horizon yield actually goes up significantly, from the initial 6.2% to 7.16%. For Baywhite, the shorter horizon meant price appreciation dominated when rates fell, and it worked strongly for them. These examples, pulled straight from the CFA curriculum source material, they just couldn't be clearer, could they? They show how vastly different investment horizons lead to completely different outcomes when interest rates change. Same bond, same rate shift, entirely different experiences and realized returns for the investors.
It really powerfully illustrates why just looking at the YTM when you buy a bond is only like half the story, maybe even less than half.
Absolutely. You have to consider the risks and your own timeline. So, okay, we've seen this push and pull, this constant seesaw effect between price risk and reinvestment risk. It really begs the question, doesn't it?
Yeah.
How do you find that elusive sweet spot, that point where these two powerful opposing forces just magically cancel each other out?
The balancing point.
Right. That's where Macaulay duration comes in. It's a truly powerful and frankly elegant concept named after the Canadian economist Frederick Macaulay, who introduced it way back in 1938.
A classic concept in finance.
It is. And it's essentially your risk thermostat. It tells you at what point in time for a given bond it becomes kind of immunized to these interest rate shifts.
Okay, so this is the key to managing that seesaw. How does it work?
Now, this is where the real complexity starts to give way to clarity, I think. Macaulay duration is defined, technically, as the weighted average time to receipt of a bond's cash flows.
Weighted average time, what does that mean in practice?
Okay, think about it like this. Imagine you're trying to find the average age of everyone working at a company. You can just add up all their ages and divide by the number of people, right? Simple average.
Sure.
But what if you wanted the average age weighted by, say, how much revenue each person generates? You'd give more weight in your calculation to the older, maybe more experienced, higher earning employees, right? Their age would count for more in the final average.
Okay, yeah, I see where you're going.
That's essentially what Macaulay duration is doing with the bond's cash flows. We're weighting the time each cash flow arrives, 1 year, 2 years, etc., by how significant that cash flow is to the bond's total present value.
So bigger cash flows, or ones arriving sooner in present value terms, get more weight.
Exactly. The bigger the payment in PV terms, especially that big principal payment plus the last coupon at the end, the more it pulls that weighted average time towards itself. So going back to the seesaw analogy, if you placed each cash flow in PV terms along the length of the seesaw according to when it arrives, Macaulay duration is the fulcrum point where that seesaw balances perfectly.
Okay. That's a helpful visual. The balance point in time weighted by cash flow value.
Precisely. And the interpretation of Macaulay duration is just crucial for any bond investor. It represents the specific investment horizon measured in years at which the gain or loss you experience from reinvesting your coupons is precisely offset by the loss or gain you experience in the bond's price, assuming an instantaneous parallel shift in the yield curve.
So if my horizon matches the Macaulay duration,
Then you're theoretically immunized. That's why it's often called the immunization horizon. At this specific point in time, your total realized return is theoretically hedged or protected against small parallel changes in interest rates. The capital gain or loss from the price change gets canceled out by the corresponding loss or gain from reinvesting the coupons differently.
wow, okay, that's the magic number then.
It is, in theory. And this concept of balancing risks leads us directly to something called the duration gap. It's a simple calculation, but incredibly powerful for understanding your net risk exposure.
Okay, how do we calculate the duration gap?
Super simple. Duration gap, Macaulay duration, your investment horizon.
Mac duration minus my horizon. Got it.
Yeah. And this single number tells you exactly where you stand in that seesaw battle we've been talking about. It tells you which risk is likely to dominate for you.
Okay, break down what the gap tells us. What if it's 0?
Right. If your duration gap is equal to 0 or very close to 0, it means your Macaulay duration approximately equals your investment horizon. You've hit the sweet spot.
The immunized point.
Exactly. In this ideal scenario, the price risk and reinvestment risk are perfectly balanced or equally offset. You are, in theory, immunized or hedged against small parallel shifts in interest rates. Your realized return should end up being very close to the YTM you expected, even if rates moved a bit.
Nice. What if the gap is positive?
If your duration gap is positive, so duration gap 0, it means the bond's Macaulay duration is greater than your investment horizon. You're planning to sell before that balancing point.
Okay, so which risk dominates then?
In this situation, price risk dominates. You are primarily exposed to the negative impact of rising interest rates. If rates go up, the capital loss you suffer when selling your bond early will be larger than any benefit you might get from reinvesting the few coupons you received at a slightly higher rate.
So positive gap, worry about rising rates hurting my sale price.
You got it. It's like having your seesaw weighted too heavily on the price risk side for your particular holding period.
Okay. And the final case, negative gap.
If your duration gap is negative, duration gap 0, it means the bond's Macaulay duration is less than your investment horizon. You plan to hold the bond past its natural balancing point.
Okay, holding longer than the duration. What dominates here?
Here, reinvestment risk dominates. You are primarily exposed to the negative impact of falling interest rates. If rates decline, the lower reinvestment income you earn on all those coupons over your long holding period will outweigh any capital gain you might see on the bond's price if you checked it at the Macaulay duration point, which you aren't selling at anyway.
So negative gap, worry about falling rates hurting my reinvestment income.
Exactly. Here, your seesaw is weighted too heavily on the reinvestment risk side for your longer holding period.
That framework, positive gap, negative gap, 0 gap, is really useful for pinpointing your main risk.
It really is.
Let's use an Indian context example. Suppose an investor has a firm 7-year investment horizon. They buy a corporate bond issued by Infosys, the big Indian IC company.
Okay.
After calculation, they find this specific Infosys bond has a Macaulay duration of 9 years.
So MAC duration 9, horizon 7.
Right. Their duration gap would be 9 years minus 7 years, which gives them a positive duration gap of plus 2 years.
Positive gap means price risk dominates.
Exactly. This positive gap tells them they are more exposed to price risk from rising interest rates. If the RBI were to hike rates, for instance, the bond's price could fall quite a bit by the time they plan to sell in 7 years, potentially leading to a capital loss and hurting their return. They're vulnerable to a drop in market value because their horizon is shorter than the duration.
Makes sense. How about a U.S. example?
Okay, for a U.S. context example, consider a portfolio manager. They hold a bond that has a calculated Macaulay duration of 6 years, but their investment horizon for the client holding this bond is actually 8 years.
Okay. MAC duration 6, horizon 8.
So their duration gap is 6 years minus 8 years, resulting in a negative duration gap of -2 years.
Negative gap means reinvestment risk dominates.
Precisely. This tells the manager they are primarily exposed to reinvestment risk from falling interest rates. If the Federal Reserve unexpectedly cuts rates, the future coupon payments from this bond will have to be reinvested at lower rates over that 8-year period, potentially reducing the overall total return for their client compared to what was initially expected based on the YTM. They'd miss out on the full compounding effect they might have hoped for.
It's such a practical tool for identifying your vulnerability, but this Macaulay duration number, it doesn't stay the same forever, does it?
Excellent point.
Yeah.
No, it absolutely doesn't. And this is critical for anyone actively managing bonds to remember. Macaulay duration isn't static. It's a dynamic measure.
How does it change?
Well, think about it. As time passes, the bond naturally gets closer to its maturity date. All the remaining cash flows are now closer in time.
Right, the time to receipt shrinks for all of them.
Exactly. So the weighted average time to receive those cash flows, the Macaulay duration, naturally falls as well. It generally decreases over time, though not necessarily one for one with the passage of time.
So my duration gap changes even if my horizon stays the same.
Precisely. Your duration gap needs to be continuously monitored and reevaluated, especially if you're trying to maintain a specific risk profile, because your risk exposure is actually changing passively as the bond rolls down the calendar.
That adds another layer of complexity for portfolio managers.
It doesn't. We can even visualize this whole balancing act with Exhibit 2 from our sources. It's a really powerful visual for understanding how price risk and reinvestment risk offset each other around the Macaulay duration point.
How does the graph look?
Imagine a graph.
Mm-hmm.
Horizontal axis is time, vertical axis is the change in your total value from interest rate changes. Now let's say interest rates rise suddenly. You see an immediate sharp drop in value on the graph. That's the price risk hitting you, the capital loss.
Okay.
But then as time goes on, the value of your reinvested coupons at those new higher rates starts to build up, positively contributing to your return, pulling the line back upwards.
So the reinvestment gain starts offsetting the price loss.
Exactly. And at the exact point in time where these two lines cross, where the cumulative gain from reinvestment precisely offsets the initial capital loss from the price drop that time point on the horizontal axis. That's the Macaulay duration.
The point where the net impact is 0.
Precisely. And the same kind of pattern holds true, just mirrored when interest rates fall. You get an immediate price increase, a capital gain, but that's followed by a growing loss relative to your original expectation because of lower reinvestment income. Again, the point where the gain and loss offset, Macaulay duration. It's the visual representation of that immunization horizon.
That visual really helps solidify the concept. It's the point where the two opposing forces generated by a rate shift cancel each other out over time.
Exactly. It's the equilibrium point for interest rate risk exposure.
All right. Now that we hopefully understand what Macaulay duration is, why it's so darn important, and how it acts as your personal risk thermostat, let's get into the mechanics. How do we actually calculate this number?
The nitty-gritty. Yeah, the nuts and bolts. We said it's a present value weighted average of when you receive a bond's cash flows. Now, the underlying formula, if you look it up, can look a bit intimidating with all its summation signs and Greek letters.
Yeah, formulas can be scary.
They can. But breaking it down into logical steps makes it quite intuitive. It's just a process.
Okay, let's walk through the process.
We use Exhibit 4 from our sources as our guide. Let's stick with our BRWA 10-year 6.2% annual coupon Eurobond, issued at par. We'll calculate its Macaulay duration right at the moment it's issued.
Okay, starting point calculation.
Step 1. Determine cash flows.
Super easy first step. You just list out all the coupon payments you promised and the final principal repayment.
So for our bond.
It's a 10-year, 6.2% annual coupon, $100 par. So you get $6.20 at the end of year 1, $6.20 at the end of year 2, all the way through year 9. Then in year 10, you get the last coupon of $6.20 plus the $100 principal back. So $106.20 in year 10.
Got it. List the payments. Step 2.
Step 2. Determine time to receipt. This is just how long until each of those cash flows arrives, measured from your calculation date, the settlement date.
So if we calculate at issuance.
It's straightforward, 1 year, 2 years, 3 years, and so on, up to 10 years for the final payment. Nice and clean numbers.
But what if you calculate it like halfway between coupon payments?
Good question. If the calculation is done between coupon dates, it gets a little trickier, but it's manageable. The source material highlights this with the BRWA example, specifically example 5, where the calculation is done 57 days into the annual coupon period.
Okay, how do you adjust?
In that case, the time to receipt for the first cash flow wouldn't be a full year. It would be a fraction, like 1,57365 years, roughly. And then the subsequent cash flows would just add 1 full year to that adjusted starting point. So 1 plus fraction, 2 plus fraction, etc. You just need to be precise about the timing based on the settlement date.
Okay, so adjust the timing if needed. Makes sense. Step 3.
Step 3. Calculate present value, PV, of each cash flow. Here's where we bring in the time value of money. You need to discount each of those future cash flows back to today's value using the bond's yield to maturity, YTM, as the discount rate.
The standard PV calculation?
Yep. The formula is simply cash flow, 1 plus R time, where CF is the cash flow amount, R is the yield to maturity per period, so 6.2% or 0.062 in our example, since it's annual, and time is the time to receipt from step 2. You do this calculation for every single cash flow year by year.
Okay, discount every payment back to today. Step 4.
Step 4. Calculate total full price, sum of PVs. Once you have the present value of each individual cash flow from step 3, you simply sum all those individual PVs together.
Add them all up.
Add them all up. This grand total gives you the bond's full price, which is its total present value based on the YTM. This should theoretically equal the bond's market price if the YTM used is the market yield. For our example issued at par, this sum should come out to $100.
Okay. Step 5. We're getting closer.
Step 5. Calculate weight of each cash flow. Now we figure out the weight or importance of each cash flow in the overall calculation. You do this by taking each cash flow's present value from step 3 and dividing it by the total full price from step 4.
So PV of cash flow, total PV of bond.
Exactly. This tells you what proportion or percentage of the bond's total present value is represented by each specific cash flow. And it's worth noting here, usually that final payment, the last coupon, plus the big principal repayment, even when discounted back 10 years, usually has the largest single weight because it's just such a large chunk of money.
Right. The principal return dominates the weighting towards the end. Step 6.
Step 6. Multiply time to receipt by weight. Almost there. For each individual cash flow, you take its time to receipt from step 2 and multiply it by its corresponding weight from step 5. This step is where the weighted average concept truly takes mathematical shape. You're multiplying the when by the how important.
Time weight for each row. Got it. Final step.
Step 7. Sum the last column. Finally, you just sum up all those values you calculated in step 6, time x weight. The grand total of this sum is your Macaulay duration,
And it's expressed in?
typically expressed in years. So for our BRWA bond example at issuance, following these 7 steps meticulously, as shown in Exhibit 4, this final sum comes out to 7.7429 years.
7.7429 years.
And if you remember from our earlier discussion about the duration gap, this number, 7.7429 years, was very close to Hydas Capital's 8-year investment horizon in that example, which meant their duration gap was small and their risks were nearly balanced or immunized against those small rate changes at that point. The calculation confirms the concept.
That step-by-step breakdown makes it much clearer than just looking at the big, scary formula. It's logical.
It really is. It's just a methodical process.
However, it's also really important for practicality, for anyone studying for the CFA or working in the field, to know that in real-world applications, especially if you're dealing with hundreds or thousands of bonds in a portfolio.
Nobody's doing this by hand.
Absolutely not. No one is doing this manually on a daily basis unless maybe they're building the calculation tool itself. We rely heavily on powerful financial calculators or, more commonly, robust spreadsheet functions.
Right, like in Excel or Google Sheets.
Exactly. Popular spreadsheet software has built-in functions, often called something like duration or mDuration. You typically input key parameters. the settlement date, which is usually today's date or the date you want the calculation for, the bond's maturity date, the annual coupon rate, the annualized yield to maturity YTM, the frequency of coupon payments per year, so 1 for annual, 2 for semi-annual, 4 for quarterly, etc.
And that basis thing you mentioned.
Right, and crucially, the basis for day count conventions. This tells the function how to count the days between dates. Common ones are 3360, actual, 360. You need to use the correct one based on the bond's specific market convention.
So the function just does all 7 steps automatically.
Pretty much. This function automates all those steps we just walked through, providing the Macaulay duration directly, and assuming you input the parameters correctly, accurately, it's a huge time saver.
Definitely need to know how to use those functions.
Absolutely. But understanding the steps behind it helps you understand what the function is doing and why those inputs matter.
Good point. Now, are there any general properties of Macaulay duration we should keep in mind?
Yes, a couple of important ones that are essential for understanding how it behaves.
Okay.
First, for any bond that pays coupons, its Macaulay duration is always less than or equal to its time to maturity. Usually less.
Why less?
Because those earlier coupon cash flows arriving before maturity pull the weighted average time forward from the final maturity date.
Yeah.
It's not just about when the last payment arrives, it's the weighted average time of all payments.
That makes sense. When is it equal to maturity then?
Only for a zero coupon bond. Its Macaulay duration is exactly equal to its time to maturity.
Why is that?
Because a zero coupon bond has only one cash flow, the principal payment, and arrives precisely at maturity. There are no earlier coupons to pull that weighted average forward. So the average time is just the time of that single payment. Our source materials example 7 clearly demonstrates this.
Okay, so less than maturity for coupon bonds, equal to maturity for zeros.
Okay.
Got it. What's the second property?
Second, as we touched on earlier, Macaulay duration is not static. It generally decreases over time.
Right, the clock is ticking.
Exactly. As a bond gets closer and closer to maturity, the time remaining until all its remaining cash flows are received obviously decreases. This naturally pulls the weighted average time down, and thus its Macaulay duration decreases as well. It doesn't usually decrease day for day, but it trends downwards.
Which is why you need to keep recalculating it for risk management.
Precisely. It's a dynamic measure that needs ongoing monitoring if you're doing any kind of active portfolio management or duration matching. Your risk exposure drifts if you don't rebalance.
Okay, let's put the calculation into context again, maybe with the spreadsheet functions in mind.
Sure. Let's consider an Indian context example for calculation using, say, Excel. An investor is analyzing a Reliance Industries corporate bond that pays semi-annual coupons.
Okay, semi-annual is common.
Very. To calculate its Macaulay duration using the duration function, they would input the settlement date, maturity date, the bond's coupon rate, its current YTM, and importantly, they would set the frequency parameter to 2 for semi-annual payments.
And the basis.
And they'd need to ensure the correct basis is selected. Maybe it's a 3360 convention, maybe actual, depending on the specific market standard for that type of corporate bond in India. Getting those frequency and basis parameters right is absolutely crucial for an accurate duration calculation.
Good example. How about the U.S.?
Okay, in a U.S. context example, maybe a portfolio manager needs the Macaulay duration of a U.S. Treasury bond that was issued last year. They'd input the current settlement date, the T-bond's maturity date, its coupon rate, and its current yield. For U.S. Treasuries, the frequency is almost always 2, semi-annual, and the basis is typically actual, reflecting the exact number of calendar days.
So know your bonds conventions.
Absolutely. These details aren't just, technicalities you can ignore. They are critical inputs for getting an accurate calculation using the duration function, which then enables the manager to understand their precise interest rate risk exposure using the duration gap concept we discussed.
So just to recap our examples for the BRWA 10-year, 6.2% annual Euro bond at Issuance, Exhibit 4, doing the steps or using the function gets you that 7.7429 years Macaulay duration.
Correct.
And as we highlighted, that being close to Hydas Capital's 8-year horizon explained why their risks were nearly balanced. And for the other property, if you had, say, a 5-year zero coupon bond, its Macaulay duration would simply be 5 years.
Exactly 5 years. No intermediate cash flows means the weighted average time is the maturity time.
Perfect. It elegantly proves why Macaulay duration equals time to maturity for those specific zero coupon instruments. Wow. Okay. What a journey. We have truly gone deep today, haven't we? Into understanding the different facets of return and especially risk for fixed rate bonds.
It really transforms what seems like a simple investment into this dynamic interplay of forces.
It's definitely more complex under the hood than just the coupon rate suggests.
Totally.
Yeah.
So what does all this mean for you, the astute investor, or the dedicated CFA candidate listening right now?
Let's wrap it up.
Let's recap. We started by identifying those three essential sources of return that make up a bond's total payoff. First, the direct receipt of coupon and principal payments.
The basics.
Second, the crucial yet often underestimated reinvestment of those coupon payments, the compounding engine.
The silent force.
And third, the potential for capital gains or losses, but only if you sell before maturity. We then clarified that a bond's yield to maturity, YTM, while a super common and powerful metric, only equals your actual realized return under a very specific and often pretty idealized set of assumptions. Assumptions about holding to maturity, no default, and constant reinvestment rates that frequently don't hold true in the messy, dynamic, real world.
The YTM promise versus reality.
Exactly. Then we explored that dynamic duo of interest rate risk, price risk, which bites you when rates rise and your bond's price falls,
Hurting shorter horizons more.
and reinvestment risk, which gnaws away at your long-term returns when rates fall, and you can't reinvest those coupons at attractive rates.
Hurting longer horizons more.
You know, remember that crucial inverse relationship, they're always working against each other, creating that seesaw effect. And we saw how your personal investment horizon is absolutely key to determining which of these two risks will dominate your overall experience with a particular bond.
Your timeline dictates your main worry.
Precisely. And finally, we introduced Macaulay duration, that powerful weighted average measure of the time to receipt of a bond's cash flows. We learned it's your theoretical immunization horizon, the critical point in time where price risk and reinvestment risk can perfectly offset each other, shielding your total return from small, parallel shifts in interest rates.
The balance point.
And we briefly touched upon the duration gap, Macaulay duration investment horizon, as a simple yet effective way to measure your net exposure. Are you more vulnerable to rising rates? Positive gap price risk dominates, or falling rates, negative gap reinvestment risk dominates. Understanding this truly transforms you from just a passive bond buyer into an active manager of your bond risk.
Well summarized. And if we connect this back to the bigger picture one last time,
Yeah.
for any fixed income investor, whether you're managing billions or just your own savings, moving beyond just staring at the coupon rate and really understanding these intricate dynamics is absolutely crucial for making informed decisions.
It's night and day.
It really is. It transforms you, as you said, from just being a passive recipient of whatever returns happen to becoming an active manager of the risks involved. So as you evaluate bonds going forward, consider not just their stated yield, but think critically about your own investment horizon and how potential changes in interest rates, which are always uncertain, could dramatically shift your actual realized returns away from that initial YTM.
Good advice.
This knowledge isn't just for passing exams, it's fundamental for building robust, resilient portfolios in the real world.
Definitely.
And maybe this raises an important question for you, the listener, to ponder as you continue your studies or your investing journey. How might a bond's credit quality, how likely the issuer is to default influence the relative importance of these interest rate risks we've spent all this time discussing versus the ever-present risk of simply not getting paid back at all?
Ooh, interesting thought. Does higher quality make interest rate risk more important, relatively?
Does a higher quality bond, where default risk is lower, make you more sensitive to interest rate changes because they become the dominant remaining risk? Or perhaps less sensitive in some other way? Just think about how these different types of risk, interest rate risk, and credit risk interact, and which one truly keeps a bond investor up at night, depending on the specific bond they hold. Something to chew on.
That's a great final thought. Definitely something to mull over.
Yeah.
Okay, that wraps up our deep dive into Module 10 on interest rate risk and return. It's been quite detailed, covering some truly fundamental concepts for fixed income.
Foundational stuff.
Absolutely. Next time, we'll move straight into Module 11, yield-based bond duration measures and properties, where we'll build directly on Macaulay duration and explore how other related duration measures can provide even more nuanced insights into bond risk and sensitivity.
Looking forward to it.
Me too. Until next time, keep digging deeper.